All right. Hey, look at how many people are already here. I see a lot of you already here. Please do make sure to say hello, send out a shout, let us know where you're listening from or tuning in from or whatever you call it. And hey, good morning, good afternoon, good evening, good midnight, wherever you're coming from. We're just glad you're here. My name is Greg Lewis. I'm the marketing manager for Metastock, and this is the day one of our quarterly Metastock conference. It's a multi-day event, 6 full days, 40 plus speakers, 40 plus presentations, and I know you're really, really going to enjoy this. Couple things real quick. We are Metastock. We're the major sponsor here, and just in case you haven't heard of us before, I'm going to go ahead and play a little video so that you can see what we're all about.
Hi there, Greg Lewis, Metastock Software. As the marketing director, I get asked all the time, what is Metastock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you. Metastock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, Metastock is a tool for traders like you to analyze the markets. Metastock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of Metastock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the Metastock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The Metastock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the Metastock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love Metastock's Option Scope. Option Scope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And Metastock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, Metastock explains how they work in an easy-to-follow commentary window. Metastock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. Metastock even has the very popular and exclusive Rahul Mohindar oscillator system, or simply known as the Armo. And as you become a more experienced trader, Metastock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why Metastock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about Metastock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
All right, so if you haven't heard about us, that's who we are, Metastock, world-class software and market data for self-motivated and active traders just like yourself. All right, today's first presenter, well, okay, let's actually look today at our lineup. Okay, today's first presenter is Vince Vora. After Vince Vora, it will be the amazing Oscar Carboni. We like to call him a force of nature. Raymond Rondeau, who has come out with an amazing product that takes testing to the ultimate level. Then John Seville, Jake Bernstein, and Brian Latta. Jake is a fantastic presenter, and he's always very interesting, and he's very experienced, and we enjoy Jake a lot. And then the incomparable Larry Mcmillan. If you haven't heard of Larry, you probably should have by now. And make sure to listen to him. And then our very own Jeff Gibby. He'll be discussing powerful tools for today's market. Melissa Armo. And then wrapping everything up today is Dan Passarelli. If you weren't counting, that is 8 presenters today. And you can stay for all or none. Remember, we are recording this event, and recordings are available to anyone that is registered. Which brings me to a good point. Thank you for asking. You didn't ask, but I'm going to tell you. If you haven't registered for today's event, you can still watch it on YouTube. That's fine. I should mention we simulcast on YouTube and GoToWebinar. It doesn't really matter which one you watch it on. It's essentially the same experience. But if you register, then you'll be able to participate in the free door prizes that Jeff's going to be giving throughout the day. And also, you'll get on our mailing list, which you may or may not want to do. If you don't want to do that, all you have to do is the first time you get an email, unsubscribe at the bottom. We won't bug you anymore. All right, so we have about 1 minute and 20 seconds left. Finally, I'd like to say, go ahead, do like and subscribe. We really, really appreciate that. It really supports us, and it lets you know, if you hit that little bell, whenever we have our live event, which is usually once or twice a week, and then quarterly we have these mega live events, and then monthly we have a marathon live event, which is 8 hours. They're always great. We always have great speakers, and we get great feedback. So I know you don't want to miss that. All right, we've got about 1 minute left. One final note, I come on before these events to give people a chance to settle in, and normally I edit myself out. But on these longer events, for some reason, YouTube won't let me do that. So if you're watching this as a recording, there's no reason why you can't just fast forward through me and get to the thing you want to watch. And we also usually put a counter at the end showing, chapters, I should say, showing which event you want to see, and you can just go right to it. So anyway, thanks for hanging out. Have a great day today and successful trading. I'm going to let you listen to jazzy music for the next 20 seconds.
Hold on just a sec. All right. Hello, everybody. Thanks for coming. Jeff Gibby over at Metastock. Let's go ahead and kick this off. It's good to see you. Thanks for coming. If you're watching this on YouTube, make sure to like and subscribe. It helps a great deal. Say hello. If you're watching this and GoToWebinar, say hello. It's good to see you. If you have questions as we go, make sure you ask them. We try and answer as many as we can. Just due to the size of the event and this particular event in general. Sometimes we can't get to all the questions, but we'll do our best. So if you have them as we go along, let us know. So before we get started today, I have to read a legal disclaimer. Let's start there. Today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features
within the software. I lost my place. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Hello, Shanae. It's good to see you. Thanks for saying hi. Let's go ahead and kind of go over here. There's a couple of sponsors I want to talk about. The first one I want to mention is Stocks and Commodities Magazine. Stocks and Commodities Magazine has been supporting our events for over a decade now. They do a really, really good job. They also really do a good job of actually marketing or making a magazine around technical analysis that comes out every week. And so over the years, they've been publishing since 1982. They've done 17,000 different articles, and they've got 1.3 million subscribers. So we appreciate Stocks and Commodities and their support. Thank you for that. Another great partner of ours is the CMT Association. You can find out more about the CMT Association at cmtassociation.org. But they basically do accreditation. And if you're interested in becoming a CMT or a chartered market technician, Tyler's going to come in a little bit later in the week and talk about how that might be helpful for you, how it can kind of help you, especially if you have like money under management or that kind of stuff. It's really, really eye-opening what they can do. cmtassociation.org, or call them at 646-652-3300. And last but not least, we want to thank AAII at AAII.com for their sponsorship. AAII is the American Association of Individual Investors. Great sponsor of the event, been doing an association of individual investors for a long time, and very, very well respected, well reputed organization as well. So thank you to AAII, CMT Association, and TASC for sponsoring today's event. We are, of course, and we'll talk a little bit more about this as we go, we are, of course, Metastock. And, you know, Metastock, one of the things that we're proud of is the fact that we've been rated #1 30 years in a row. We're not going to talk a lot about Metastock right now because we want to get underway, but it has been rated #1 30 years in a row. One of the things I absolutely love about Metastock is the ability to scan. I'm going to run a market scan as soon as Vince gets started. And while I'm listening to him, I'm going to be looking at stocks. But I just love the ability to scan. You can also test trading ideas. You can get forecasted moves. You can get real-time alerts, commentary, signal. Great platform. It starts at $59 a month. And what we're doing as part of the conference is if you buy a month of Metastock, we'll give you a second and third month for free. We'll talk more about that as well. Metastock.com/conf promo. So I think that covers everybody, all the sponsors, all that kind of good stuff. Our first speaker is Vince Vora. Vince Vora has been running, doing events with Metastock for a number of years. He's designed some of our most popular methodologies for trading the markets, for finding stocks that are about to break out, and he does a really, really good job about system design. The other thing I love about Vince, Metastock, is that he just is very, very easy to understand. He's very thorough, and he's a great technician. So, Vince, let's go ahead and get you started. How are you doing today?
I'm great, Jeff. How are you?
Cool. I'm doing very well. Let's see. Let me go ahead and make you the presenter.
Excellent.
And I'll make sure I can see you. I can hear you. And I'll just make sure we can see your screen.
Yeah, let me know if you should see a blue slide there.
Yep, you're good. So
excellent.
I'm going to get out of the way. It's your turn.
All right, thank you. Thanks for having me on. Welcome, everybody. Good morning. Glad to be here with you. Today, I want to make the most of the hour that we have together this morning. As you can see on my screen, what I really want to talk to you about is our victory method. This is something that I designed back in middle to late 2019, so just before the pandemic, COVID pandemic hit, and have been trading with it ever since. So I'm going to go straight to the charts. Just before I do, I just want to say again, I'm Vince Vora. I'm the head trader here at Trading Wins. I've been doing this for a very, very long time. It's actually approaching almost 40 years now. And as Jeff said, designed several different add-ons, but Victory is by far my favorite and what I'm trading with these days. Please remember, trading can be risky, so don't trade with real money until you get completely comfortable with the system you're using. Having said that, let's go straight to the charts and let me tell you what Victory is, what it's meant to do, and how it can help you with your trading. So what you're seeing on the on my Metastock chart here, these arrows and dots here in this blue line, that is the Victory add-on that Jeff and his team programmed for us back in 2019. So obviously the arrows are your initial trade setups. Now, one thing I want to say right off the bat is the intent here is not to take every single signal. Now, we have tested this over and over again in different markets, different time frames, different exchanges. It will work. You will come out ahead, or should come out ahead, if you're trading every single one, but that is not the intent here. What we want to do is identify, identify the ones that are going to give you the greatest edge in the market. So if you decide to trade with the Victory add-on, you will receive a couple of different training classes along with ongoing support from us at Trading Wins. And Jeff will get into a bit more of that later on. But the arrows here are your initial trade setups. That's when the algorithm all comes together and tells you it's a great time to get in on a trade. But this indicator is all based on trend and momentum. So it is solely based on technical analysis, no fundamentals, based on trend and momentum. So what you want to do is identify a great trend, read how strong it is, and then go along for that ride. That's what we try to do here. The dots are the exact same thing as the arrows, meaning the same criteria in the algorithm that came together to populate an arrow has come together again here. The only reason we identify it as a dot this time, and you can see as I hover over, it says long RE, which is a re-entry, right? We mark it as a re-entry. The reason why we do that is because we're already in a trade. So if you got in on this one, now when you see another dot appear or several afterwards, you can add to that trade if you like, or if you missed the initial entry, you can feel free to get in on this one now. The same criteria has come together, okay? One is just as strong as the other. It's the exact same thing. It's just that if we're already in a trade, we mark it as a re-entry, not an initial entry. You can also tell that once we do enter a trade, all the bars, the price bars, are colored the same. In other words, for long trades, they're all colored green until we exit that trade. And for short trades, they're all colored red until we exit that trade. That is there to help you remain disciplined and not get scared out of a trade. I mean, you know, many times we get in, starts going our way, we see a couple of red bars, we start to panic, worry that we're going to give back our profits, pull the trigger, get out of our trade just to watch it continue on. So this is there to keep you disciplined and keep you in the trade. If you ever see yellow price bars on this, there aren't any on this chart, but if you ever see yellow, it means you shouldn't be long or short. You should be on the sidelines waiting for the next proper setup. All right. Now, again, not every signal is one we want to take. For example, these red ones here, since we're in an uptrend, right, we only want to use that change in color as an exit, not a reason to get short the market. Since we're in a long trade or a bull market here, why would we want to go short, right? We're just asking for a quick stop out. So we'll teach you along the way which ones to take and which ones to not. I'm going to give you 3 or 4 key things to look for, very quick, very easy, and then give you one main thing that you should just follow if you want to keep it as simple as possible. Okay? So what we need for a long trade, obviously, is a green arrow, right? We need the signal to begin with. That's one. Number 2 is we need slope on this blue line. Now, this blue line, as I hover over it, you can see is just a 20-period simple moving average. Not exponential, not weighted, just a 20-period simple moving average. It's the one indicator I've traded with my whole career and will never trade without. Reason being, this moving average not only is one of, if not the most commonly traded moving average used by both retail traders like you and me, as well as pros, but it does a great job helping us to identify the amount of momentum behind a trade. And by that, we're talking about the degree of slope. So if you're looking to trade to the long side, you want the 20 to be sloping higher, all right? And if you're going to trade to the downside, you want that 20 to be sloping lower. So very simply, as I flip through charts, and I'm going to try to go through as many as I can. So on that note, just so you don't think I'm cherry picking any charts, I'd like you to put symbols into the chat. Tell me which stocks you want to look at, Forex pairs, whatever it is. This works on equities, futures, Forex, crypto, it doesn't matter. Anything you can create a chart on, any exchange. I'm going to show you, markets overseas, exchanges overseas. We can look at the Nifty, Hang Seng, whatever it is you want to look at. We can look at it. Works the same across the board. And any time frame, by the way, whether you're a day trader and trade the 1 minute, 3 minute, 5 minute, or whether you're a more of a swing trader like me using daily charts, or more of a long-term investor with weekly and monthly charts, works the same way. So when we're looking for a reason to go long, we need a green arrow. Then we need a slope on that 20, and the degree of slope matters. Now, what do I consider a very significant slope? Just visually about a 45-degree angle, something like that. Any kind of slope is fine. So whether it's a slight slope, that 45-degree angle, but the higher the degree of slope, the better, obviously, the more momentum, okay? So as you can see here, you have slight slope on this one, right? Better slope here, but look at this slope, right? So the higher the slope, the more the momentum. It's like wind at the back of those price bars, pushing them higher. That's what we want to see on our trades. The third thing we want to see is that the price bar that is highlighted by that arrow or by that dot is close to the 20. Whenever price moves away from the 20, it snaps back, right? Now, when you're at all-time highs, sure, it can keep going for a while. Eventually, it's going to snap back. But what we want for our entries is to be as close to the 20 as possible, mostly because we do use the 20 as an exit. So, if you're getting in up here and you get stopped out all the way down here, it's going to be painful, right? We want to keep our losses as small as possible. And then the last thing we look at is we look to our left to see if there's been prior activity at that price level, right? In this case, along this stretch, and this is the Qs, by the way, QQQ, the ETF for the NASDAQ 100, it just kept making new all-time highs. So when we look to our left, there's nothing but blank space, which is ideal, right? Means there's no overhead resistance. So if you get a setup that is near the 20, has slope on that 20, and you look to your left and there isn't much in the way of resistance, that's a very high probability setup. Those are the ones we want to take. So how do we enter? Well, we allow this bar to close, again, whether it's a 1 minute chart, a 5 minute, a daily chart, once it closes, you mark the high of that chart. And one tick, 1 penny above there, as long as it breaks that high, you can jump in on that trade, all right? And then ride it until you see a change of color. Change of color, you're out. Now, we encourage you to scale out along the way. A lot of these trades, they move quite a bit. So you want to scale out some of your profits along the way because you never know when it can snap back on you. There's one thing that the victory system cannot protect you on, which is the same thing that there's nothing, no system out there that can protect you from this. And those are gaps, right? The market closes here, you wake up the next day and it opens down here. It's not very common, but it happens. One common event that causes that is earnings. So we always tell our students is to avoid earnings. Always check that next earnings date for whatever stock you're going in on. And if it's too close, don't take that trade, but know when that date is. Even if it's 2 months from now, if you end up catching a runner like this and you're staying in that trade, you want to make sure you're out before earnings. Okay, you don't want to get caught with that gap. So very simple criteria to get in. Now, on the short side, it's the opposite. What you're looking for is a red candle or a red dot, right? That bar needs to be near the 20, but that 20 needs to be sloping lower, right? Downward. That's what you want. Then you look to your left, and if there isn't a lot of support, a lot of prior activity there, even better, okay? That's simple. So what you're looking at here is a monthly chart of the Qs. The reason why I'm starting off with this is to show you that this is a good way to judge the overall market. So if you're looking at the Dow Jones, the S&P, the NASDAQ, the Russell 2000, the main indices, right? You kind of get a sense whether we're in an overall bull market or a bear market, okay? If you're above the 20, you're good. You know, price tends to go higher. If you're below it, it's the opposite. But just look at the victory color here, right? We're still green. So we're still bullish, even though we've been pulling back for a few months here. Overall, that is the trend. Now, doesn't mean you have to trade on that. What you can do when you see that is just roll back to a lower time frame and then look for trades in that direction. So if the overall market, especially if all four, the Dow, the S&P, the NASDAQ, are moving higher, you want to have most of your positions to the long side, not the short side, right? So just use it as a gauge. If you are a longer term investor, I highly encourage you to use the monthly charts. For example, I'll just show you some of those big name stocks, right? The Costco's of the world, right? I mean, these require very little time. I mean, you're looking at it basically once a month, your charts. You know, you work one day a month and you look at these. Metastock has a great scanner. If you're not aware of it, I'll show you. That'll help you find new setups. But once you get in on those, all you're doing is coming back next month to see if there's a change in color. Otherwise, you're staying in. And you may want to check it throughout just to scale out of some of these positions. But if you look at some of these monthly charts, you know, look at all these setups. Any of these you could have taken, right? You have a signal, you have slope, you're near the 20. You look to your left, it's just nothing but blank space. I mean, ideal setups. Any of these would have made you money, let alone buying here, adding to it, and then eventually scaling out. Fantastic, right? Across the board, many like that, because the market has been trending higher for several years. So here's Amazon, right? Now, one thing that I will tell you that I've learned over my years that you should have as a hard stop, and that's any close, not a trade, any close below the 20 period moving average. If we had followed that rule here and got out here, it would have saved us from all this pain, okay? We won't even talk about shorting this and make money along the way down. Just if you're just an investor, you're just a long side investor, right? You're going to buy and hold. You're not interested in going short, okay? Whenever you get a close below that 20, get out. If it turns around, goes right back in, that's fine. You can jump right back in, but get out. There's numerous examples I can show you where these, as good as these companies are, as solid as their outlook was at the time and so on, once they close below that 20, they go for a ride, right? Think of the ARC funds, for example, and many stocks after the pandemic started. What happened there? So again, we're going to go from an extreme. Here's, I want to show you first, Apple. Okay. And thank you. I see a number of symbols. I'm going to get to those in a second. Here's Apple, right? One of the best stocks out there. Still in the green here, still trending very well, right? Just to show you any time frame, I'm going to go down to a weekly on Apple. And remember, what are we looking for? At a glance, okay? I know for those of you who've never used this add-on before, your eyes aren't trained to immediately go to the criteria that I talked about at the beginning. But as I flip through charts, remember that what we're looking for is slope on that 20. So if you look at the setups that have that slope, just kind of look and gauge to see how many are winners, how many are losers. I can tell you the overwhelming number are winners. Why? It's because there was a trend in that direction. And with strong momentum. That's what the 20 is telling you. There's a ton of momentum. So you can pretty much buy anywhere along this line. What we do is kind of pinpoint the entry to kind of maximize that gain and reduce as much risk as possible. But you can pretty much buy anywhere along that line and make money. That's why. Now, when you see a flat 20 or a 20 that's going in the opposite direction, so here's a buy, but look at the 20, right? It's not sloping higher, right? So you may say, well, why didn't you take this one? It ended up working out great. I will tell you 2 things to look for if you want to take these. But the reason I'm saying go with the slope is until you get a little more experience with this add-on, you just want to take the easy way out here. You want to take the highest probability trade setups, build your account, and slowly get familiar with the add-on, and then start looking at adding other trade setups. Because we can go into many other things aside from support and resistance. We can talk about other indicators that we can talk about chart patterns. We can talk about candlestick patterns to add to this and make it strong. There are many ways. What I'm telling you is you don't need any of that. You can just keep it very, very simple and just look at the trades where there was slope along that blue line and those signals with the bars near it, and just look at winner after winner. Okay. The reason why we don't want to trade when the 20 is flat, okay, that's where traders get chopped up. That's where you lose most of your money. Okay. You get in, you get stopped out. You go short, you get stopped out. You go short again, you get stopped out. It happens over and over and over again. That's why you want to avoid the consolidation areas, the areas with no momentum or trend. Okay. And only trade with the areas with momentum and trend. And even if you're just starting out, you're not even familiar with pivots. Okay. So pivots are the turning points. So this is a pivot high. This is a pivot low. This is a pivot high. This is a pivot low. Okay. Even if you're not familiar with those things, you can't even judge for yourself whether there's higher highs and higher lows or lower highs and lower lows. You don't need it. Just look at that 20-period moving average. Okay. Now this is the weekly. We can go to the daily. And remember, as you go lower in time frame, obviously there's going to be a little more volatility, right? A lot more back and forth. The higher the time frame, the smoother the price action, right? Here's Apple on a daily. Went through a very, very strong trend here, right? Again, you could buy anywhere along this line, right? But we pinpoint those entries when we get those retracements to that 20, help you not only identify the initial entry, but where you can add to that position, okay? Now, if you decide to trade with this, along with the instructions to do this, we give you a full money management plan, a full trading plan that goes with it. If you follow the money management rules, all right, you will never take a big loss again. I will guarantee you that, okay? You will never take a big loss again if you follow the money management rules we give you. Why? If you don't know me, if you haven't heard any of my other presentations and you don't know my background, when I first started out, I took a massive loss, okay, in trading. Why? Because I thought I knew what I was doing, but I didn't really know what I was doing. I overexposed myself and got caught and took a big loss. From that point on, my trading has changed, and I created those rules to make sure I would never have to go through that kind of pain again. And so I'm passing that on to you in those training classes. Okay. Now we're going to go sub daily here. We can go to hourly if you want. Okay. Again, just look at the signals with slope versus the ones without, and you'll quickly be able to see how good this works. But I'm going to go to an extreme. I'm going to go all the way to 1 minute. Okay. 1 minute. It works the exact same way. The piece of advice I'm going to give you, if you're a very, very short-term trader, like a day trader trading on 1 minute, 3 minute, 5 minute charts, you need liquidity. You need volume. Okay. You don't want stocks that aren't traded very often. You want the Apples of the world that have a lot of volume. The charts are nice and smooth. You can read these signals very easily. Look, if you had avoided these setups here, okay, because the 20 is pretty much flat, okay, you would have avoided all these stops. And then once you got to that slope, boom, nice and easy, right? Slope, boom, okay? Avoid, all right? who cares if you're missing that first section, even though I'm going to show you how you can take advantage of that too. Once you get to slope, boom, boom. It's that simple. It does the work for you, okay? This is not complicated. What complicates trading is the actual trader. We are the problem when we trade. Why? Because of our emotions. That's why. So we built this to not only read the trend and the momentum and give you a high probability setup, but we've color coded it in a way that will keep you calm and allow you to remain in the trade for the life of the trade. Okay. Now, let me go back to a daily chart. Start looking at some of the symbols. If there's a particular time frame you want to look at, by all means. But Kevin says MELI. He wants to have a look at. Let's have a look at MELI. There we go. And let's have a look. All right. So here it is. Bit of a messy chart, right? And again, this is what you want to avoid. You want to avoid messy looking charts. If you want to see another one, I can put it up for you in a second. That comes to mind is Zoom. Go have a look at the Zoom chart. A complete mess on the daily time frame. So if you see price bars going back and forth, back and forth, back and forth, right? Pretty much no matter where you enter that stock and you put a stop, you're going to get stopped out because of the wild swings. That's what volatility is. That's what we want to avoid. One of the sort of side benefits of victory is that when you see a lot of arrows back to back here, all lumped in together, that's a warning that you don't want to trade that chart, okay? You don't want to trade that chart. So I can look at this and say, all these signals here, I wouldn't want to take some of these or most of them. Now, if you look at the ones with slope and you say, I'm just going to follow that rule that Vince told me, just look for the slope. Near here, I look to my left, there isn't much, so I'm going to take it. I get stopped out. Look at the size of the loss that you would have here, right? Very small, okay? Very small. This one here actually works out. One of the things that we're going to teach you with this is where to scale out. Where are your profit targets? Before you enter a trade, not only should you know where your stop is, you should know where your next two profit targets are, okay? And so here you would have actually taken partial profits, would have come back, you would have added, you would have taken another partial and eventually gotten out. You would have made money here that more than would have recouped these losses. We'll show you exactly how to do that. But what I want you to do is look at a chart and just glance at it and say, is it a mess or is it nice and clean? One of the other tips I'm going to give you is that when a chart is trending strongly, all the bars are more or less the same size. Okay, let's go back in Mcmillan and see if there was a time here when it was trending really strongly. Okay, here's a little cleaner. Okay, you notice how here the bars are pretty much similar size and they're not big, right? When you're trending strongly, look at this strong trend to the downside, right? You get the odd big bar, but they're all more or less very similar in size, okay? And they're all moving clearly in one direction. You get higher highs, higher lows, one candle after the other. That's the other thing. So glance at it and look at it. Let's look at a higher time frame. And again, you look at the ones along the slope, okay? Very easy to pick off, very obvious. And there you go. Here's another one. Boom, right? Now, I know some of you are waiting to say, hey, how do I take advantage of the start of that move? Okay, first off, I would encourage you, please, try to avoid the urge of trying to pick a bottom or pick a top. You're asking to lose money doing that. But I'm going to show you a couple ways. Let's look at Meta, for example. And Dwight, Eric, I see your symbols. I'm going to come back to them. No worries. Anyone on YouTube, Jeff will let me know what your symbols are, and we'll get to some of those. Okay, but let's have a look at Meta, for example. There are some examples here of what you want to see when you want to pick off these signals here, okay? And let me go back to the daily chart. I think there was an example here. Yeah, perfect. So when I want you to focus in on this area in here, okay? Notice this buy signal here. Look at the 20. It was flat, right? Completely flat. Now, whether the overall trend is clearly, you know, moving in one direction, it doesn't matter. At the time of the entry, it's flat, right? So at this point, we didn't know if Meta was going to start consolidating sideways or if it was going to break down or just continue the trend, right? So when you have a flat 20 or no clear trend in place and you're trying to decide, do I take this signal or not? There are two things you want to look for, two very simple things. One is a break of a prior high for long trades or a break below a prior low for a short trade. So in this case, this is the prior high that I would target, right? So at this point, when it gives us the green arrow, are we higher than this prior high? We are not. So we cannot take that trade. The other thing is a retest of the 20-period moving average. What I mean is we move away from it a little, we come back to it, and then we bounce off it. Okay, here, if we had broken the 20, if we had moved below the 20, we were likely heading lower. Okay, but we didn't. We bounced off it. It just so happens that we got another re-entry signal, so that makes it even easier, right? But this is what I would call a successful retest. So at this point, you could get in and look for upside, and boom, off it goes. So, and those two things you can use with any strategy. It doesn't have to be with victory. You either break a prior high or you retest whatever moving average you're using, okay? The cross of the moving average alone is useless. Don't waste your time. It'll work great in trending markets, right? For example, this strong trend here, you break, you cross back above, and boom, there it goes. But the second you start to trade sideways, like in here, you're going to get chewed up. You're going to lose all your money. You're going to give it all back. And that's what you want to avoid. Again, a clump of arrows and dots, avoid it, right? You could look at this as a channel, right? Mark the lows, mark the highs. If it breaks, get in. You know, these are all the things we teach you to use along with this indicator. But again, keep it simple. Just look for slope, okay? Let's look at, what is it, AMT for Dwight. Let's have a look at AMT. Okay, so here's one here that we talked about. No real slope right down here, but it cleared this high. Okay, now for your money management plan, was it too far from the 20? It would have been for me. Okay, it would have been for me. But again, as you can see, we cleared that high. We confirmed that we've changed direction and off it went, right? It still worked, okay? Here, we didn't have a slope, did we? But here's a low. Once we broke this low, off it went. See how that works? It's very simple. But you want to avoid thinking. You want to avoid, you know, all those other things that may complicate your trading. Focus on the signals with slope. Boom. It doesn't get any easier than that. Look at this one, okay? Now, when we look to our left here, there's activity. We got to try to judge, you know, is there too much support there or not? We'll show you exactly how to do that. But when you have a significant slope like that, you get a very clear signal, boom, off it goes, right? This one, no brainer. There's nothing to the left. Off it goes. Very, very simple. And you'll be surprised how many of these are out there. So your job when you're trading with this is going to be on a daily basis comparing one setup to another in order to select the best of the best. That's what we're really going to focus on in the training class, because there's so many of these out there, especially during trending markets, that you're going to want to pick one or two for that day and go with those. All right. What else did we have here? ABV for Eric, ABBV. Let's have a look at ABV. Oh, I think it was a K. Yeah. Let's have a look. So again, if we focus just on slope, okay, there's one here now. It kind of went a little flat. So if you want to say, oh, that's flat, okay, I can skip it completely, wait for slope like this, boom, there it is, right? If you want to wait to break that high or retest the 20, once it breaks it, off it goes. That's simple, right? Here's one recently, slope, boom. I can guarantee you, like, this is why I'm asking you to put in symbols. I have no fear about bringing up any chart here, and it doesn't have to be stocks, any. Why? Because the couple of indicators that are behind this algorithm, what they do is when they come together, it's impossible to miss a trend. When they come together, there is that trend in place. And so it's just a matter of identifying the amount of momentum that's behind it. That's what we're doing with the 20-period moving average and that slope, okay? But here it is again. You have significant slope, right? If we draw that line to kind of mimic the slope, that's way more than a 45-degree angle, right? Just visually, okay? Now, keep in mind, if you're going to zoom in your chart or zoom out, you're going to affect the angle of that. So just a sort of a rule of thumb to use. If you're using daily charts, you want to have about a year worth of data on your chart. So if we're in November, go to last November at the beginning of the chart, right? And put in a year of data. If you're on weekly, you want to look at 3 years, right? Monthly, you want to look at the full history. If you're day trading, you want to look at like 2 or 3 days worth of data. That's it. And then the slope will be what it is. But if you have a look at the number of these with slope that make you money compared to lose you money, it's overwhelmingly in favor of the wins. And when you don't, okay, if we were to get in, get stopped out, it's usually a small loss. Let me see if anyone else has questions or symbols. Let's see. Richie is saying, I'm trying to get some stocks for him to look at, but can't open. Oh, I'm sorry. People are having trouble with the chat, maybe. Stephen was saying GMRE. And in a second, I'm going to show you, different things other than just stocks. We'll look at some Forex, some futures. We'll go to different exchanges around the world and show you exactly how this works. Again, quickly here, right? If we just go from left to right with what we see on the screen, okay, and you look at the ones with slope and say, could I made money there? Absolutely, especially if you're scaling out, right? This one here, the slope is not in our favor. We skip it. We're not even going to bother looking at prior lows or retests. We're just going to skip, right? No slope here in our favor. We're going to skip it, okay? Even though, again, if you looked at those things, you could have gotten in, but we're going to skip it, right? Again, we're going to skip this. The slope is not in our favor. You could say, wow, I'm missing huge moves here. Again, this is why we teach you the break the prior low or a retest of the 20. Both of those happened in here. You would have been in this trade, but it doesn't matter because there's a ton of trades out there. If you just wait, here's one with slope, right? Would you have made money? Yes, you would. Here's one with slope. You would have made money, right? Here's one with slope. You would have made money. So out of here, even if you didn't use the additional tax, if you're just a complete beginner and just looking for that slope, you would have went 3 for 3, right? It is what it is. It's trend following. That's all it is. Barry wants to look at TQQQ. Let's look at TQQQ, which is the ultra short for the Qs. All right. I'm looking at daily. If you want to look at any other chart, and John says he wants to look at a 5-minute of the Qs. Okay, we'll look at that. Again, when we look at here, what are we looking for? Slope, right? Now, to me, this might be a little far from the 20. I'm extremely conservative. I hate risk. All right? I don't ever want to feel the kind of pain I felt back in the day. So I avoid risk completely. All right? So I don't mind missing some of these because I know there's others that, are just closer to the 20 and provide less risk for me. And that's why I take them. But, some of you are going to be way more aggressive than me and are going to want to jump all over these. Either way, you look at slope, you got a winner, right? here's slope to the downside, you got a winner. Okay, here you can argue there's some slope, but you take this anyway because it was a successful retest of that 20, and off you go. So again, count the ones with slope as opposed to the ones without. How many were winners, how many were losers? It's pretty much a no-brainer. And whether you're looking at one time frame or another, you know, it works the same way. It's just a matter of your time frame, right? Are you trading with this? If you are, frame's going to matter the date that you choose, right? Obviously. But again, whether it's monthly, weekly, daily, 5 minute, it doesn't matter. Let's go to a 5 minute chart for John, and he wanted the NQs. Now, are you talking about the futures, or I guess it doesn't really matter. We can look at the Qs on a 5 minute, but let me know what exactly it was that you wanted. Peter saying, please answer my question. Peter, I didn't see your question. Let me go back and see. It says, how does it differ?
Yeah, you got it. Yeah, I was just going to read the question to you because I saw it. I'll let you go for it.
How does this differ from Veracity, which I already purchased? Is that no longer the better indicator? Peter, it's still very reliable, still works great. The reason I created Victory back in 2019 was because I expected a lot more volatility. Now, at the time, I had no idea that COVID was around the corner. It just worked out that way. But I expected more volatility. So what I wanted was something that was going to pivot a little quicker, meaning when we get those changes in direction in the market, I wanted the indicator to respond a little quicker. And that's how Victory came about. So, you know, if you ask me, yes, I'm trading with Victory now, not with Veracity. I find it to be a little stronger, but that I'm not trying to dissuade you from trading with Veracity. Veracity still works, but this is a little more responsive and frankly a little easier to follow with these signals. That's all. Let me see if there's any other ones I've missed. Carl says, are you trading straight calls and puts? Actually, Carl, you can trade straight calls and puts. No, I trade more spreads now. And if you join our membership, which is part of this add-on, we will actually teach you a combo that we've been using recently that is for this purpose. Let me find an example. Here's a perfect example. So look at this one here. See this long, right? You have slope. You look to your left, there isn't much there. This looks like a perfect setup, right? But what happens? It starts to move in your favor. Maybe not enough for you to scale out, okay? And then it snaps back and gives you an exit. So if you look at the entry and compared to the exit, it's pretty much in the same spot, sometimes even a little lower, right? So if you're just buying the shares, that would actually be a break even or a loss. If you're buying a straight call, that would have been a loss. But with the combo that we're trading now, this would actually be a gain, okay? And it's more of a calendar type spread. We'll explain it in our chats. We meet 3 times a week with our members over Zoom Live. We open our cameras. We're searching for trades. We're teaching different aspects of technical analysis, all of that. Jeff will tell you exactly what's included in the end. Let's bring up more charts here. Futures, John says, I guess that was the NQ. Let me see if I can, no, it's not the same as, Jeff, do you know the symbol on Metastock for the NQ? Maybe.
I think the E-mini is the ES, like uppercase ES, lowercase C1.
Yeah, that's for the S&P, right?
Yeah, it's an NQ. I don't do futures a lot. I'm going to get embarrassed by the answers. Is it NQC1? Uppercase NQ.
Yeah, I tried C1. That. Yeah, because C1?
Yeah, lowercase C and a 1.
Oh, yeah, there it is. Yeah, thank you. Perfect.
Yeah. I'm not embarrassed.
No, Now, this is a 5-minute, right? So you can see that right now there's nothing going on. We're just kind of all over the place. This is a disaster here. You do not want to be trading here. You're just asking for trouble, right? With bars this big from high to low, bouncing back and forth, you're asking for trouble. You want to wait till things settle down. So during a day that's strongly trending like this is where what you want to trade, right? So we can go back and look at examples, and here's a nice, strong, consistent trend in the NQs. Look at the bars, all similar size, right? So much more volume here than what we're seeing right now. But again, it works just the same. Crude oil, for example, futures, right? Same thing. And I'm going to go back to daily just so you can, but there's one on the 5-minute that had popped up. Again, crude has been kind of crazy. When you see all these arrows and dots lumped together, switch to a different chart, okay? But again, here's another example here where we started to trend. We kind of went lower. We pulled back. Now the 20's flat. Do I really want to trade that? I don't. But if it breaks a high, there's nothing overhead, off it goes, right? Same sort of thing. Here you had a nice slope lower recently, and it's worked out nicely. What else can I show you? Bitcoin. Any crypto traders here? I mean, I'm not one. I'm just showing you this to show you that it could work on anything. Here's the most recent move, right? I mean, Bitcoin, let's be honest, hasn't been doing much for a very long time. And that's why you get a lot of these types of consolidation areas, right? Again, people that are trying to force trades and just trying to get in because they think, well, Bitcoin's going somewhere eventually, I'm just going to get in. You're asking for trouble. You're just asking. At the very least, this is dead money, right? If you're going to put your money in something and have it just kind of go sideways for a while, it's not earning you anything, okay? What you need to do is find trends. Find trends. So what is the difference in here? The slope, right? That is the real difference, the slope. Now, you can say, well, there was slope on this one too. Kind of went sideways, right? Yeah, we didn't really lose anything though, right? It's break even, maybe a small loss. So
you might have seen this question, but kind of wanted to know how many days do you look at when determining slope? So if I'm looking at today, am I looking, Jack, just a couple of days? Am I looking to the start of that move? Where am I going to kind of determine where the slope is kind of peaking?
I don't think of it as days. I just looked at on that candle, was there slope? So if we maybe this is a better way of answering your question. If for example, you have a stock changing directions, I'm trying to think of one. I'm going to try to answer two questions at once because Jay's asking me to look at a Forex pair, XAU USD. So let's do that and I'll try to find an example. Maybe I put in the wrong symbol. XAU USD. Or is it just XAU equals maybe?
XAU equals, yes.
Yeah, okay. All right, so here's a perfect, not a perfect example. Let me look, see if there's another one somewhere along here. Okay, so here, I'll use this one and it's not a great example, but have a look at this dot right here, okay? Again, it's not perfect, but a lot of times when you get a move like this, you might have a bit of slope, right? Like you say 1-2 days, right? And you look at that. If it's just 1-2 days, right? You got to look at the overall. So in here, if we look back at this group of candles, can we say there's a clear uptrend or a clear downtrend? We cannot. It's sideways, right? You know, do we have higher highs, higher lows? Do we have lower highs, lower lows? We don't have either. So this is why we wouldn't take this trade. It's not because of the slope or the lack of slope or whatever. It's because there's no clear trend. When you have a clear trend, when it's been going for a while and you just get that little pullback to the 20 with that slope, That's what we're looking for. So there isn't a specific number of days, but is there a clear trend or not? And as you flip through charts and you train your eyes, you will see immediately what you're dealing with. So for example, this trade, absolute textbook, no brainer trade. Why? You just look back and you can see top left to bottom right, there's a downtrend. It's very easy to spot. And look at the degree of slope. Look at the candles. They're all uniform. They're all more or less similar in size. You got to move, pull back. You got to move, pull back. You got to move. The staircase. That is your market structure. Okay? It's very simple. And when you pull back like that, if you pull it back into that prior low and bounce off it, I get perfect market structure. It's telling you got to jump in on this, and it works out very, very easily, right? So, and again, if you look at the ones with slope versus the ones without, right? How many of the ones with slope worked out? How many didn't? It's pretty obvious. Now, let's go to another extreme because I'm running out of time here, and I want to show you the other tools that come with this. But if there's any of you here from overseas that aren't necessarily trading on New York, for example, you can use this on any exchange, whether it's the TSX in Toronto or wherever, the Hang Seng in Hong Kong, for example. Okay. Same rules apply. Okay. The Nifty in India. Okay. It's any time frame. Okay. The Nifty's been beautiful to trade lately. My goodness, the trades on the Nifty have been outstanding. So here, are you going to take this trade? The quick answer is no, because slope is going in the opposite direction, right? Now, if it were to move back above, come back, touch the 20 and bounce, yeah, we could look at it. If it breaks this high, yeah, we could look at it. But what we're really looking for here is for this to turn around, close back below the 20 and give you a red dot or a red arrow in the direction of that slope. And then that's where you go, okay? But be patient and wait for them. Look at this one. How clear was that, right? No-brainer trades. So any time frame, any market, whether it's Forex, futures, crypto, equities, whether you're trading it with options, it doesn't matter. Whatever you can chart. Okay. Let me quickly show you the couple of tools that come with this, and then I'll answer some questions if we still have time. So if you go to the top left of your Metastock platform, click on View and click on Expert Commentary, you get this box. It tells you a bit about trading wins and a bit about myself and the indicator. But what this will do is you'll see this little triangle here on the most recent candle. It always defaults to the most recent candle. So if there was no trade here, you would not see any green text here. There'd be a blank space. But because it's telling you that there's a new signal here, and because it's a green signal, it's going to paint the text green and tell you what it's looking at. If it was red, one of these, and you can switch here by clicking above any of these candles or using these arrows in the top left of the expert commentary box to move that little triangle to wherever you want so you can see what it was telling you at that time. Okay. So let's go here if we can. Let me click there. There you go. So the system is currently signaling a long opportunity. There's that little triangle, right? Now let's move forward one candle, okay? There it is. Now what it does is it gives you a stop loss area, okay? A potential stop. So that if you have to set up your orders, go to work, and you can't be in front of your screen, you can have a stop set there. If it moves to the next candle, it's going to move that stop up. In other words, it's got a trailing stop function where it gives you the exact level where you can just change that order and follow it along. And then when you exit, it'll tell you in this case, because sometimes you can get an exit flag or it goes straight to a red arrow, which is for a short opportunity. But again, since there's no slope, we wouldn't go short. We just treat that as an exit. But this kind of holds your hand throughout the whole process. It's super helpful. The other thing that's really helpful is if you go to top left and click on the P, the power console here, go to the third tab down, the Explorer, okay? Now, up in this top section is where all the add-ons are. And for mine, since they're in alphabetical order, you have to go near the bottom where all the Vora ones are. Here's Veracity and here's the Victory. Now, what Jeff and his team did, what was it, last year or the year before maybe, is added a filter. So if you run this scan, Vora Victory, it's going to run a scan for any arrow and any dot. But the ones that say filtered are the ones that are filtered for slope. It's only going to give you a list of the ones with slope. And all you have to do to save yourself time here is right-click on these and click Add to Favorites. That'll put them in this tab here. So this is what I use, the Vora Victory Filtered and the Vora Victory Reentry Filtered. So the top one are the arrows, the bottom one are the dots. That's it. And then I come down here and I select what I want to trade with. Now, I usually do all optionable stocks, which is like 5,300. And it does in a few minutes. But for purposes here, I'm going to select the 30 stocks in the Dow and the stocks in the NASDAQ 100. Okay. Then I'm going to go to my right and select the time frame. Again, if you're a 5-minute trader, 1 minute, you can select more an investor, monthly, weekly. I'm more of a swing trader. I'm going to look at daily here. And oops, I got to mark these boxes. So let's search for filter and reentry here. And this box confirms what it is you're searching for. Then click Start Exploration, and you're going to get this pop-up. And you'll see how many charts you selected, how it's quickly scanning them, and it's done. Now, on the arrows, we didn't actually find any in that small group. Let's hope, we didn't find any here either. That's very rare. But anyway, what you would get here are columns where it'll show you how many longs, how many shorts. You can click on them, click Open Chart here, open it immediately. I'm going to show you one that we shared with our team last night. UI here, Ubiquity. All right, open it. And there it was. So here's the setup that we shared last night. Let me just zoom in a little so you can see clearly, right? Here, now see how if I zoom in, it kind of stretches things out. So you want to avoid doing that as much as possible. But look at this setup. Look at the slope, right? We're clearly trending from top left of the chart to bottom right, clearly in a downtrend, no question, right? We have significant slope. There's our setup. We mark our low, and first thing this morning, we trip it, and we're in. And now we just follow the color. So we're in this until we see a green candle. Then we're out of the full position, okay? Along the way, if it's a nice runner like this, we look for prior targets, and we start to scale out. Again, we'll teach you how to do that. So, Jeff, I'm going to pass it back to Jeff. He's going to tell you exactly how to get this and what comes with it. But I am going to stick around for questions. One I'll answer quickly. Michael's saying, can it work on soft commodities, cocoa, cattle, anything you can chart? Honestly, it works the same. All I ask you to confirm is that the underlying that you are trading, whether it's soft commodities, equities, crypto, whatever, is liquid, has volume, is traded heavily, but it works exactly the same. So, Jeff, I'm going to pass it back to you, but let me know if there's any questions I can answer.
All right, absolutely. Thank you, Vince. I appreciate it. Very good. Let me go ahead and do this real quick. I actually do want to talk a little bit, and there's just a question or two that I'm going to grab real quick from YouTube. Sure. Nothing too serious. Nothing I can't handle. Let me do this. Thank you very much, Vince. I appreciate it. Mm-hmm. Okay. Should be able to see a screen coming through. Yep. Go ahead and do this. And this as well. So one of the questions that we had was a little bit earlier from YouTube, and I'm actually, I think it was Lewis that maybe asked, oh, no, it was Paquet. what he was actually talking about is he wanted to talk me to just kind of highlight the color codes and exactly what they mean. So the only color codes that we actually do in the expert advisor is, or on the chart, I should say, is right here. You'll see it's either green if it's in a long position or red if it's in a short position. So right now, if it's green, it indicates that the victory is kind of bullish or in a bullish position. Now, you may not have taken this signal on S&P just because the SOAP hasn't started to pick up yet. It doesn't factor that into that. It just means that currently the victory is bullish, okay? If it's not colored green or red, if it's gray or a different color, Paul, all it means is it's not bullish or bearish. It's in a neutral state, okay? So that's all. That's all it is. So there you go. I know there's a lot of questions that we may or may not be able to answer because we kind of just we have several hundred people here. Thank you for coming. If there are questions that we didn't get to, I apologize. If there are charts we didn't get a chance to look at, I apologize. If you go to metastock.com/sales-chat, we can answer any question you've got. And we've tried to hit the biggest ones and that kind of stuff, but we're just going to miss some. So my apologies if we just didn't get to the question that you had. In terms of the Vora victory system, Vince does a really good job of talking about scanning and how to scan and identify those signals. One of the things another question that we got was, how do you know what the slope is, or what is the look back in the slope? And one of the things that we added to kind of the current version of the victory is kind of a slope number. So if I come into the commentary here, this is a commentary window for this. I'm going to kind of dock it off over to the side real quick here. And I'm just going to go back just a couple of days. So right here, okay? So a couple of days ago, we generated a long signal on victory, okay? And it's actually going to tell you right now, based on our slope calculations, we actually have a negative 0.64 number. So the Vora slope is designed to measure the slope of the 20-period simple moving average. Positive numbers indicate a positive trend and negative numbers indicate a negative trend. As a rule of thumb, you should look for a value that's greater than 5 for longs and less than 5 for short. So one of the things that we talk a lot about, or that Vince talks a lot about, is slope. And one of the things I love about kind of the way that we've kind of looked at this is it's very objective. It's not subjective. Is it going up or down right here? Well, according to their calculations, it's going down just a little bit, and it's not ready to take a long trade. So the other thing that's kind of cool about this is it gets really, really specific in terms of the strategies that you can implement. So if you're interested in taking advantage of the long opportunity, you could look to buy the stock. If you're an options trader, you can look at an intermediate term call option 2 to 3 months before expirations. These signals can last anywhere between a few days to 4 to 6 weeks. If you're aggressive, you could look 2 to 3 strikes out of the money with this type of a delta. It tells you how to put in a stop position and what you'd be looking for. So in this case, you'd hold the position until it identifies an exit or 2 weeks before expiration. So it gets very, very, very specific. So Carl, in terms of the spreads that would be used and that kind of stuff, here is some suggestions about what you could do. I know that actually we just did a bit of a market session with Vincent where he talks about different strategies that you could use. And if you want to get in touch with us at metastock.com/sales-chat, we could send you a copy of that video too. So there you go. Let me kind of go ahead and talk about let's go ahead and kind of just talk about the victory add-on. There's the box art for it. So in 2020, when we released it, was the best-selling Metastock add-on. I love the fact that Vince puts a lot of thought into the commentary that he does. He does expert alerts. You get the full market scanning for triggers. You get re-entries. You've got scanning, everything that you want. You even have the ability to do a system test. And as part of it, one of the things that Vince is going to include is access to his pro membership. So the pro membership is what he was talking about a little bit earlier, where you get daily emails. These emails come out every day from Sunday to Thursday. They include a market summary. They include articles and trade ideas, if there are any, on the daily and weekly timeframes. I've been getting the trade ideas for about a month or so now, and they're great. You get a recap email every Sunday. You get Zoom calls Monday, Wednesday, Friday. And that's all included with your victory purchase. So, or a year of it is included with your victory purchase. So the normal cost on Vince Vora's Victory Method is $19.97. Here at the conference, it's going to be $9.97. That'll include a boot camp class that Vince and I sat down. It's about 3 hours of training. It includes training on how to use the Vince Vora's Victory system. We offer it with a 30-day money-back guarantee, so you can try it, see how you like it. If you don't like it, you can get a full refund. We're going to include 12 months of that Vince's Tradewinds Pro membership service. That's normally $97 a month by itself. So if you want to take advantage of that, you can give us a call at 800-882-3040. You can go to metastock.com/conf-promo, and you can also get in touch with us at metastock.com/sales-chat. So Vince, I want to say thank you very much for kind of presenting and kind of being here with us today. I really appreciate it. I always wish we had a little bit more time than we do. I always run a little bit behind as well. So of course, we're Metastock. We're going to offer an extended trial where if you buy a month, you can get the second and third month for free. You can find out why it's been rated #1 in its price category for 30 years in a row. And you can find out about that at metastock.com/conf-promo, metastock.com/sales chat, or 800-882-3040. Marius, give us an email for that one or a phone call, metastock.com/sales chat, 800-882-3040, or Metastock. Actually, just get in touch with us, and we can help you with that. So, and I'll type those phone numbers in just a second. All right. While we're talking today, I do want to really quickly say thanks to AAII.com for sponsoring today's event. AAII has been a kind of a sponsor of the Metastock events for, I think it's been, May, and this is the second conference that they sponsored. They're a great organization. We're very happy to be partnered up with them, and we appreciate kind of the work that they do. They do a lot of classes, they do lessons, they do watch lists, they do newsletters. You can find out more about them at AAII.com. So, and then our next presenter today is Oscar Carboni. Oscar is great. Oscar always comes in. He's always looking at current charts. He always wants to kind of give a really good opinion on the market, and he does a super good job. We love having him, and he's up next. So Oscar, let's go ahead and see if your mic works.
Can you hear me, sir?
I can now, yeah.
Hi, you want me to share my webcam?
Yep, you can do that. And then I'm gonna actually change the presenter over to you as well so that we can see your screen. Now we're running just a minute behind. And so I'm just gonna make sure everything's working and get out of the way. I'm trying to figure out why this share is like in the lay down position. I can't see your webcam yet.
You cannot? That's interesting. It's on.
I can see a black screen where your webcam should be.
It's interesting. What do we do about that?
Let's see, if you, in the dashboard, if you click on webcam, it might give you some options.
All right. Stop cam. Let's see. Webcam, stop, hide all, always in front. Okay, good.
If you go to preferences, maybe.
Preferences.
At the very bottom, it should give you any options. And I know you broadcast in live with Oscar.com all the time. So it might be that your webcam is currently in use.
Well,
different?
We can make sure, let's shut a few things down just to be sure. And then go from there. Turn this off and turn it back on. And that's really odd because I made sure that this was ready to go.
Once in a while. I mean, you gotta have some technical issues once in a while, right? It just keeps I still can't see you.
Oh, that's crazy. All right, let's try one more little thing here.
We can see your screen though.
So I did a nice fresh reboot. All right. And I made sure they even reset the internet for us, so we should be ready to go. All right, and let's see what we get now.
There you are. Boom. I was going to ask you if you had your lights on or something. No, it's stupid, but yeah, you're here. I can see you. I can see the SPX daily chart, and I'm out of the way. Your turn. Go.
I'm just going to move this out of my way, make sure I've got everything ready for you, and we'll go from there. All right, so we should be good. So am I presenting right now, Jeff? Am I live? Ready to go?
It's your turn. Go. Yeah.
Good morning, good afternoon, good evening, traders from across the globe. Thank you for participating in Metastock's extravaganza today. I'm sure that you will see some fantastic teachers today. You will learn about great programs, and Metastock, I cannot applaud them enough. I've been using Metastock since I'm 18 years old in this business. I'm not even going to tell you the year because it was like 97 years ago, but I've been using Metastock for my entire career, and I can say I've used many other types of software. This is my go-to software. It does very, very well for me and my Omniacs around the world. So thank you guys at Metastock for allowing us to have this. Next thing I will tell you is, trading's risky. Did you know that? Very. Make sure if you trade, you put your stops in, put protective stops in before you begin trading. In fact, if you're going to put on a position, I don't care what the stock commodity, you name it is, put the stop in first, then put the trade on. You will live to fight a lot longer life of trading if you do it that way. Now that I've said that, let me explain what's going to happen today. You are looking at a chart, which is the exact same chart that you would have seen if you've seen the last two Metastock webinars in a row. So we could go back to a Metastock webinar about 6 weeks ago, and we could go back about 9 weeks before that. And these very same charts have been used in all of these webinars. And I leave everything on the charts because we look at them together. And what I try to do is show you, or at least offer to you, what I find are tips, tricks, and techniques that you can use trading going forward from this webinar and forward. So these charts are based on, as I mentioned, everything that we've been looking at. And what I like to do is just continue to update these charts so that you can see the analysis that we looked at in our last webinar, what we thought should happen based on that analysis. Did it happen? What can you glean from this to help you trade moving forward? Now, I've done hundreds and hundreds of webinars, seminars, and at all of them, I basically show you everything I can show you. And I don't even mention the Omni. I don't mention it. I don't tell you what the Omni is. I don't say if you follow Omni trades, this could happen. I just don't advertise for myself. One of my Omniacs, that would be somebody who's come out to my 5-day course here in Vegas. I hold seminars, but for 3 or 4 people, very, very small. But I hold seminars. One of my students said, Oscar, you are not allowed to do another webinar unless you explain to people what the Omni is and what it does and where they can find it. And I said, well, Neil, it's not really my style. I mean, I like to teach. I don't really like to, if you want to sell to them, if you want to show them where to find me, I will allow you. So Neil put together this wonderful PowerPoint, and he was going to show you his PowerPoint this morning for about 5 minutes before I presented the charts. And he put together a beautiful PowerPoint, which I approved, and then called me up to say, Neil, I'm so sorry for you. I hope you feel better. I hope this all works out for you. God bless you. But he called up with a very serious problem in his family, and he could not present for me this morning. He was just going to do 5 minutes. So I said, you know what, Neil, send me what you did, and I will show them for you. So I'm actually going to show you a little bit about what the Omni means, and then we'll get into these charts, and you'll be able to figure out, I'll show you what the tips, tricks, and techniques are. So Neil, this is for you, buddy. Not my style to do this, but let's see what Neil's got for us. I think it's kind of cool. Let's see what we get. All right, so Neil put together, I won't say his last name because he doesn't have it on here, so obviously he didn't want us to do that. And here's what he's got. Oscar, explain to them what the Omni is, because you say Omni all the time. You don't tell anybody what it means. All right, let's do it. So this is his presentation. I will do it in his stead. What is the Omni? How does it work? From Neil, who's a graduated Omniac of my course. And I'm just going to show you his PowerPoint and read what he wrote. I don't even know what it is, to be honest. I've glanced at it. In any trading session, there is more action than the open and close prices. There is money to be made between the high and the low, and that is absolute. Because yes, you can look at a daily bar, and it's got an open and close, a high and a low, but you're supposed to try to make money in between these highs and lows, right? I know that's what Omni does for us, at least it tries. Will the upcoming session go up and then down, or down and then back up? Will it go straight up, or will it go straight down, or sideways? How do we know? It's not easy, right? Well, the Omni will give you a bullish, bearish, or neutral signal, and it will tell the trader whether to enter short or long, and where to enter and exit that trade with your stops included. Good deal. This is good. Thank you. Let's go to the next brand. Omni. Omni stands for, OMNI stands for Oscar's Market Navigational Indicator. That Omni, which I've created, it's my baby, I've had it since the 80s, projects the direction of an instrument for the upcoming session. It recommends the stop, the entry, and the exit prices. It uses market indicators and technical analysis, and it works on any instrument in any time frame. Now, this is the stuff that Neil has discovered since he's left my OmniCam. I'm reading you his webinar. I'm liking it so far, his presentation. All right, so he's showing you my Omni page next. So what's on this page? If you join my website, which is absolutely free, you can come to the Omni page. The Omni's got two main parts. On the left side tells you what I'm thinking of doing for the day. Am I a buyer of dips? Is the Omni a buyer of dips? It's not my opinion. Is the Omni a buyer of dips, seller of rallies? And it'll tell you what I'm thinking for the day, what time it is. So let's read what Neil said. The two main parts show the daily Omni with the current information and trade recommendations, which is true right here. The second side of it is Oscar's chat room, where dozens of Omniacs hang out throughout the market session. The chat room is where you can talk with me, Oscar, and get the latest information straight from my lips. Now, he's absolutely right. I hang out in a live trading room every day of my life. It's a chat room. I am always there to help you and give you information. If you need it, please come to the site, click on it, and join me. No credit cards required. So there's two things here. There's Oscar's chat room, or there's the daily Omni. And I think Neil's probably going to get more into that in the next frame. Okay. So if you're looking at this page, which is the daily Omni page, if you join my site, you'll see what I want to do. If you scroll down on that page, you'll also see the chart that I'm looking at, you know, depicting some of the analysis I want to show you for that day, what my trades are based on. So on the daily Omni page, you can see the current chart analysis to accompany the nightly video. You can also view any Omni trade recommendations that I've ever posted in my entire Omni career, at least for the past 15 years on this site. Pick any trade below and see the trades from that date. So Neil picked on the 29th, one of his experiences for trading with me that day. He took the 29th and is going to break down the trade of the 29th. Following is a review of the Omni trade in the E-mini S&P 500, that's the market we trade, for September 29th. So remember, on the left side, it tells you what I want to do, and on the right side, you're going to find flash updates will come out, which is my instruction. So 9/29/23 is the date. Again, I didn't put this together, but I'm enjoying reading it to you. It's pretty cool. The first flash update, let me go back. On this side, the flash updates will come out. There's a time, it tells you what time, what day. So the first flash update that came out at 5:44 p.m. before the market even opened at 6 p.m. First flash update, 17:44, right, 24-hour clock, military time, 5:44 p.m. I actually send the video. New video, the Omni offers buy signals, blah, blah, blah. If you click on that, you'll see the video. Now, clock note he's got at the bottom, Omni standard time is Eastern time. So any times you see are all Eastern time. All right, so the first flash update that went out, it rings, ding, 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 you see my video. I send out another flash update on the 29th, and here's what it says. Second flash update coming in at 8:38 p.m. or 20:38. And it says, the Omni says you can buy long E-mini S&P as it nears the 43.27.24 area. Close is okay. So if it gets near 27, just get in. The last price is 43.34. It's going to drop for us to get sold. Place your protective sell stops at least below 42.95 at the onset of this trade. We will trail our stops higher as soon as market activity allows us to. Boom, you get that signal. You're supposed to put the orders in. You're buying at 27 or close to it if you can. So you've got your flash update. The third flash update that comes out says, now this is at 1:19 a.m. in the morning, because we trade 24 hours a day. Omniacs are long, E-mini S&P, so it did work. They're 43.27 and a half. Your profit of last trade is 43.39. So we got in at 27.5. It's trading at 43.39. Omni target is 43.50, then 57, then 72 to 74. 3 targets for the day. Be sure to react at these levels so you receive the second flash. You're trading with me during the day. You got in at the low so far. You did a good job. Okay, 4th flash update. The Omni is now trading at 43.46.5. The first target is 43.50. We bought at this star. The first target is here. It rallied all the way up so far, got close to our first target, and I send out another flash update. If you were planning to take profits at target number 1, which is 43.50, take those profits as we approach that target, just get out, then cancel your stops. If you plan on staying in for higher profit objectives, move your stops to just a tad below break even. So now we've moved stops to break even. We can't lose. We're nearing the profit objective. You either take it or at least you're at a break even spot. We're riding a trade. That Neil pointed out for us. The 5th flash update comes out at 3:22. This is AM, by the way. We're trading all night. The Omni target of 43.50 has been hit. If you took profits, be sure you canceled the stops. If you stayed in for targets 2 and 3, be sure that your stops are still sitting a tad below break even, making sure that you do not lose. Another flash update comes out. The 6th flash update says, bingo again. Target number 2 of 43.57 has been hit. Be sure to take your profits on all long positions. Oh, I remember this trade now. Watch this. Except a runner, which is 1 or 2 lots. I remember this trade. Move protective sell stops down up to 43.49. So what we've done was we got in here. If you didn't take your profits here and it got above here, you moved your stop. So we've already moved our stop to the first profit objective. We got in here. If you didn't get out here, you moved your stop and you're still riding the profit. I remember this trade. I'll tell you all about it in a moment. Now I know where Neil's going. 7th flash update. ES just hit 43.67.5. If you remember, our profit is 43.72, but we got in at 43.27.5. It's all the way at 43.67.5. And I say, I'm taking all my profits at market and canceling my stops. That's enough money to be made in one day, and I get everybody out. This is where it gets interesting. Knowing where and when to take profits is key to a winning trade. I sent them flash updates and said, you got 3 profit objectives. Get your butts out before we get to that last one. And look what happens. After it hit 43, where we got in at 43.27.5, it rallied up to our profit objectives. And look what happened next. This is a 30-minute chart. We got out right here at this star. It literally went 3 points higher, turned around and spent the whole day dropping. If you did not know when to take your profits, you would have been annihilated on that trade. So the Omni will tell you where to take profits. The key in this lesson, I see what Neil was trying to show you now. The key in this lesson is to take your profits. You have to know where profits are, when to take them, and you've got to react when you get there. Because imagine being in such a good winning trade and letting it turn into a disaster on you. So if you did not take your profits, right here it says after we exited the ES, it topped out at 43.71 before the market even opened. Traders took profits at Omni levels and were out of the trade before it dumped to 43.11. Hey, Neil, very good, sir. You did a good job on that. I like it. So what's the summary? The session closed down 16.6 points on the day. Look at what happened. We got in, it rallied up, we got out, it dumped. We were out of the trade already. The range was 60.5 points. Following the Omni, we profited 42 out of 61 of those points on a down day. Paid for a year of this platinum subscriptions. Very good, Neil. Thank you for this. Now, me personally, I won't put something like this together because it's not my job. My job is to show you charts. But I thank you very much for this, Neil. Maybe now people will understand what the Omni does. So that is the Omni. Thank you, Neil. Oscar's market navigational indicator. And now if anyone was interested in what it is, you can easily come to my site, livewithoscar.com, and sign up for it. We'll talk about that if you want to show up. Thank you, Neil. Thank you for watching that. Now let's go to work. All right. So you're looking at the E-mini S&P Daily Bar. You guys have seen this chart in each one of my seminars prior or webinars prior to this one. Simple. You see the red trend line here, the top and bottom. That basically indicates we're in a bear market. Simple, right? If it's If it rallies up and drops and makes a new low and then a lower high and a lower low and a lower high and a lower low, you are in a bear market confirmed. Conversely, if you're in a bull market, you do the opposite, right? Simple chart. It will rally up, make a low, rally even higher, make a higher low. So that's the premise of this chart. What else is on this chart? This is what I found interesting when I looked at this chart. Now, here's what I want to tell you. All of these charts, this webinar I put together for you like Tuesday, Wednesday last week. I didn't know Thursday and Friday were going to be such big bars. It went crazy. In the last couple of days, bars are going to probably alter this webinar. So we're going to update these charts live together as it happens and see what the heck happened. So I'm going to show you the analysis on here, show you what should happen going forward. We'll update the charts to today, see where we're at, and we'll see if we can have some fun with this. So anyway, you're in a bull market. Here's what I noticed. Very, very interesting about this chart. Jumped right out of me. First off, let's look at this right here. Let's make this a little darker. We have a little bit of a, little trend channel I built here. And there's a reason for this. You'll like this. So you got the trend channel on the top, and the bottom line is right here. So we're going to darken them in and get this. Last time we were in this bull run, and it started to look a little scary and look a little bearish like it did last week. We rallied up, came down into this sort of, I would call it a parallel channel. Dropped below the 200 ball moving average right here. Drops below the 200 ball moving average, right? Well, get this. What does it do when it gets below the 200 ball moving average? It drops for 6 days. Look. It drops for 6 days. It's below the 200 ball moving average, gets back above it, gets above the channel, puts in a bull flag, explodes. Makes a channel moving down, gets below the 200 ball moving average. Right? That's right there. Drops for 6 days below that average, turns around, goes back into the channel, makes a bull flag. Let's go to top day, kids. Check this out. This is insanity. Look at how well analysis works. Here you are. We've got some sort of a kind of a parallel channel moving down, right? The same sort of action. You get below the 200 ball moving average right here. 1, 2, 3, 4. You're down below for 5 days. Now we're going to add in what's happened since today's date. We should be looking at what 11, 6 will work. 6. And we'll do the same here. Now watch this. We add the days back in. And look what it did. It did exactly what it did over here. I mean, exactly. It spent 6 days. Let me show you this. It made me excited. It spent 6 days under the 200 ball moving average, went back above the average, got above the channel, and started to build a bull flag. Well, look, 1, 2, 3, 4, 5, 6. It spent 6 days below the 200 ball moving average, got back above the channel. That is exactly what happened over here. Exactly what happened. What you should see next is a bull flag in some way populate over here. I mean, if we're going to repeat patterns, you should get some sort of a bull flag populate up here now. What I found really interesting was that you did 6 days through the 200 ball moving average, 6, and then exploded above it. That is insanity. Then it did it again right here. Got above the channel, and now it's going to probably make a flag. So that's the first thing I noticed, and I said, well, let me point that out to the Omniacs. That's pretty cool. All right, what that is, it is. Let's go to the next chart. So keep that in mind, okay? It's acting exactly the way it did when we got down here and then exploded and made this whole piece. That's what you have happening here. Let's go to the next chart that was in our webinar together. This is exactly the same charts in the last webinar. I remember it. We used NASDAQ. Watch this. Now, you're going to find notes on these charts because we've been using this for so long. There are notes that go way back. Once the notes are old, I strike them out. See, they have strikeouts in them. So this says the NASDAQ daily bar. The older note was NASDAQ is in a strong bullish channel. Use the 18 bar moving average. Well, that changed. A new tip became use the 21 bar moving average, the orange one. Well, that was a webinar ago. Now we're in a new webinar. What happens next? So what happens next is I am telling you it is time. Here's your tip.
use the 150 bar moving average or algorithm, if you will, to time NASDAQ. Why? Let's look at it. Look at how well it has worked here, here, here. And if you get back down to it, you should use it. So that was my information I wanted to share with you, Omniacs. Make sure you're using the 150. Now watch what happens. Don't forget, I haven't updated it for last week. I did this webinar before the week happened, or in the middle of the week. So we're going to re-update this now and watch how insane this stuff works. Watch this. Boom. Not only did it get back above the 150, but it put the 21 moving average back in vogue. So now you can still, here's your tip, you can still use the 21 bar moving average. I'll show it to you in just a moment. Let me just take the strike away from this. And it's no longer in strikeout mode. Wall Street is now keying off the 21 bar moving average. That is this orange average right here. So we're going to get rid of this little cross here because it doesn't exist anymore. I was going to tell you not to use it, but look what happened since I did the webinar. Now we are back to using the 21 bar moving average to time. So if you want a tip, trick, or technique in NASDAQ, a simple 21 bar moving average has been really good to tell you buy or sell. Gets above, be long, gets below, be short. So that's the trick or tip I want to give you for NASDAQ. And you use the 150 bar moving average as your buffer, because it seems to work on all the big moves. But right now, short-term trading, you're looking at a 21 bar algorithm. 21 bar simple moving average is what you should be following to time your NASDAQ. I hope that helps. Let's move to another chart. Let's do it this one. Oh, the transportation average. What's the tip on here? Is what I want to make sure everyone was aware of, the new tip. Holding support down here, because if you look, we had support, tested it again, and this is, I've been using this chart in my videos all week long, letting people know there's support. So support test, rally, support test, rally, support test. That's where we're at now. So let's update this chart, because what I had said was holding these support channels calls for a rally up to the top of the blue channel. So if we hold the support, we're going to get here. That's my contention, and then higher from there. So now we are once again going to reset the days. Let's just put in what today's date would be. And we'll see what we got. So far, we are heading right to that spot. It has held support. We are heading right to the top of the blue channel. That's what you should be expecting from the Dow Jones Transportation Average in the next few days. It held the support 3 times in a row. That is great support now. Every analyst knows it's in every algorithm. Believe me, this right here, this piece of geometry is in all the algorithms on Wall Street right now. They know it's there. It's bounced 3 times. It's going to be in their trading systems. We are now moving up towards that one. So the advice is good there. It did not change once we updated. It's still the same. We've got more charts to look at. What did we just do? Transportation average, Russell 2000. Oh boy, this chart's full of great stuff. It all started here, kids. I don't know if you remember, but the whole top started in the Russell 2000 back here with this head and shoulders. Way back when the top began and they started raising interest rates, that's what we looked like right here. Left shoulder, head, right shoulder, broke the 200 bar moving average, down into a bear flag, and we're done. Old news, right? This is the old webinar. It's already crossed out. Let's move. Second webinar happened. If it gets above the 200 bar moving average, there's going to be tips. That's old news. Now we're looking at the latest tip. The triple bottom has held in Russell. What's a triple bottom? Right here. You've got a bottom here. The market came back and hit the same spot again, and finally hits the same spot again. That's considered a triple bottom. Well, now that you've had a triple bottom, the market should hold. And the next stop on this train should be the top of this blue channel. That's my advice to you. We should hold here, move to the top of the blue channel. This was put together on Monday, Tuesday, Wednesday of last week. We are now going to see where we're at in that phase. Did it make it there yet? Is it on its way? Look at that. Is this not sick the way analysis works? Look what this went and did. In 2 days after I did this webinar, after I put it together for you, it did exactly what it was supposed to do technically. And it still looks bullish from here, especially if we can close or get above this channel. So analysis lately is just firing on all 12 cylinders. Forget about 8 cylinders. It is firing on all 12 cylinders lately. And if you're good at analysis, you should be killing these markets right now. You should be calling them really, really well. I can help you with that. Trading them is different from calling markets. You can call markets really well, and you can trade them and blow it all up. That's another aspect to what's going on here. What I'm showing you how to do here is to call the markets properly, what tips you can use, tricks. You've got to also be able to trade it properly, and that's where the Omni method comes in. It tells us where to get in and get out. So as humans, we don't screw it all up, one thing at a time. Anyway, the triple bottom should bring us to at least the top of this channel, and that's been done already. Maybe we'll get more out of it. So that is the Russell 2000. Let's see what other charts. We have plenty of charts to look at. Crude oil. Nice. Crude oil, we had stuff to say in the last webinar and the one before that webinar, but this tip actually, the one that's crossed out, in the last webinar said, staying below the 100 bar moving average is key. Use it to decide your market direction. If you get below it, it's great for selling. If you get above it, it's great for buying. We also said in last webinar that staying below 93.50, which is this spot right here, is key. Well, the market ran up from that last webinar, got to 93.50, stayed below, and broke. So this note no longer it shouldn't have a strikeout. This is an actual still valid note. So this note remains valid. Staying below 93.50 is key. And we also have this note, which I am now going to show you why I'm unstriking this too. We are going to continue to use the 100 bar moving average to time crude oil. And here's why. If you look at how well it worked, this is your 100 bar moving average right here, right? It has worked better than anything. I don't think anything works as good as I've seen lately on crude. I mean, it's just amazing. And now we're here. This is us right now, top day. And I was going to say, I don't think the 100 matters anymore, but then when we update the chart, you'll see it does. So we have a new tip. 75 is your target. The 100 moving average remains valid. I didn't expect I was going to be telling you that today, but watch when I update the chart. So we are dropping to 75. That's where crude should go next. And the 100 bar moving average, or algorithm, if you will be your trigger. And let me update this chart, and we'll see what it's doing at the moment. So it is working still. It holds very well. The 100 bar moving average on crude is absolutely your ticket. Use it if you're a crude trader. It is a great tip. It is a great technique. It has worked for this entire downmove. Probably one of the best tips in this webinar. Make sure that you're looking at the 100 bar moving average if you're a crude trader. Let's see what else we have. What do I want to show? All right, let's look at the bunch. Oh my goodness. There's so much on here. Now, bonds, the 150 bar moving average has literally been Wall Street's darling on bonds for years. They just love it, love it, love it. The 150, the black average, they absolutely love this thing on Wall Street when it comes to trading bonds. It's been that way for years. Who cares why? I like to put a wheel on the car and make it drive really fast. I don't need to reinvent wheels. I don't need to know why the 150 works. I like to know that it does. So the 150 bar moving average in bonds was in vogue for quite some time, but now this is old news. What we had was, we had some notes. It must hold right here. It must hold this area. So it must, if it holds this area and breaks, so we're going to get rid of a lot of these notes now. I think that we don't need this stuff in our way anymore. Let's cut that out of the way. This whole must hold thing doesn't matter. Those arrows don't matter. We are getting down to just the science behind these averages, because they seem to matter more than anything in bonds. So we'll get rid of anything else that looks like it's in our way. We don't need to see it. We don't care. What we want to see is what is going on with these averages right now. Here's what I will tell you. When rates go up, T-bonds go down. Rates go down, T-bonds go up. They're an exact opposite relationship with one another. If interest rates go up, T-bonds go down, futures. If T-bond futures are going up, interest rates are going down. So you need to know that. Then there's this. The 150 was a great average for quite some time in bonds. I've got a new one for you. It works even better. The 31 bar moving average. Watch. See it? It's right here. I'm going to blow it up for you. Let's make it darker and blow it up. It's amazingly accurate. So now, let's just do that again. I want it to be a little thicker. Look at this blue average and its amazing accuracy lately in bonds. I mean, it picked up right about here and just, actually it worked from here over, but right here it picks up and just becomes the thing that stops bonds from going higher every time, right? So I say that you should start using the 31 bar moving average to time your 30-year bonds. And we will update the bond chart now as well and see where we're at. It worked as it should have, right through the average. It told you that you should get long. It has worked so well. I want you to use the 31 bar moving average to time your bonds. You get back down to it now, you can buy it. If you settle for 2 days under it, you can go short. So that's the tip I want you to use in bonds. I hope that will help you in the future if you are a bond trader. There aren't as many bond traders today as there used to be, but there's still a bunch of us out there, a bunch of you out there. And make sure that you will use that 31 if you use bonds, if you're trading bonds. In fact, go to mark that just so it's before my office for the next one. We'll leave that sitting there so that we can make reference to it next time we pull this chart on our next webinar. What else is out there? The US dollar. So, interesting what happened with the dollar. The US dollar was working on something called the 70 bar moving average, which was like lightning on the dollar. I'm going to make it thicker for you. Check this out. We've morphed into something else, but this 70 bar moving average, and let's just make the other one thinner for now. We're going to flip these back and forth. Let's just see both. This 70 bar moving average capped off the dollar and then just became its darling. You knew when to get long. You knew when to get short. Wall Street just started to love the 70. Well, look back here at how much better it worked. 70 worked better back here, right? If you ask me. This is the green average, works here, works all down here. I think it gets a little ugly, gets a little muddy once we move forward. So I think I'd rather see you start to use something else, the 19 bar moving average. Look at it. And this is what I had planned for you on Tuesday last week. I said, from now on, start using this because look at how much better it's working. And let me grab a little tool and I'll show you what I mean by that. So look at how well the 70's not working anymore, right? The green one's not working. Look at how well the 19 bar moving average is working. It's giving you signals all over the place. So, okay, my tip to you was we're going to now start using the 19 bar moving average. And then I updated. Look at this. Then I did the update. I'm sorry. Here. So I've never done a webinar like this where I'm updating for you, but I just figured I'd give it a whirl. Well, when I was going to tell you to stop using the 70 and start using the 19 bar moving average, that's already old news 3 days ago. Now look, we're back to the 70. See that? Now you can go back to the 70 bar algo or moving average and just use that. So that's my tip on dollars. I thought I was going to tell you to use the 19 bar moving average, but it moved away from it already. And it's playing back at the 70. So 70 has come back in vogue. And personally, me, I would play in between the two averages. I would use the 19 when we're near it. I would use the 70 when we're near it. You get below 70, dollar drops. Watch that 70 bar moving average there, okay? So that's in your dollar. And I'm simply trying to give you things that you can use moving forward. let's go to another chart. And of course, if you've got questions, save them for when we're done. We'll go over the questions together. Euro currency daily bar. The tip on here in the last webinar was to use the 100 bar algorithm, or moving average, because it's been working like a charm. And that is this teal average, and as you can see, it literally works like a charm. I mean, it is just beautiful the way it works. But it just works perfectly. Exactly what it should do, it does. It's a beautiful average. It's your 100 bar moving average on euro. New tip. Forget the 100, the 50 is now working even better. This is crossed out, right? Struck out. The 50 is now in vogue. We are at it right there. It's the 50 ball moving average. I'm going to now make that thicker for you so you can see what it is. This is the one that's become in vogue. So if you had information on using the 100 in euro, it has now gone to the 50. That seems to be the thing that the traders are playing around, and not so much the 100 anymore. But then we do have to update, right? So let's do our update and see where we're at this moment. And that average is working well. That is your average. Use the 50 ball moving average on euro. If you're euro traders, it works really well there. So that would be a tip for euro traders. If you are looking to get involved in the euro and you don't know what to use, a 50 ball moving average is a nice trigger for you these days. Of course, you can come to my site, Live with Oscar, and we can work out an Omni on euro, and it will tell you exactly where it wants to buy and sell. But for your purposes at home, a little bit longer term picture, use your 50 ball moving average to time euro. I think you'll find that it will give you pretty decent signals. And oh, here we go, Mr. Bitcoin. So Bitcoin, as I've been showing you this chart video after video for the last few weeks because Bitcoin's in vogue lately, my tip was Wall Street watches algos, the 50 ball moving average. They watch that in Bitcoin as aptly as they watch it in any stock, in any fund. If Bitcoin stays above the 50 bar MA, it will continue to attract buyers. That was my message when we were here. That was in the last webinar. It got above the 50 bar and did attract buyers, got into a bull flag, and my tip to you remains the same. Bitcoin will be trading 85,000 per Bitcoin within 2.9 years, according to our calculations. 85,000 in 2.9 years, according to our calculations. Now, this has been a 5-year target. We're counting down. We're down to 2 years, 9 months. You will get there. And look at how well it's behaving in this stair-step pattern. And if we update, let's see what's happened since this bull flag has formed. I don't see an update in there. I'd like to see what's happened since. Since the bull flag is formed, you got above it a little, came back down, and maybe we're hovering inside of it. So Bitcoin, long-term, much higher. Short-term, buy pullbacks into the bottom of the flag. I think you'll be fine in Bitcoin. Your major key is the 50 bar algo in Bitcoin. They love it on Wall Street. Whatever. Remember, we don't reinvent wheels here. We put them on our car, drive really fast with them. No need to research and find out why. By the time you find that out, they're on to something else and you're looking at old news. We want to see what they do and work with them immediately. What does Wall Street do? This is what they're looking at. You need to be looking at that as well. What else do we have? NVIDIA. Interesting. NVIDIA has been part of the AI revolution. As you can see with this chart, it's just gone crazy since AI has been released. The old tip on this was to use the 21 bar algorithm or moving average, which is this teal, and it worked really well. Look at all the arrows and the circles worked well. Well, there's a new tip now. We are going to go with something different. Let's make this one thinner. We are now going to go, until they change, with something called the 9 bar algorithm. Let's go change that. That's not what we do. Let me square my average and change its properties. check this out. It's a 9 bar. And this is what they're keying off of lately. They are keying off this 9 bar average, starting here. Boom. Well, actually, it starts about here. They just key off of it, key off of it, key off of it. Wall Street's keying off of it. Wall Street's keying off of it. You need to key off of it too. That is the 9 bar moving average. It will change, but that is what they're keying off of in NVIDIA at the moment. And of course, if we update NVIDIA, watch what happens. Look what it does. It abandons ship on the 9 and goes right back to the 21. So we are now going to take away the strikeout and tell you it is fine, safe, and fair to continue using the 21 bar algo. Look, that's this one right here. So right back to it. It only took a couple of days. It abandoned it for just a couple of days and went right back to it. So we'll make this one a lot lighter, and this is your average that you will be following right now. The 21 bar algorithm. Seems to drop to the 9 bar when it gets under it, but this is no longer in vogue. This one is. Back to your 21 bar for your timing if you are an NVIDIA trader. What other tips can I find for you cats before this thing comes to an end? Hold it down. All right, so the advice here, of course, in the past was the 60 bar moving average, which is now I got strikeouts through it because that was the advice we were using. And in fact, let's talk to them for a moment because you can see how well it used to work. This 60 bar moving average, if you look around these arrows here, 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 I mean, it just was the perfect average to use. Just perfect. And then it fell out of vogue right here at the circle. This is the spot where, for whatever reason, the 60 bar moving average falls out of vogue. What do we switch to? Looks like it switches to the 200 bar moving average, much longer term. So my advice is getting above the 200 bar moving average and getting above this channel will return the market back into a bull run. And let's see what we've done since I built this webinar a few days ago. And look at that. We are now above the channel, above the 200, starting to look at the 60 again, and this should augur for higher levels moving forward. Because we did actually do what the analysis projected we should, which was get above the channel, get above the 200, continue your bull run. So that's what we were expecting. Use your 200 bar moving average now to time the down. It's going to be keying off of that for a little while until we get away from it. And believe me, the street loves that average more than any other on the block. So make sure you're paying attention to it. What else do we have? This is just a daily down, right? A lot of stuff on this chart, but it's not as ugly as you might think. A lot of information on here because remember, we've been using this for a long time now. So it just goes back and it tells you about all the stuff we were looking at back in the day, and then what happens moving forward in next webinar. So yes, there's a lot of info, but it's actually pretty discernible. You're looking at the Dow Jones. Let's just concentrate on where it is today. All right, all this stuff happened in the past, so let's kind of concentrate on today. What's happening right now? So we came out of the inverted head and shoulders, rallied up, put in a normal head and shoulders, right, an upright head and shoulders, 1, 2, 3, and did come down, got below the 200 bar moving average. And here's what I find interesting on this one, is the channel. Let me just see if I can darken this channel in for you. And let's do the top one. So we've got a channel. We dropped under the 200 bar moving average, and we keep hitting the top and almost the bottom and almost top of the channel. Getting above the trend channel and the 200 bar moving average offers a buy and hold signal. If you could get above this spot, I am telling you it is a buy and hold. That is your tip on this chart. Look at the chart. Once again, we are looking at the Dow Jones Daily. And what I'm telling you about the Dow Jones Daily is If you can get above this spot right here, it is a buy and hold. Let's see what happens so far. Oh, let's cancel that and just start that. Let's pull the dates in where they belong. And what do we end up with? We got through the channel. We're above the 200. You are in a holding pattern. I say the market continues higher throughout the rest of this year. Of course, we could break back below this and we might have to reassess what we're looking at right now at this moment in time. That is confirmation of more upside coming. Nothing goes straight up, but we are not looking at the downside. We're looking at the upside moving forward. Let's see what else we have in this little bag of tricks. Oh, we're at the NASDAQ now. Personally, I'm just going to tell you this looks like a bear flag to me. Maybe it doesn't. Maybe it does to you. I have been looking at flags for a long time, kids. That looks like a bull flag to me. Looks like a flag. Maybe it'll act like a flag. Let's see if it's updated. Weekly's a different. Yeah, weekly should already be updated. So it's already updated. I think that's a flag. I don't know. Maybe it's not. I think it is. We're going to have to wait because each one of these bars is a full week's worth of trading. This is a weekly chart. So we have to wait. But if you ask me, this is nothing more than getting ready to continue higher. Now, what normally happens is once you get anywhere near the 200 ball moving average on your weekly NASDAQ, you spend a lot of time going in the other direction. Right? So let's see if it just continues going in the other direction. What else do we have in our bag of tricks? We looked at NASDAQ. The Dow Jones. Man. Dow Jones weekly. We're looking at weekly charts now. In the last webinar, my advice was, this looks like a bull flag to me, this black thing. The tip was a wait for the bull flag to break out. And you can buy dips down to the bottom of the blue channel. Wait for the flag to break out, then we can buy dips. Well, the flag did break out, and look at how buying dips work. And finally, the flag gives up after it makes its projection. We start to head down, and what was very big was the 50 ball moving average. That was the big one right here, the blue guy. Well, the new tip is this. We're going to make an adjustment from the 50 ball moving average to the 170 ball moving average, 170, using the 200 ball moving average as your stopgap. Now, let me show you what that means. We are going to get away from the 50 for now. Let's make it thinner. We're going to pretend it's not there for the moment because our new bias is to buy or trade around 170 bar moving average, which is this orange one. That should be your way of trading down on a weekly using the 200 ball moving average, the green one, as your buffer. You don't want to drop below that for a settlement of a week. That's a problem. You're going to use the orange one as your trigger buy. And then you're going to use the green one if you settle a week below that to get out of that trade for swing traders. So let's look at it. Let's update this. It should be 6 inches. Apply. And what looks to have happened is it is working as of today. This is a weekly chart, so this is today's bar. It has gone back up. So it is, it's actually last week's bar. It is holding that average. The 150 is not valid anymore. The 200, excuse me, the 170 becomes valid with the 200 as your buffer. 170 is orange. Use that to time your weekly Dow for you swing traders out there. It seems to work really well, and you do not break the 200 ball moving average very often in the Dow. So use that as your buffer. 170 is your ticket on the Dow weekly. Dow Jones weekly, the transportation average. Now this one just speaks for itself. In the last presentation, a couple of months back, 8 weeks, 9 weeks, whatever it was, I said, you know what, this is a very healthy market. It's stair-stepping higher. It's a sign of a healthy, wide breadth, or widening out breadth market rally. What's stair-stepping? You run up, you stair-step down a little bit. You step back up, you make another channel moving down a little bit. You stair-step back up. That is a healthy market when you see that. That looks good to me. I like seeing this pattern. That's what you want to see. So it's still stair-stepping higher, my advice in this video. And there is a new tip. Holding above the 200 ball moving average and the channel, all this for prices to move much higher going forward. So we need this to hold right here where it's testing. If it does, you've got a good signal that the market wants to go higher. Let's update this and see what it's done since I built this webinar last week. It has held so far on the weekly and has rallied back up. Now, so far, so good, kids. You are looking at early indications that the market is trying to tell you we are going to have a Santa Claus rally because it spent its time in October moving down to a key level and held that key level. Once it holds a key level, you usually start to see the opposite side, like here. Boom. So we held the key level and we're starting to go up already. Holding that 200 will augur for much higher prices in the future. What else did we have prepared? These are all the same charts we looked at in the last two webinars, guys. Traders, I just want to go over them with you again. So we just did the Dow and we are at the E-mini S&P. E-mini S&P weekly, probably the best of all the charts. As you can see, way back in the day, we had this massive channel rally. Then it started to put in resistance, which failed every time it got to a failure. Right? Let's take a little tool so we can check this out. Failure. Right? Puts that and dumps. Failure. Failure. It's above. That's different. What is that? It's above and then holds. Now that's different. Right? Walk with that's different. We get into a channel, moves higher, moves back down, and here's where things get interesting. The same exact average is working on the ES weekly as you would expect. So tip for fund managers, use the 170 ball moving average to time your E-mini S&P. Let me show you. Look at this. This works really well. This has been working like a charm, this orange average. Look at it. And watch this when we update. We bounced, we hit that average and exploded, kids. It works like a charm. Look how much money was made in between hitting that average and or just getting near the average and moving above it. I don't know why his phone is making so much noise, but I'm just going to move it out of our way so that listen to this so much. I don't know why it's making noise. My dogs are running back and forth in front of my cameras right now. And there's phones ringing. Isn't this a wonderful day? We're going to call that DNB. Stop ringing, please. So it worked really, really well on your E-mini S&P chart. I think you should continue using that 170. It works like a charm, and it will help you in your timing. So the charts that we looked at 3 webinars ago, 2 webinars ago, and this webinar right now are all basically the same. And they are pointing higher right now, even though we had our little October pullback. I hope these charts are helping you. I hope you gleaned a little bit of a couple of tips if you got from this video. That's fantastic. That's what I was hoping for. Jeff, any questions? Is there any way I can help you?
Well, 2 questions real quick for you.
Sure.
DPAM says, hey, Oscar, does your Omni service trade primarily futures or only futures?
No, actually, it works with stocks, ETFs, futures. I like futures better than single stocks, but it works really well on stocks. And just about anything I've applied it on. I know it's crazy. We've even applied this to weather charts and it worked out. So, whatever. It seems to work really well. And it's been working since 1984. It's kind of cool.
Ron wants to know, I'm on the Telegram with Oscar. The alerts, yes, I'm on the Telegram, but I don't see the recommendations. So the question is, do I need to be a paying member to see these?
So the recommendations, I free them up at the end of the day. Let me see if I have the site open, if so I can just kind of give you an overview. But I free them up at the end of each day so the public can see them. But I keep them closed during the day on purpose so that the public can't see them, right? Because if you're in a trade with me and we're getting in at a certain spot, we got stops in, we don't want to show the world what we're doing, not until we get out of the trade. So yes, the service, I'm embarrassed to tell you, is like $4 a day or whatever the number is. I'm embarrassed, but you can have me in your corner for like less than the price of a cup of coffee. I know it's sad, but it is what it is. That's the way the world works today. So yes, you will. There is a pay. It's like $4.60 a day or $200 a month, whatever it is. But once you pay, you would receive what we call the flash updates. Then what happens is anytime we do a trade at all, if we trade, you receive a pop-up window. And in fact, that pop-up window looks like this. It's kind of interesting because it will wake you up and tell you what to do. As well as I send it out on a Discord channel immediately. I don't want to switch right now, so but I also send it out on Discord, and it goes out through your email. So we make sure that you are encompassed, and then it shows up on my site as well. So not only does it go out through that pop-up window that I mentioned, and it's out on Discord, and it's going out through email, but it will populate over here for you as well. So we encompass the traders with these signals. Make sure. Here's why. If you say you missed the signal to me, I know you've lied and you stuck your head in the sand because you were afraid to react. You can't miss these signals. They come at you from every direction.
All right. Last question, and we are, as always, running late, but last question that we have time for. Would you call yourself a day service, a swing trading service, or something else?
So it is a day trader's service, right? It's for people who want to be in the morning and out by the close, and then maybe back in the next day. So it's for a one trade per day. It works for swing trading and longer term trading. I present it for day trading, but in reality, we swing the day. You know what I mean? That's kind of what we call it. We're not jumping in and jumping out by any means. We're getting in at a specific level, waiting for a big run, and getting out. And then we're done.
All right. As always, Oscar, thank you. It's always great to have you.
Thank you.
I'm losing my thing.
Thank you for having me, Jeff. Thank you. I know this was a little bit different than I normally present, but I was asked to change it up, so I did.
I didn't ask you to change it up, but I think it's great either way. We always love having you, Oscar. Thank you for coming.
Thank you.
All right, very good. And we'll have you again soon. Live with Oscar, everybody. Also, I'm going to talk a little bit about a recorded session that we did with Oscar. So let me go ahead and kind of take the presentation here. And as you can tell, when Oscar kind of comes in, he talks a lot about technical formations, trend lines, all that kind of stuff. And we actually sat down with him, and I think this was just a year ago, and we set up a class around how to do trend lines, support and resistance levels, technical formations. And it's 3 hours of instructions. Oscar did a great job. He always does, though. We love having him on if you find him entertaining, if you find him educational, that kind of stuff. You're going to love the master class. We use Metastock the whole time, but Metastock's not required. If you want to sign up for the class, you can. It's available on our website. You can watch it instantly. It's normally $4.99. Is the normal price for it for that 3 hours of instructions. We're going to do a conference special on it where you can pay $349. So you can do that at 800, or you can do that by calling us 800-882-3040. You go to metastock.com/sales-chat, or you can go to metastock.com/conf-promo. And what I will say about this class in particular is I learned a lot. And I've been using trend lines. One of the things I'll talk about a little bit later today is trend lines and how to use them and how to find them and stuff like that. And this is a great class. If you're looking for kind of a fundamentals of technical patterns, this is an easy way to do it. So $349 will be your conference special, 800-882-3040, metastock.com/sales-chat, or metastock.com/conf-promo. So there you go. Daniel says that presentation was a big peek behind the curtain to Omni. So yeah. William, I'm glad you can hear us. Thank you. I'm glad you can hear us now. So great to have you. Neil asked when is Raymond Merriman presenting, and he is, Raymond Rondeau presenting, and he's up right now. So, but first I want to say thank you to AAII AI.com for sponsoring the event. They're a sponsor of ours for a little bit now. They sponsored our May event and now our November one, and we look forward to a long and fruitful relationship with them. I will say the AAII, you can find out more about them at AAII.com. I would say that they have been incorporated as a nonprofit since 1978. They do a lot of market lessons, market forecasts. They have a portfolio tracker type of a thing. And they do a great job. Very, very well respected, well reputed, if that's a word. If not, I just made it up. But AAII.com if you want to find out about that. And our next speaker is actually from AAII. And he is what they call the active trader division, the active investor division of the AAII. And I've known Ray for a number of years. Super nice guy, always does a great job, always easy to understand. And here's a picture of him, but I've known him for so long. I know he's on a tour right now where he just got back from the Money Show. He's done over 160 events over the years, and he's a very, very good designer, very, very good technical system. So Ray, let's go ahead and bring you in here. And let me just go ahead and make you the presenter. I'm going to turn on your audio, and you might have to do that on your side, but let's go ahead and kind of get you started. We are running about 12 minutes late. It's not uncommon. It happens every single time. So what we decided to do though, this time, Ray, was not freak out about it. Every time we got a little bit late. So there you go. Okay, Ray, let's see. I cannot quite hear you yet, but I can see your screen. So that's a good start. I can see you. And I can't quite hear you yet. I'm going to unmute you. And then you also have to hit the unmute button because you're muted by yourself. There you are.
Let's try it again. Now you can hear me, I'm sure.
Yeah, it lights up green as soon as you turn it on. And so then I go, okay, here we go. We got it. So I can hear you. I'm going to get out of the way. I know we're a little bit late. I don't want you kind of freaking out about time. But it's your turn. So you go now.
Right. So Jeff, can you see the correct screen? Because I'm having trouble seeing it on my end, what you're seeing.
Yes, I can see the PowerPoint that has your phone number, your email address, all of your information on it. We can see what.
Not presenter's view, just the regular slide.
Mm-hmm.
All right, here we go.
First try.
Almost like I've done this before, huh?
Right. Yeah. A few times, right? Like 160 plus times?
A few times, yes. So we'll give it a try here. So welcome to today's presentation, the most important trading system factors for today's markets. I would like to thank you for attending, and of course, Jeff for his introduction. And as Jeff mentioned, if my voice starts to go, this is my seventh presentation, 11 days over 4 cities, and all presentation topics were different. So we'll both be surprised what the next slide is. So I'll be checking this out quite a bit. We seem to be having one issue here, of course. This presentation's focus is primarily on the concept of conviction, its application, and its validity. And we're going to try to tie this in with our lead. Our trading strategies with hit ratios of 85% and a profit factor of actually 4-to-1, realistic, and more important, is there evidence to back this up? It's a big challenge, and we'll let you guys be the judge and jury on this. Not sure what's going on here with that. We're going to have to check this out. There are 6 primary areas that we'll be covering today, and we'll start with conviction basics, then move on to 3 new conviction-based indicators. From there, we'll look at the conviction systems, the performance results, and in the last segment, we'll explore 6 methods to improve any trading or investing approach. We're going to cover these areas relatively quickly, and for those that are interested in learning more about conviction and systems, we have in-depth instruction manuals that you can see here and that we supply you. And we also give you weeks of onboarding emails, hints, and tips. As a bonus, you also get a free year of AI membership with the monthly AI journal. And yes, that includes access to all the fundamental scans that are based off the world's greatest investors. More importantly, as you can see here, we have studio-grade full-featured classes built into a professional online learning system for the conviction studies and other investment topics. These are not webinars, okay? They have learning resources and slides and definitions, tools, a chat room, testing, credits, certificates of completion, and complimentary premium products for those who complete a class. And in the end, we actually have a special offer if anybody wants to get involved with this. So what is conviction? There's a lot of confusion on this, and that's where we're going to start right now. In totality, conviction is a series of technical factors that are synergized to more accurately gauge and measure the underlying intensity of trends in individual price moves. Does it include a derivative of dollar volume? Yeah, it does, and that's what the indicators reflect. But the conviction systems include a total of 7 factors, which we're going to touch on today. So what is a factor? It's a characteristic related to an investment that can be associated with having an influence on returns. And to qualify as a factor, it has to be quantifiable and not explained by other measures, things like size or value or volatility or momentum. The conviction systems are comprised of technical factors, as you would expect. So here's an example. Here's an optimization test on one factor of conviction, the amount of dollars transacted in a given time frame. And I'm going to try to turn on my laser pointer here, and here you can see it. And we will cover this in depth in a few slides, but for now, notice how every time we increase the conviction factor, the far right column, the number of trades will decrease, which is logical, becoming more restrictive, but the average profit, the K ratio, and the total return to max drawdown all improve, and a higher number is better. And K ratio is just the consistency of returns. Research like this, along with the conviction scan performance, reaffirms that conviction dollars transacted may be considered an evidence-based factor, and also why it's an important measure than just volume alone, something that we're really going to focus on here. So then we would take this factor in isolation and we synergize it with other technical factors to form an efficient system. Here you can see the profit factor system, back-tested, computer-generated. This is the realized equity curve over the last 10 years. This system returned 81.7% on a 3.73 profit factor in a study on every single stock in the S&P 500 over the last decade. Very consistent returns, even during COVID, it never lost, and it never had more than 2 consecutive losses over 10 years. And I would not expect that to continue, by the way. In this video, you can see example of the research from one of the conviction systems that were compiled with a third-party portfolio backtesting program. Overall, it took about 1,800 lines of code to accurately develop these factors and test this system. Now, that is painful, but this approach has a huge advantage as we have the ability to optimize results. For instance, how many days should I hold a position? And we do this not to identify outliers or artifacts, but to see if we can find the true Gaussian distribution relationship pointing us to better answers. And the bottom line is that you can't do this by hand. And for the record, it should be noted that all the conviction studies that you're going to see focus on analysis on every single stock in the S&P 500 over a 10-year period from 2012 to 2023. All signals were generated end of day, and it was assumed that $5,000 was invested in each signal, and the results are non-compounded. So why do we do this? I have to back up statements. As Grace Hopper once stated, right? One accurate measurement is worth 1,000 expert opinions. At AAI, we require evidence-backed research, and we've been doing it for over 45 years, as Jeff alluded to. I can't just state off the cuff that some things happens 90% of the time, and I know this because I've used it for years. I've been a full-time trader for 24 years now and teaching on trading and investing for almost as long. And I'm also a programmer and system developer for multiple platforms. And I can absolutely tell you there is no comparison between system design, computer backtesting analysis, and my so-called recollection based on my experiences for finding the right answers and for developing the most accurate systems. And this is why we give everyone the results of these studies. My advice is if a system does not have trade-by-trade logs and verifiable back-tested performance results, then quite honestly, I would move on. These reports are extremely detailed. We give you the system parameters, the hit ratios, the projected returns, the popular ratios, transaction entry and exit efficiencies, and drawdowns for yearly consistency. We want to be confident that the trades are verifiable, and we provide every single historical trade so that you can match them in your charts from the history and then also in real time going forward. We want full transparency here, not self-reported performance figures. And lastly, with all three system performance results, we actually had these certified by an independent third-party company called QuantKey, a leader in system design, development, appraisals, and evaluations. Now that would all seem good, right? Kind of and sort of, but unfortunately, because all of the restrictions and limitations that I have to abide by, you're going to see that the reported results are actually going to be negatively skewed. And again, in that final section, I am going to give you some ways to improve all systems performance, including this one. Last slide on this, conviction is not relative strength or momentum, which is a common misconception. You can have an issue that is still limping upward at extreme levels in a euphoric market environment, and that is still exhibiting less conviction than one that is building conviction strength while still going down, but starting to turn after a controlled downtrend in a bearish one. And these are the 7 factors that we kind of measure to see. So we start with relative momentum conviction and how this differs from volume and why it's more effective. If you don't know what volume is, it's simply the number of units, shares of contracts, transacted in a given time period. And we display this amount in the bottom of a chart. And to keep this simple, our charts will always be a day. Here you can see an example of some daily volume bars, and the amount of volume is represented by the height of the bar. And volume bars are normally plotted as a single color, or perhaps 2 colors if red if the price finishes down from the open, and green if price finishes up from the open. So now that we have it displayed, how do we use volume? It's believed and it's logical that price movements on days with heavy relative volume are more important and relevant than price moves on days with lower relative volume. Just think of it like a significant other, a teacher, or your boss. The higher their voice gets, the more serious or the meaning that is behind their tonality, or we should say the level of the volume. As we see here, relative volume for a variety of reasons can happen. We see high volume because of a new revelation about a security, something that's unanticipated. Another reason that we see it is technical events, something very similar to what we see here with this breach of major support in this chart of gold at points J and K. This breach led to an 11% move in gold prices in just 2 days. Technicals have relevancy, if for nothing else, due to the self-fulfilling prophecy of the patents and the computers that are programmed to move money off of them. I would not let anyone tell you anything differently on that one. Now, expanding this theory to volume and trends, we were taught that volume expanding with price moves in the same direction of the trend is supportive of continuation of that current trend, our green arrows. Similarly, lower relative volumes and diminishing normal retracements back towards the trend are also considered to be supportive of that current trend, as price will retract at some point, even in the strongest of trends. And this theory is logical, and it's been around for a long time, but unfortunately our markets have changed dramatically since the tools that plot and analyze volume were first developed. On this slide, we are highlighting several of those reasons, and they are legit. And that's what we're going to look at now. Not necessarily a paradigm shift on the analysis techniques, but adjustments to the way that intensity is measured and displayed. This brings us to the term conviction dollars. To be clear, this is just a term that we are using, and this concept has been around essentially as long as volume has. In fact, in its most basic form, conviction is almost identical to dollar volume, with both values representing the approximate total dollars exchanged over a given time period. Not volume, but total dollars. So how does conviction dollars differ from standard definition of dollar volume? Well, conviction uses the average of the bar's high, low, close, and open price as opposed to the closing price as per the dollar volume definition. In this slide, you can see the differences in the calculations. So we want to use dollar volume. Now I said estimation. Why not use VWAP or volume weighted average price to calculate the exact number of dollars? Because most charting platforms don't offer historical VWAP. And in truth, the difference in the calculations between dollar volume and conviction dollars is irrelevant, but the benefits of using conviction or dollars over volume is not, as we're going to see in these next 3 slides. This is a key slide. Here we have single colored volume bars plotted in the middle pane right here, and conviction dollars with RCM indicator plotted in the lower pane. Now look at point A. Here the amount of selling pressure right here seems to be increasing with the volume bars on this downtrend. And because of this, we could conclude, according to traditional theory that we just covered, that the downtrend intensity is increasing and it's likely to continue. But when looking at the actual dollar value right here in true conviction at point B, we can see that the intensity is actually decreasing from a total of around $100 million per day to $80 million per day from the start of the downtrend. Yes, the volume may be increasing, but that's only because the stock prices during this period are less than half of what they were when the downward trend started. By looking at volume, it creates an intensity illusion. Here's another example with Tesla. Here we can see prices drop from $300 to $100 between the yellow vertical lines. And volume at point A is again displaying the increasing intensity illusion. And at point B, we can see that the selling intensity is measured by conviction dollars, and dollars is what matters, is not increasing, and since we see the upward turn in prices. And this obviously works both ways. When prices rise dramatically, here's a longer term example of this with PBF, where prices went from $5 to $50. RCM line is supporting the continuation of the 18-month upward trend, showing increasing intensity or conviction, whereas volume at line A is skewing that intensity view, displaying a decreasing conviction level or decreasing volume, saying that the trend is unlikely to continue, and that's just not true. Unfortunately, this phenomenon has hurt many investors who attempted to use volume analysis in this manner. It's not because an investor doesn't know the rules, but it's because of the visual volume skew that occurs on large price move, which conviction in general and RCM specifically identifies. Again, it's dollars that matter. Digging in a little deeper, what exactly is RCM, or should you be looking for intensity readings? In this chart of AT&T, we can see RCM's primary signals as dots right here. And RCM places the signals in the commentary reports right in the charts to help you. Green dots show an area of potential bullish turns. The slowing of diminishing prices on less conviction, the true conviction, the selling pressure seems to be losing steam, as we can see in the yellow arrow. The red dots show areas of potential bearish turns, identification of the slowing of increasing prices on less conviction. The true conviction, the buying pressure seems to be losing steam, we can see in the blue arrows. We are looking for multiple RCM signals along with a flattening of price and then a high conviction break, which you see right here and right here as our signals for a potential turn or change in trend. And here again, you can see the RCM signals on a chart of everyone's favorite company to trade, Apple. And you see the signals. It does a nice job. Right here, it's a little late, right on the money. This one's not at a peak, but it front runs this drop off here. Here you can see buy, buy, buy. Again, as a continuation, it picks these up very well. Intensity readings in RCMs can also be used for secondary signals for reinforcing the primary direction of the trend. And you can see these as small pluses or tick marks. On upward price trends, consistent green tick marks are reinforcing of the continuation of the upward price trend. Here you can see a point A right here. You were getting consistent tick marks saying that the trend is likely to continue. But notice over here at points B and C, there were no tick marks, and of course, price rolled over relatively quickly. Now, RCM not only displays if the security finishes up or down, but it also adjusts the intensity of the color to reflect the magnitude of the price moves. So when we see bright green colors highlight large relative upward price moves, and brighter red colors highlight larger relative downward moves. Now, why would we do this? What makes it much easier to identify important price moves like blow-offs, high volume, large upward price moves, and selling climaxes, high volume, large downward price moves, which are correlated with trend changes. It also helps spot churning, another phenomenon. Now, a couple more things on this. It's important to remember that RCM or intensity momentum readings are best used as a short to intermediate term retracement signal generator. And it's always used as a secondary or reinforcing tool. RCM alone is not enough weight to call a major trend reversal signals. Here's an excellent example of this on the Qs, showing RCM identifying shorter term turns at D, E, and F, but only back to the major prevailing trend at lines A, B, and C. Building off of this, with the same chart, kind of on the same theme, one or two signals with an established trend are noteworthy, and price often continues onward, as we will see. But it takes multiple dots for any consideration of a turn against a prevailing or established trend, and you always will need additional technical evidence. This is the last slide on this spot, just to walk you through an example how someone might use intensity analysis for nothing else perspective. And here we can see the commentary report. Let's say an investor is looking to get long Tesla for whatever reason, fundamental based. We can see on May 18th, 2021, the green arrow, prices pulling back to support. By using RCM, we can see that the conviction on this pullback is actually diminishing. Then we wait for the turn up in prices. We have the downward sloping trend line right about here. At that point, by using RCM, an investor would have another level, something else supporting the turn. That's one way that an investor may use that. Our second indicator is called OBC. Now, OBC stands for on-balance conviction, and RCM looks at increasing or decreasing conviction dollars in relationship to trend. But OBC looks at up volume versus down volume, or up conviction versus down conviction, as an aggregate within this for each successive bar. Now, OBC analyzes up versus down intensity, like Granville's OBV or on-balance volume, which I'm sure you heard of. But OBV was created literally 60 years ago in a completely different market environment, in an era when using pencils and papers for calculations. As you would expect, OBC uses conviction dollars, which has the same advantages over volume for large price move skews, but OBC does something else that's very important. It proportions the amount of the intensity to the magnitude of the price change of the bar. And this becomes the most important, or most will say complex part of this presentation. Here you can see an example of the calculation differences, and you can see how OBC proportions the intensity to the size of the move, and OBV in the bottom does not. The key point here is that with OBV, the stock could literally drop 0.1% or 50%, and OBV will subtract the same amount of volume in both circumstances. From another perspective, if a stock finishes up a penny, it would add all the volume as positive, and if it finishes 2 cents lower from there, it would then subtract all the volume as negative. It totally disregards the magnitude of the move. It's all or nothing, and this is probably not the best way to approach this. Now, that table showed an extremely simplified example to illustrate the Bayes calculation concept. For OBC's methods to compile these results are complex. I'm going to give it to you in a sentence, and we're going to move on. What OBC does is it proportions a percentage of the dollar volume up to a certain ATR threshold, and then it takes a linear one-to-one measurement up to another ATR threshold, and then it buffers extremely high readings over that threshold to prevent outlier skews. Huh? I know. I just wanted to give that for the mathematicians. You don't really have to understand that because in the end, OBC is very easy to use. The takeaway here is with this approach, accumulated conviction is more representative of the intensity of the move, and moves on higher volume and larger price moves are given more weighting than moves on high volume and smaller price ranges. That differs from OBV, but there's more. Here's another math example, and we won't cover this in detail, but this looks at another indicator, Chaikin's accumulation distribution. The catch here is that with AD, it doesn't include overnight price movements. I don't know about you, but those count in my account. I'm not kidding here. A stock could lose 30%, but if the close finishes higher than the open, even by a single penny, it would count that as positive volume. It only calculates from the open to the close. And with OBC, that includes overnight price movement as it should. Enough math. How do we use OBC? Like OBV, we plotted over price, and its interpretations are the same. In this chart, OBC is in white, and OBV is in magenta, and I realize it's hard to see. But the primary signal is a divergence from the price action. Now, you won't find many of these, but when you do, they're often meaningful, and I'm going to show you some examples. If you're unfamiliar with the concepts of a divergence, this occurs when price and an indicator are heading in different directions. An OBC bearish divergence occurs when prices are heading upward or sideways, and OBC starts heading downward. And as they say, a picture is worth 1,000 words. Here we have a good example of an OBC divergence on KLAC. The intensity of the moves on the up days is less than those in the down days, which the naked eye has trouble detecting. That's why we use the algorithms. Now that brings us to a bullish divergence, and a bullish divergence occurs when prices are heading downward or sideways and OBC starts moving upward. Here's an excellent OBC bullish divergence on Tesla, and it occurs with a nice bullish bull reversal pattern. Unfortunately, most of these are not that obvious, but I want to scan in here and zoom in to show you exactly what's happening in the differences between OBC in white and OBV in magenta. In the blue square, you can see we had a number of down days, and these are shown as dots on close, but the down days were very small. Here, OBV kept subtracting the full value, propelling the OBV downline further. But OBC only took a very small percentage of the conviction amount on these minor down days, and hence the line starting headwarding upward, plotting the correct divergence. Now, it's critical to note that OBC displays areas of a potential change in trend. It's not an absolute. And this is true with all the conviction indicators. You always need more evidence. But OBC shows us another perspective that is not apparent again with the naked eye. Here we have a chart of ETF SPY, the S&P 500, and at point A, you can see a significant divergence occurring. Prices are still inching up, but without OBC support. Here, OBC clearly begins heading downward, creating a significant bearish divergence, one that correctly forecasts a 6-month decline in prices. Looking to the bottom, right here at point B, we can see OBC printing a bullish divergence from the declining price trend, again correctly forecasting a 17% intermediate term in rising prices. Like with RCM, if you have trouble spotting these divergences at first, we have an expert advisor that can assist you with the analysis. Here we have a chart of Kellogg printing a beautiful OBC divergence in March of 2022. This led to a strong subsequent uptrend. To the left, you can see the commentary reports that includes bar-by-bar statistics, most of which you won't use, highlighting the divergence with a written assessment that almost everyone uses, saying OBC divergence, there's possible weakness in the downward move, which there was, and then prices started to head upward. Now, if you're going to use OBC, there are a few tendencies that you should be aware of, with the most important one being that bullish divergences are harder to find, but they also seem to be a more reliable signal. And this is just because fear moves tend to have higher intensity than bullish moves. Agreed. There are some other general elements of OBC that you should understand, but to save time, we will skip these. They're not necessarily difficult, and they're covered in the OBC education class. And remember that these classes are given to you for free. Finishing up here, because there's no single best way for every trade, for every person. For more advanced investors, we've included numerous settings that can be adjusted to contour all of the conviction indicators to your specific style within Metastock. You can see this being done right now here with RCM. And you can even set these indicators to calculate with volume if you choose, and you can control all of the sensitivities. For OBC, I would say that 98% of users or more should probably just use the default settings. Now, kinetic conviction is the final tool that we're going to look at before we head to the strategies and the factors that make them up. And this tool has several uses for traders and investors, and again, it's been adapted to today's market environment. First, we need to define the problem like we did with the others. High-frequency trading distorts intensity readings like volume and conviction. Although I'm not sure anyone knows how much HFT activity there is, we know it's a lot. So based on a consensus of reliable assessments, we'll say it's like 50%. The truth is that HFT incorporates many techniques and it's hard to quantify. But what we can say with certainty in regards to intensity analysis, we're not interested in flash orders that are held for a millisecond and that it distorts intensity-based readings. I know, another math example, but we need something for conceptual purposes only to establish reasoning. To keep the math simple, let's say that a stock's average volume was 1 million shares pre-HFT. With that true volume, we would be interested for accumulation and distribution analysis, right? Holding for milliseconds doesn't count. It would be 1 million shares. Then we'll say that today we had 1.25 million shares, leading us to a true volume relative amount of a plus 250,000 shares, or an increase of a plus 25%. This signal would be moderately important, and we'd want to take notice of it. Now, dark pool activity. Dark pools are private exchanges for institutional investors that allow us to trade large blocks of a security without adversely impacting or shocking the market price. They exchange shares where the public simply can't see them. For our purposes, the key thing to keep in mind with dark pools is that they do not disclose their intentions. So our order books don't show them right here, but the results are reported, albeit on a delay, after the completion of the entire block trade to the consolidated tape right here. This is the area on the right, otherwise known And this is the information where the charts are derived from. So doc pools account for a large number of total shares traded, and we do want to factor in these results, unlike HFT. So that's the theory and the reasoning for the tool. So what is kinetic conviction? It's an indicator that highlights important activity by increasing relative sensitivity through the means of measuring price, volatility, volume, or conviction dollars, and it does this by calculating and displaying the differential between the current bar's conviction and its exponentially weighted average conviction differential. KC displays the conviction differential, not the $1.25 million amount, but the $250,000 amount, and we plot it as a histogram. And it's easier to read than to explain. So going back to our theory with volume or conviction, days of high magnitude are relevant and considered more important. But there's a caveat to this in that the actual volume of conviction readings are only relevant when compared to the issue's historical levels, and more so its recent levels, and we want to reduce the HFT effect, right? The levels are not absolute. Here we have standard volume bars in the lower pane and kinetic conviction bars in the middle plane. With standard volume bars, it's not always to see if the day's intensity is noteworthy, like in this yellow box, or even if the recent volume levels are above or below average. And that's what kinetic conviction does. Here's a better view of it. For evaluations, if KC's values are above the zero line, they're displaying that the bar's conviction differential is above its conviction differential average. It has meaning. If KC values are below the zero line, they are displaying that the bar's conviction differential is below its conviction average. The zero line is constantly changing and adjusting to reflect the differential average in an exponentially weighted move. KC price moves with intensity values above the 150 green standard deviation bands are considered more relevant and meaningful. The move is of greater importance. And KC price moves with intensity values below -50 or the lower red standard deviation bands are considered less relevant and meaningful and of questionable importance. The bottom line is if the moves go out of the bands, you want to take notice. If nothing else, it's probably just noise and not noteworthy. Now, not only is kinetic conviction beneficial for single day evaluations, but it's also useful for trend evaluation. Here's another example on how to use kinetic conviction, again on Tesla. And here we can see we have high supportive conviction right here on this upward trend. And then we can see that when price stalls over a few month period, it's actually on low conviction. From there, we can see prices start to head back up with a continuation of the trend, and we get that huge conviction breakout right there. Again, KC has the expert advisor and commentary report with more statistics than you're probably going to need or use. But they also have the written assessment to help you understand. One key measurement that I do want to point out is the KC dollar intensity, the blue arrow. This displays the dollar percentage above or below its exponential moving average. A value of 0 would represent that the bar's dollar conviction is equal to its average. A value of 100% would indicate that the bar's dollar conviction was twice its average. And a value of -50 would indicate that the bar's dollar conviction was half of its average. This is probably the single most important measurement of the conviction indicators, and it really provides you a good, quick assessment of the day's intensity and relevancy, and if it's noteworthy. Now that we've covered all three indicators, this is the money slide. Here we have the recommended setup for a complete conviction view. And this template is already set up for you in Metastock, and it's called the AAI Conviction Trilogy. On the bottom at point A, we have RCM for classic trend intensity momentum analysis. In the middle pane at point B, we have KC to highlight recent moves or moves of relative significance by plotting conviction differentials over understanding deviation bands and for spotting selling climaxes and blow-offs that often start trends or end trends. And on top C, we have OB3 that measures up day versus down day conviction, and its key signals are divergences showing potential areas of a change in trends. The expert advisor is set to RCM, which is probably the best for investors, but it can be adjusted to kinetic conviction for short-term traders. And it's all set up for you in a single template, very easy to understand as long as you know the theory and how to read these signals. So we now turn to, I'm looking at the time here. I have about 13 minutes left. I started late, so I'm right on time. We turn to the conviction systems, where we look to validate the indicators and reinforce our theory and investment analysis. And of course, for traders, to screen with Metastock Explorer to generate a list of small candidates to apply other analysis techniques for. Before we start, we have to do a little house work here. This screen basically states, please don't steal our stuff. This screen basically tells you the reasons why the material may not be 100% accurate. There's exceptions for every rules, and why this material may not be suitable for all investors. And our last one is a regulatory notice. And if you have questions on these 3 slides, you can direct them to Jeff in the chat. He's a smart guy, and he loves taking questions on these slides. So now that we have all 3 systems, they're designed to generate candidates in the Metastock Explorer, and they display the signals right on the charts, as you can see here. But one thing to keep in mind is to get elevated performance with these systems, we have multiple exit algorithms, meaning that one of the many things can happen to get you out, good or bad. Each new bar is factored in. And because of this, these systems do not project stop exit at the time of entry. Although they do have profit target extremes and fail-safe stops built in based on the ATRs of each security, they don't show this. And you would say, well, why don't you show it right away? The reason is for improved performance. Let me ask you, is there really only one set of things that can happen in a chart for you to want to get out of position, to take a profit, or to cut a loss? No, or at least I hope not, right? And because of this, we've programmed multiple dynamic exit criteria on both the profit and the exit, and it doesn't display it initially. Another thing to keep in mind is that the signal algorithms for entries and exits are different. And I know that this is common with most indicators and systems to use the same formula, RSI, stochastic, MACD. For the most part, we use the same exact formula for our entries and exits. But this is probably not necessarily better. We're advancing system design here. Again, let me ask you, do markets rise and fall differently? Of course they do. Then, well, why would we want to use the same factor criteria and the same parameters for both our entry signals and our exit signals? We probably wouldn't. And at least in back testing, by using different measures, it improves performance. Here's the results of the LT scan, and LT stands for long term. Highlights are a good number of candidates at 1766 and a strong 2.66 profit factor. Profit factor is the total wins divided by the total dollar losses. Total dollar wins divided by total dollar losses. LT generated an average trade return of $215 on a $5,000 investment at 4.35% with a modest holding period of under 11 weeks. It had an incredible maximum consecutive win rate of 48 winners in a row. The big negative with this was it had a maximum consecutive loss number of 13, and that's a ramification of a long-only strategy during the COVID drop. It kept taking signals. Here's the equity curve. It did have a minor drawdown during COVID crash, which I just talked about, but it held up well over 2021 and 2022, that kind of bear market environment. I would say this is most appropriate for investors and traders with a longer term time horizon, who are focused on total returns, including dividends, and who are looking for a system to identify potential positions or assist with the timing on a group of securities that they're currently interested in. And I might add that this system would probably be best for option players due to its longer holding period, which I'm going to touch on in a little bit. Here's the results for the ST scan, and that stands for short term. Highlights are the highest number of candidates at 1873. Remember, this is on 500 stocks over 10 years, and it has the most imbalanced approach. The ST system generated an average trade profit of 2.24% with a modest holding period of only 31 days. Negatives, it had the lowest profit factor, although respectable, at 2.5 to 1. And it had 9 consecutive losses at one point in the 10-year period, but that was offset by 35 winners in a row, which is not bad. Here again is the equity curve of that, which is important. This is a beautiful, consistent equity curve with no signs of the COVID crash and a fast acceleration after it. It also created profits, albeit slowly, during the down period in 21 and 2022. I would say this is more appropriate for investors and traders with an intermediate time horizon looking for a system to identify a list of potential positions. For optimum performance, investors can apply additional analysis methods to refine the large number of candidates to improve the reported baseline results. And here's just another view of this, which is actually even more impressive. And here you're seeing the realized equity curve perspective. The realized equity curve shows the results after the closing of the position and not on a day-to-day closing price valuation. And to me, that's a pretty nice equity curve, but it gets better. Lastly, here's the results of the profit factor scan, and profit factors, PF, stands for profit factor, called the PF scan. This had an extremely impressive result at plus 81% hit rate and a 3.73 profit factor, but on the downside, it only generated 3.5 trades per month, again on 500 stocks. Here's the profit factors realized equity curve. It doesn't really get much better than that. Because the system is so selective, it generated very consistent returns with no losing years. And again, it never lost more than 2 consecutive losses over a 10-year period at the end of this study, and I would not expect that to continue, by the way. I would say that this system is probably best for investors or traders with a shorter term time horizon who prioritize risk and consistency of returns and who are willing to scan a larger universe of stocks for potential positions. And I think I touched on this because it's so important. Again, all the systems performance in these reports that I just told you were certified by an independent third-party company called QuantKey. Now, if you remember from the beginning, we stated that these reports' results were likely being underreported and that I was going to show you evidence why hit rates in excess of 85% with profit targets of 4 to 1 or better theoretically could be possible and how you can likely improve any strategy's performance. And this is our final section. And for those in the home base, we have about 6 minutes left on this, so I've actually cut some time. Improving conviction system performance. We're going to look at 6 different ways that anybody can improve performance. Look, we're short of the 85% hit rate in the 4.0 profit factor goal. And so we're going to look at ways that will not only enhance these performance results, but that anyone can use really with any investing or trading approach to improve their results. Our first method to improve performance, you don't really have to do anything. And this is a common omission for people looking to develop new strategies. The conviction studies don't include dividends, which would greatly increase returns. And we know when a stock releases a dividend, the price drops to reflect that decrease of the dividend payment. Studies show that 40% of the total return of the S&P 500 are dividends, which is our study group. performance was only measured on price appreciation that was being decreased by the dividend payments. Also keep in mind that when you add back in the dividend amounts, not only would this increase returns, but many of the conviction systems reported small losses, as you can see here in the last column. These are all 0.1, 0.2. These would have turned into gains if you added in the dividend, and it would have increased the hit rate significantly. Now, we don't want to lose 15% of the time, but as you can see here, many of these losses are a very small percentage, and we're going to look to take care of that also. Number two, there's no market timing mechanism, which is absurd. These systems take or show entries even in obviously bad times, which I had to do because of the restrictions placed upon me. You don't have to do this. Don't do this. Don't fight the tide. In fact, we have a market timing mechanism coming out with Metastock in the spring that can be overlaid with this system or any system that you use. And here you can see right here during the Great Recession, where it would have gotten you out and where you gotten you back in, you would have saved over 30%. So again, don't be afraid to overlay market timing mechanisms and other elements to improve the results of this system, these systems, in your own systems. Our third way, other technical elements, of course. This is how you make a living, right? Scans are built from systems that are designed for research purposes and to identify and substantiate factors. From an execution standpoint, a scan's purpose is to identify securities that meet the system's criteria and to reduce a large number of securities down to a manageable size for further evaluation. Even someone with modest trading or technical analysis skills is going to be able to filter out the bad setups, and you should be able to improve performance from that 81 or 85% level considerably. Our fourth way, these systems don't factor, excuse the pun, fundamentals, right? Anyone who gets the conviction package will also get a complimentary one-year membership to AAII, and that includes some excellent fundamental scan tools and screens. This video shows some of these scans, and they're based on the philosophies of some of the world's all-time greatest investors. My favorite, as shown here, is the My Screen scan that shows you the individual stocks that appear in the largest number of fundamental systems. For some investors, the integration of fundamental stock selections at some level is an area that could improve and should improve your performance. Number 5, theoretical compound returns in the profit factor system back-tested to well over 40%. That's not including the dividends or anything else. But for professionals that would like to be even more aggressive, integrating options is a consideration as these systems target relatively quick, high probability swing trade-like executions. Obviously, the effectiveness of this method is dependent on the skill of the investor. But I would not rule out using options if you're experienced and comfortable using them, especially with the LT systems. Number 6, money management. Finally, well, first, we didn't even compound returns for the system. We didn't reinvest the returns. We stayed at $5,000 per position. If you reinvested the profit, you would have greatly enhanced your overall returns. And if you question, just go to any online calculator and punch in some numbers. Additionally, by incorporating money management techniques like moving stop losses to assure profitability or scaling out of your positions to let your profits run would likely significantly increase overall returns. Here you can see 2 conviction trades where profits could have been extended by using the conviction screen to get into it, but then using basic trend analysis to stay with the position. So that's the Conviction Plus system. So there's 3 intensity-based analytical tools and 3 trading systems along with Prove, that's the plus. And that's what you see here on the screen right here. And 2, this is a tool that calculates how many shares, this should be a video that's not starting, so I apologize. There it is. This is a tool that calculates how many shares of a position that you should buy and rebalance to equalize your downside risk for each position that you hold on a volatility adjusted basis, with the goal that each position has an equal end effect on your portfolio. Buying equal share amounts is crazy, and buying equal dollar amounts of various securities with differing volatility is not a sound practice. Not many hedge fund people would do that. And it can be used, and this proof can actually be used for mutual funds, stocks, and ETFs, and you can mix them. It tells you how much you would expect to lose on the average down day of each particular security. And this can be used for hedging a portfolio by shorting or by using puts. And it's excellent for eliminating market directional risk for those looking to profit in both bullish and bearish market environments with an equity market neutral approach. And we have an entire webinar on proof. My hope here is that if you choose not to use the conviction tools, that you've learned something in this presentation that you can use to improve your trading and or investment returns. For more information on the conviction systems, AAI's active investing, which focuses all on setups and technical analysis trades and overlying options and many other advanced techniques, or the education classes, you can contact me directly at Rondeau@aaii.com. As I mentioned at the beginning, if you order Conviction Plus, you get all of the conviction classes are included. And if anyone would like to learn more about other areas of trading investing from other experts like Ken Fisher, Paul Merriman, and the National Association of Active Investment Managers, you can go to www.aai.com/V as in Victory, E as in Edgar, S as in Sam, and you can use the code AAII50, and you can get 50% off each class. And these classes are really well done. Some of the classes you can get literally with the promotion for as little as $10, which is crazy. This is the end of the formal part of the presentation. I tried to make up a little time for Jeff in the home base.
Great job.
My name is Raymond Rondeau. I'm an investment strategist and senior technical analyst with AAII. As always, I do thank you for your time and attention. And I want to thank Jeff, Kelly, and the entire Metastock staff for this opportunity. That's it.
A couple questions, if you don't mind. Just some quick questions. We had a question about what instruments does this work with? So obviously you've done a lot of design for stocks and that kind of stuff. Does it work well with international stocks? Do you have experience with any international markets, ETFs, futures, Forex? What are the recommended instruments? And I will note, go ahead.
Oh, no, I apologize, Jeff. The only one that we tested on that I can produce the results are on the S&P 500. But if we accept that technical patterns are fractal in nature, right, a core belief in technical analysis, that it would be hard to believe that they wouldn't be effective with smaller stocks. Certainly ETFs, I gave many examples how to use them with ETFs. Futures are just technically parallel ETFs, so I don't know why it wouldn't work there either. I've certainly used them on commodities, very effective. We showed that one chart of gold. I have not used them on international securities, although I've heard from people from New Zealand and Australia who use Metastock, who purchased Conviction Plus, and they say it works great, but that's anecdotal and I can't prove that, so I don't want to lead you in that direction.
It doesn't surprise me. A lot of stocks that work well, or a lot of systems that work well here work in any auction theory market, but we do offer a money back guarantee as well. So you can try it out. So would you say this is more of a day trading or a swing trading type of a system, or even longer term than that?
I would say probably swing and long term. Kinetic conviction certainly is very helpful for day traders, but in general, the entire system is more for swing trading. We gave you the holding periods on them. Remember, those are actually days, not bars. That's important to remember.
Okay. And then let's see. You talked a lot about system design. What are some maybe overlooked factors or some important factors when you're designing a system? What are some things that you look at for real quickly because we're out of time. But,
Yeah, that's a good question. I mean, system design is everything, in my opinion. It gives you the answers. You can ask me any question, if I buy on Mondays and sell on Wednesdays, whatever it would be. What RSI numbers are best? What MACD numbers are best? We have all these studies, etc. At what parameters? How should you use them? The computers just do a better job telling us the answers. Certainly, we talked about gapping. That would be one, but not just gapping, characteristics of a gap. What precedes it? What comes after it? Is the gap meaningful? Overbought and oversold levels. That would be another element. Where prices finishing in relationship to a bar. It's impossible, no matter how experienced you are as an investor, to design the most optimized system just based off experience. And computers tell us not only which factors are most important and how to use them, and it kind of layers them so you can put them in importance, and then it helps you synergize the factors, because sometimes factors don't work well together, but they work good in different combinations, and that's what kinetic conviction is.
Perfect. Thank you, Ray. I appreciate you, man. Thanks for coming in, spending some time with us. Sorry about the late start, but it was good to have you. I'm glad we got you in here.
Great. I think I gained you 4 minutes, Jeff, and thanks to the home base and everybody. Thank you.
I'm going to spend that 4 minutes though talking about you. So there you go. Anyway, thanks a lot, Ray. We really do appreciate that.
Thank you.
And
sir.
I do want to spend just a minute talking about kind of the system and the methods, because they are very good. And one of the things I've always admired about Ray is the design that he does. So let me go ahead and kind of just show my screen over here. And I just want to kind of I want to recap real quick. It includes the 3 unique indicators that he talks about, or that he talked about, and kind of and he talked about why they're better. But you get the optimized balance conviction, you get kinetic conviction, you get relative conviction momentum. All of those are included. You're going to get the, and here's some slides on them. I'm going to kind of go fast with them, but he did cover very thoroughly why these are better versions of kind of some of the indicators that were developed in the 70s. In addition to those indicators, you're going to get specific methods. You're going to get long-term, short-term, and then the preferred choice system. And the long-term, again, has an average length of about 82 bars or 82 days, but it's perfect for investors who have that long-term trading horizon and are looking to favor a total return strategy. You've got the ST system, which is a 35-bar hold time, perfect for that intermediate trader. And then you get the PT, which is 27 bars. So you do get the proofs calculator, which is a very unique way to kind of look at money management and risk assessment in your portfolio. It's going to give you the down loss per specific day. You also get full scanning, full explorations, the ability to scan. Again, I'm going to run a scan in a minute as soon as I kind of get started, but I love the ability to just say, hey, show me the signals that have a signal today. It's one of the things that I think we do best in Metastock. Show me the ones that have an opportunity. I want to be able to ignore the noise and just focus on those stocks that work best. It's going to include that. So the AAII Conviction Plus, not only does it include 7 indicators, 4 explorations, it's got 6 different explorations and 7 different templates. In addition to that, AAII is going to throw in membership to the AAII.com member database. And all of that is normally $14.97. As I mentioned before, here today, it's $9.97. It's a 30-day money-back guarantee, so you can try it. The risk reward is awesome on it. It does have a 30-day money-back guarantee, like I just said 10 seconds ago. To take advantage of that, give us a call, 800-882-3040. You can go to metastock.com/conf-promo. And Rob, I hope I didn't say it that way. Oh, and you can also give us a call at metastock.com/saleschat. So there you go. Thank you, Raymond, very much for coming in here. I do want to say thank you to the AAII for also sponsoring the event. I also want to talk about CMT for a second. One of our sponsors, CMT Association, been a sponsor with us for a number of years. They're a great group of guys to work with. They've done a really good job. You can find out more about the CMT Association at cmtassociation.org, or you can give them a call at 646-652-3300. So cmtassociation.org. Of course, we're Metastock for 30 years in a row. We've been rated #1. We can help you find market opportunities, test trading ideas. We have a patented forecaster in there. It's been a software that's been rated #1 in its price category for literally 30 years straight. So pricing starts at just $69 for like our DC program. And you can pay for a month of that and get a second and a third month for free. So you can do that at metastock.com/conf promo. You can call us 800-882-3040, or you can give us a chat online with us at metastock.com/saleschat. So I just started a run on my watch. That's why I was buzzing. Our next presenter is John Seville. John is a frequent contributor here. We've had him on the channel a number of times. I was just looking at his bio. He started his company, Acorn Wealth Corporation, in 2007. And I remember we would spend a lot of time helping him build and create indicators in Metastock. It was a lot of fun. I really liked the strategies that he used and some of the Twigs methods and some of the stuff that we're working on. Very fun guy to work with, super smart, super cool accent too, by the way. But let's go ahead and bring him in here. John, let's go ahead and get you started. I know we're running a little bit late, and that's not unnormal.
Right on, Jeffrey. Can you hear me?
Yep, I can hear you. Let me go ahead and make you the presenter. Go ahead and do that. Okay, so I'll let you know as soon as we can see your screen. Not yet, though.
Not yet?
Maybe. Oh, here it comes. Yeah, it just takes a second for me. I can see I can see you too.
It's like the light coming in from behind me.
Yeah. It was really bright at first. I thought, wow, he looks like an angel. But then it kind of, like the camera adjusted. You look great. I'm going to go ahead and get out of the way. It's all you. Thanks for coming in. It's good to see you too.
Thank you, sir. Yeah, great to see you. I was just thinking about our next Traders Convention coming up in February.
Yeah, for sure. I'll be there.
Okay. Now, have we got the screen up as well?
Yes.
Okay. Give me a second.
Although your
guys.
webcam did turn off. I don't know if you did that on purpose or not. But we can't see the screen.
Is myself. That's one I'm just trying to.
Oh, yeah, that happens sometimes. Okay, now I can see both the screen and you. And once in a while, when I turn on my webcam, that's all it wants me to see is me. But can you see your screen?
Now I've got it. Excellent.
Okay. All right, good. Then I'm out of the way. It's your turn. Go.
Terrific. Well, yeah, great to be back. And I always enjoy these conferences, especially in the kind of market that we're in right now. And as Jeffrey said, we've been around actually 16 years. Today is Acorn's 16-year birthday, in fact. So we got started doing this on November 6th, 2007. It's a real thrill to be celebrating our 16-year anniversary today with everyone here. So thanks for showing up. It's been a great event so far, and we're going to dive into some exciting stuff, and we'll kick off. Firstly, of course, our standard disclaimer: this is for educational purposes only, not a recommendation to buy or sell any of the securities discussed. So always be aware of the risks of trading and never risk more than you're willing to lose. Any past returns discussed do not guarantee future results. There are no guarantees with any investment, not stocks, not real estate, not futures, not anything. So again, beware of the risks and speak to a financial advisor before taking any action. Any stocks discussed today may be being held by myself, Acorn Wealth, or the employees and contractors of Acorn Wealth. So that, of course, is not tailored towards the individual risk profiles of any traders here. So always do your own diligence. And with that, I think we can crack on into things. So, yeah, as Jeffrey said, I mean, I won't go into a long, drawn-out introduction. We've got a lot to cover today. But we did start in November 6, 2007. We've trained now over 6,000 traders around the world, and still doing it strong today. It's been an exciting journey, and we've had quite a few recent moments where we had recognition in the industry. We were invited down to do an interview there with Kevin Harrington from Shark Tank in February down in Florida. That was a real thrill. Even more thrilling was when he chirped up and said that tracking the smart money was one of his favorite strategies. And that was a cool thing that came out in that interview, which will air nationally here in a few weeks. So anyway, won't spoil the surprises there. But and we also were awarded the FinTech Award for Best Stock Market Educator of the Year last year, which was another kind of thing that I was very proud of. But what I was more proud of in these events was not what we had done as a company, but more importantly, the impact that had on the people that have been part of our community, traders like yourself. I'm sure there's many acorns in the room. If there is, put a quick 23 in the chat box. G'day, g'day. But I mean, ultimately, it's not about what market predictions we make or the trades that we do. It's about the difference we can make for traders looking to learn and looking to be better and more confident in their trading. That's what I got started in this business 4 years ago, was wanting to make a difference. Because I had as many traders do, a rough start. When I first got started in trading 20 plus years ago, my goal was to do this full time and to travel the world, because I love traveling. Most Australians, as you probably are aware, are spread out all over the world. We're you just can't get rid of us. But when I first got started, I thought, all right, I'm going to go buy all the textbooks. I'm going to go buy all the indicators. I'm going to buy all the courses out there. I'm going to do this right. And I spent tens of thousands of dollars on systems and indicators and tools, and I knew a lot. I knew a lot, right? I read it all, and I sounded smart at the dinner table. And if you looked at my chart, I did all the things that we often do. I started off with RSI, Relative Strength Index, and then I added on stochastics, because you got to have that. And then I added on balance volume, because you got to have that. And then I added on money flow, because you got to have that. And then I added on MACD, because you got to have that. And the more and more bright, shiny objects kept loading onto the chart until, it was littered. And then, of course, you add the moving averages and RSI and all, it just becomes a lot. How many people have gone through this kind of rabbit hole of analysis paralysis themselves? Whose charts either look like this now or have looked like this at one point? Put a one in the chat box. So that was the rabbit hole for me, and it was really frustrating to know so much and have so many tools and to not be making any money. In fact, it was the opposite. After doing all of this, I blew up 2 accounts in my first few years of trading, which was also incredibly frustrating to be doing everything I was told to do and for it to not work. Again, I'm sure there's probably a few people feeling like that or have gone through that themselves. So this is what really led me to develop the smart money tool that I'm going to be showing you, and the system that I'm going to be showing you today. Because what I had to do was bring it all back to the basics and say, look, ultimately, what are all these things telling me? Because there's only 3 things you can actually analyze in a chart. Does anyone know what they are? 3 things that you can analyze in a chart: volume, price, and time. And pretty much all of the hundreds, if not thousands, of indicators that you see out there are ultimately looking at this, a compilation or a function of these 3 different aspects in one way or another. And so one of the things that was a big game changer for me is I met my mentor, Strathy Curtis, who has passed on, unfortunately now. He would have been 85 last month if he was still with us. But I met him in my early days, thankfully. And he said, Johnny, you've got to get rid of all this stuff. You've got to bring it back to what really moves the market. And that's where this system, which has had some uncanny performance, which we'll get into later, all evolved from. But we'll come back to that. Before we get into that, let's start out with the basics. Let's start out with the foundations of what those small hinges that move the big doors are. And this is where the 3 rules of smart money trading comes from. Number 1, it's not personal, it's patterns. And this is something that I think is a lack of understanding of this is one of the big reasons why most people's charting and technical analysis fails. But we'll go into that in a moment. But number 2, double down on smart money. One of the big things that my mentor told me early on was, he said, Johnny, you've got to realize that 80% of the volume in the market comes from smart money, algorithmic trading, high frequency trading, hedge funds. This is 80% of the volume. JP Morgan released a report early this year that estimated that retail traders now only represent somewhere between 15 and 20% of the daily volume in the market. Fascinating, but should not be any surprise. So if we want to be on the winning side of a trade, it seemed to make a lot of sense to figure out where the smart money was going. And when something is algorithmic and follows patterns, that's something you can reverse engineer. So that was part 2. And part 3 was to automate it. And when I say automated, I don't mean putting my life savings in the hands of a ChatGPT trading bot, right? Or an automated trading system. I'm not saying there's anything wrong with that, but it's just not for me. I love using technology to do 99% of the work, but I still want to have the final click of the button. Who would agree with that? You know, we can be efficient and still trade smart without being fully automated. When I say automate, what I mean is when we have a strategy and we know why we're getting in and why we're getting out, we can program in those levels. And again, we'll be diving into that today. So that's the 3 rules of smart money trading and what's evolved in our company over the last 16 years now. So to dive into the first one, rule number 1, this is the golden rule. And I actually had this printed out on my wall for many years when I first started out. And I'll take my webcam off for the moment just so we can have a little bit more real estate. But the golden rule that I pinned up on my wall was this, that when we look at a stock or a market or a foreign exchange, whatever the case might be, it's not going to change direction unless it hits one of the following 3 things: horizontal support or resistance, trend line resistance, or moving averages. So essentially, these are 3 different types of support and resistance that can be in play. And the analogy I've always used since day one is to think of it like getting onto an elevator on the ground floor. If we get in to an elevator at the ground floor, hoping to go up, well, there's only 2 places it's going to go, isn't there? It's going to go up to the first floor, or it's going to go down to the basement. It moves between floors in the building, and trading is very much the same, right? If we get into a stock at the ground floor, the simplest way, if someone said, teach me to trade in 10 minutes, this is what I would do. I'd say, well, let's identify where the floors and ceilings are in a chart. Let's buy at the ground floor, sell as soon as we get close to the first. And if it goes the wrong way, much like an elevator, how quickly do we know if an elevator is going the wrong way? Almost immediately, the moment it starts going down. So in trading, a really simplified paired back trading strategy is if you can identify where the really powerful support level is, and you can buy as close to that as possible, set a stop loss right underneath it, let's say 2% underneath, and not get greedy as soon as it goes up only to the first floor. Let's say that's an 8% profit for a 2% risk, and that's it. And then just do that over and over and over and over again. So when we start to take the complexity of the market and bring it back to the simple things that really move the big doors, we can now incorporate things like patterns and probabilities, smart money. And this is where we can perhaps get on the ground floor and go much further, maybe even all the way to the penthouse. And so to dive into that a little deeper, when we are looking at these systems of support and resistance, this brings us to the next layer of the market analysis and pattern analysis, which is the type of systems we can be in. And there are two really core systems: oscillation and momentum. And the differences between the two are as, well, they may as well be as different as a long is to a short. They are black and white, different systems. So how many people, just pop in the chat box, put a 1 in the chat box if you're really familiar with the key. If you're not. All right? So quite a mix. So let's dive a little bit deeper into what the differences are. Yeah, as we went into the end of 2022. Can everybody see what's controlling the stock? Are the moving averages really in control? I would say no. Look at how the stock goes up and down through them like a hot knife through butter, like they're not even there, because they're not really. They're not there. They're not meaningful when you're in oscillation. What's in control? The algorithm, the pattern, the system that's in power here are these two straight and parallel lines. In fact, if we look at those two perfectly parallel lines, they actually account for all of the best trading opportunities and reversal points that the stock made. So our first step, as you can see, is to identify what system is in control. What of those, going back to that golden rule, what's in charge? And that then tells us how to trade it. So if we're in oscillation, we don't use moving averages. We don't use MACD. We don't use relative strength index the same way. These are all, kind of momentum indicators. But if you're in oscillation, we would be using things like Bollinger Bands, maybe Keltner channels, and most certainly, most importantly, looking at the support and resistance, not through the lens of moving averages, but through the lens of the oscillation levels. Right? Really key, really key. The next part to this, of course, is momentum. And so this is the same chart of NVIDIA, and this is where we can observe the shape that the oscillation made, right? So once we have the shape of what's in charge, once we understand the pattern, then there are very specific rules of how we trade it. And a downward channel is a bullish pattern. Why is it bullish? Well, what makes a pattern bullish or bearish isn't the direction the pattern is moving in. It's what it tells us is likely to happen next. And this is why patterns are, in my opinion, the most powerful leading indicator out there, because their specific job is to tell us, based on what's happened, what's likely to happen next. And the problem with so many indicators out there and so forth, a lot of these bright, shiny objects, is that they're lagging. They're really just telling you stuff that's happened before. Patterns tell us what's likely to happen next. And they also have very specific rules of where we should consider getting in, where we should consider getting out, what the probability of a winning trade will be. And so what we're doing here when we start going back to the basics of price action and patterns is we're answering, I think, some of the questions that traders struggle with the most, which is when do I get in? When do I get out? Where should I put my stop loss? Right? That's what this gives us. So when we see NVIDIA going down in a downward channel, and unfortunately probably many traders selling on the way down in that bullish pattern, it's actually gearing up for a move to the upside. And so as we break out of that channel, that's a potential entry point. Our next potential entry point would be the test of the support, which most breakouts do. And then that gives us a first target of around there. And then it obviously continued on much further. So let's look at that, because what's happened here is a transition from oscillation now to momentum. So unlike before, can everybody now see, do the moving averages work now? From this point onwards, put a 1 in the chat box if you can see how most certainly the moving averages are now in control. They are now the system that's in charge. You see? So and that's what stocks do. That's what markets do. They go from oscillation to momentum. And then momentum back to oscillation. You can see at the top where the moving averages suddenly stop working. It's now gone back to an oscillation system. So by understanding what is in charge is such an important part to analysis before we get into all the other stuff, because that's how smart money works. Algorithms don't see this. They don't see candlesticks. They don't see the noise. Algorithms see levels. They see levels in the chart. Just like the elevator in the building, going from floor to floor. And so if we take a moment to turn the clock back a little bit and think about how this then applies to markets. Let's apply this to some of the big moves that we've seen in the market. Let's go back to 2008. 2008, where we had this global financial crisis. Well, countries shut down, banks shutting down. The collapse of the financial system. Fast forward 12 years and now we've got another market breakdown, this time fueled by a pandemic being the catalyst. And of course, the question when you look at those events where these are these black swan events is, well, okay, with these types of events, the $1 million question is, could they have been anticipated? Could they have been predicted? And the answer to that, in my mind, is absolutely. And for those of you who followed us for a while, you'll remember that the 2008 crash was our first big call on the market. We started in November 2007, and one of our first calls on the market is, we think it's going to crash. and again, in 2020, 2008, 2018, some of these major tops we've been able to help people anticipate. But it wasn't through having a crystal ball or magic tricks or anything like that. It was coming back to this understanding of patterns, understanding of looking at how money is moving behind the chart. So if we take a look at the 2022 crash as an example, we could go through all of them, but for the sake of time, we'll focus on 2022 today. Take a look at the S&P 500, right? We're looking at the SPY here. When you look at the SPY, and this is all the way from the beginning of 2021 to January 2022, what was the pattern in charge? Were we in momentum or were we in oscillation? Put an M in the chat for momentum, put an O in the chat for oscillation. And if you know the pattern, throw it in there as well. Yep. Oscillation. Why oscillation? Because what was in control? What held the market up and what held the market down? It wasn't the moving averages. We go, well, look at that. Up through them, down through them, 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 up through them. Like, look at how many times through that period that the 9 and 20 day moving average failed. Failed once, failed twice, failed 3, 4, but like there's countless times it failed. What was holding the market up and what was holding the market down? Those two parallel lines. It consistently ran up into that resistance, touched it on every single reversal, every single top happened at that line, right? But never breaking through. And on the bottom, we can see all the powerful buying opportunities happened at that line. So we now have a shape. What is the shape? It's an upward channel. Okay, so what are the rules of an upward channel? Well, an upward channel is bearish. An upward channel tells us that statistically, after 3 touches on support, it's statistically now probable that it's going to break down, that we're about to enter a bearish move. So we've got our 3 touches. Okay, so now we're expecting a breakdown. So we measure the channel, and that is our first target of where we expect it to break down to. And that's actually exactly where it broke down to. And this is how we were able to warn people in December, prior to that drop, that we felt that we were about to head into a sharp drop in the market. No crystal ball, just following the rules of patterns that have been around for decades, right? And so this is something that's just so important to be able to anticipate this. Now, again, nothing's 100%, but there's a reason why they call them patterns, because they have this ability to often do the same thing over and over. Now, if we take a look at what then occurred, you can see that's how the market then, that was the top. That was the top of the 2022 market, and down we went. But how did we decline? What was the pattern on the way down? So the first thing we can do, because a lot of people won't naturally just see the patterns when you're first starting out. So the first key is, well, right? And we can see the oscillation that way. And that's what gives us the heads up in many cases to look for the oscillation system. And so what became quite apparent quite quickly, especially after these 2 very sharp rallies, we go back to our golden rule and we say, well, the market didn't just randomly turn around instantly. There was a support level there. Which was it? Well, it wasn't a moving average. It was oscillation. And that gives us our heads up, and that's what helped us identify those future support points. There is a science to this. This isn't just guesswork. It's process. It's rule-driven. And so as we bottomed out, much like an upward channel is bearish, a downward channel is bullish. And we'd had 1, 2, 3 touches along the resistance. So once again, there's our rule of 3, and we now be expecting the market to break out. So as we go up to our 4th touch, that resistance to us is now very weak, perhaps even non-existent. We're expecting a rally. And where would we expect a rally to? Well, we would measure the channel. We duplicate that on top of the channel breakout zone. And that gives us our target. Okay. And so as we see the market breaking out in January, this gives us a rule-driven way of forecasting where this is likely to go. It's kind of like a play or a favorite movie where we already know the ending. You already know how this goes, and you're starting to see the story evolve, and we're now watching with anticipation and excitement as it starts to follow through on those rules. And just like most breakouts do, breaks out, pulls back the support, and instead of panicking on that pullback, we're actually excited and buying on the pullback with that confidence of the system. And where do we go? Well, the SPY, the S&P, went to exactly, as in exactly, where that rule-driven target was. You know, and again, those of you who follow me, follow us on I think it was July 27th, we hit that target and we published a broadcast to every single person on our list, and obviously all of our students, and said, you know, we're selling everything. We're liquidating everything we hold in the market long, except maybe 1 or 2 long-term holds that I still have, right? Because why? Well, the reason why is that we had now reached the target of a system that had been evolving since the top of 2021. We'd now reached the end of a system that had taken 2 years almost to evolve. Does that make sense? Think of it like, you know, you've gotten to the top of a mountain. You've climbed the top of this mountain. You know, the view is exhilarating. It's been a great ride up. It's been incredibly exciting. But now you're at the top. The only way potentially now is down. And that's exactly what we saw with the S&P, is that after reaching that target, been evolving for over 1.5 years, we then started turning down. And so where we're at now is a really critical test of this system, as if you look at the way that we've been dropping, we are now kind of right at this resistance point. This is today's data. We're right at this resistance of that potential downward channel once more. And so where we go from here is, to me, likely the indication of whether we're headed back for a retest of 460 area, or whether we're falling down back to support around there. This is an important juncture. And by all the rules of patterns, we are at that juncture today. This is where the roads split. And notice that what we've been able to do here is analyze the market, some of these major turns, without going into anything, any fancy fundamentals. We're not taking into account geopolitical events and all the noise. We're simply looking at how the system's working behind the charts. And that, to me, is what makes trading incredibly exciting. So the next part to this was taking the pattern and going deeper into the smart money. And this is where the indicator and system I mentioned earlier to you starts to play a really valuable role. because I've been doing this for a long time. Obviously, I've been doing this all my life, actually, all my adult life. I got into this when I was 16 and still doing it to this day. Sometimes it's nice to have a little bit of extra help. And so introducing the smart money divergence system. So what you're now seeing is the 2023 top with the smart money divergence index applied on top of it. And so what the smart money divergence system is doing is it's looking at all of these other factors we previously had to clutter our chart with. It's looking at relative strength. It's looking at money flow. It's looking at overbought and oversold conditions that stochastics analyze. It's looking at volume profiles. It's looking at different time frames. It's looking at all of these things that we often clutter our charts with to analyze those different combinations of price, time, and volume. And what it ultimately is doing is analyzing the characteristics of whether the algorithms behind the chart are dumping or loading up. That's what ultimately we really want to know. Are we in an uptrend that's worth staying in or one getting out of? And so what we're looking at here on the chart is something that you can't see with your own eyes. And that's where indicators do become really valuable, when they do something that we can't see for ourselves. And so what this does is takes all of those algorithms and all there's a ton of code that we've developed. It took us about 6 years to develop this, to perfect this until we released it publicly. And we released it publicly at the beginning of last year, 15 years in. And what it's telling us right there on the weekly chart on the SPY is it's detected from that proprietary algorithm the smart money is getting out. And it was right at the top of that channel. And that was incredibly important and helpful in us being able to anticipate that top. And when the S&P topped again in July of this year, that was the second time that we saw the indicator print again. And this indicator doesn't reprint. So you're seeing all of the signals here on the weekly chart over this entire time frame. There was only 2 signals it issued on the SPY over those 2 years. And they were both right at the top of the market as it anticipated and saw what was going on behind the scenes. Everyone understand the value of that? And if you go back if we take the clock back even further, look at some of the other major declines in the market, such as 2008. Again, we're talking about a weekly chart here. It anticipated the top there before a sharp drop. This is a weekly chart, so this is quite a substantial move. And then, of course, right at the top of 07. If you take a look at 2018, when we had that flash crash, was it unpredictable? Was it chaotic? Well, not based on this indicator, right? It detected that smart money was flooding out the back door right at the market top in October of 2018. So when people say, well, how do you anticipate it? I'd love to say I've got a crystal ball. I'd love to say I'm some genius savant, but I'm not. Just ask my girlfriend, right? That's why we follow the smart money. If you account for 80% of the volume, you are a force to be reckoned with, and ultimately you are the market. And so piggybacking off these moves is incredibly important. And again, in 2020, right at the top of the 2020 crash, smart money sings again. The reason why they call it smart money. And so, in all of these major market crashes, this has been able to print either right at the top or in the weeks leading up to it, which I think is just infinitely valuable. Who would agree? Put a 1 in the chat box if you can see, if you have an idea of how much money that might have saved you, or the shorting opportunities you might have taken if you'd had that confidence, right? It's a system. And it's helping us take the guesswork out of it. And so today, as part of the and I'm going to show you some trade examples here in a moment, but just so you understand, the value of this is, well, you calculate that for yourself. You think about how much money it might have saved you if you had got out at the top of 2020, the top of 2022, the recent top in July. What would it have saved you? What opportunities could you have potentially had or taken advantage of had you have had that extra level of confidence, right? I can tell you the value of it probably doesn't even come close to the offer we're going to give you today, because today is part of Metastock's special event and a celebration of Acorn's 16-year anniversary today. We're going to be giving you lifetime access to this indicator and system for only $397. So, and I'll put the link in the chat box here for you. It is acornwealthcorp.com/meta. Okay. Now, let's go deeper. I'll come back to that in a moment. But detecting these powerful divergences, of course, doesn't just work in the market. It also works for trades, for individual stocks. And I love it because it allows me to take all that clutter I used to have on my chart off and focus on what's really moving. So here's an example of this is a real trade with real money, and that we did on OC. So let's start off. Let's go through our smart money checklist. Let's go through our 3 rules. Number 1, what's the pattern? So in Owens Corning, and we're looking at the weekly chart here, this is my favorite way to use the indicator, by the way. Even if I'm looking for day trades, swing trades, what I love to do is to look for powerful patterns on the weekly, and then dial down from there. And so Owens Corning was an upward channel. And in this case, it broke the wrong way, if I can call it that. It failed. It didn't break down as statistically it should. So what does that mean? Is it a failed upward channel? No. It's actually a different pattern entirely. When you get an upward channel like that breaks to the upside, it's actually an even more bearish system. It's kind of like an upside down cup and handle. And when you see it happen to the downside, right? So when we saw this break upward out of the channel, what it wants to do is it's like pulling a rubber band back even further. It still wants to snap back bearishly. So when we see something break up out of a channel like this, we consider everything that happens above that channel to be a bubble. And it's just a matter of waiting for the timing of when it's going to pop. And so we were tracking this already. But when is the right time to get in to this short position? Well, this is where the smart money divergence system comes in. As the stock went further and further up, we then got our smart money divergence indicator on the weekly chart. And that was the time where we now start saying, okay, this might be ready to get into. This might be ready to short. And so we then took a look at what was the daily pattern. Let's zoom in and take a look at the smaller time frame. And if you zoom in to the daily pattern from the weekly, what pattern did we have there? Upward channel. Bearish system, right? Smart money divergence sell signal at the top, and we touched once, twice, 3 times. There's our rule of 3. Now it's ready to break down. Now, based on our rules, this is ready to short. We've got a bearish pattern on the daily. We've got a bearish pattern on the weekly. We've got smart money divergence on both. All right. what else could we do to make this even better? Well, what about a bit of insider selling? Something we also scanned for. And we saw that there was heavy insider selling on this all the way up to the three potential first target of 119 and a second target of 111. And I bought the puts on that one, and it dropped straight down. I think the absolute lowest it went was 110, $1 below our second target. And so that was a really nice move. It was sold those puts, December 130 puts, when it hit the second target for a nice little profit. You can see other examples. PWR, right? PWR, same kind of thing. This was also an upward channel that had broke to the upside. So there's your bubble. There's a smart money indicator at the top. Rolled over. This was alerted. This one we were a little bit later on. I think it was alerted around 190. And our target was right there at 170. So down it went. It was a quick move. And as you can see, then the smart money divergence went back to long. And so if you were still in the trade, it gave you a warning that the tide may have shifted back to the long side. But its ability to kind of nail some of those tops and bottoms is awesome. MTH was another recent bearish signal, short alert that we did. Smart money divergence right at the top, insider selling, down it went, all the way down to our targets. Smart money divergence indicator went long, and that was before it shot up. So at 112, it indicated a smart money divergence long. So if you were short, gave you a really good warning, right? And then possibly even an opportunity to go long. And so there was the alert on MTH. September 12th, short, potential head and shoulders, entry signal 131, target 121, second target momentum, and we just continued lowering the stop as it continued to drop. And as you can see, hit that 121 target very easily and finished out around 110. Look, I get so many examples. I'll fast forward through these because I've got some information to give you on the special for today. But can you see how you would use this? Look at that TNGO. It shows you the smart money signals from the top and the bottom. OPI, I'm still in this one actually. I'm long OPI right now. I hold an active position in this for full disclosure purposes. Smart money divergence sell signal. Came up in our scanner a few weeks ago as a smart money divergence long. Now this is a REIT, and what you might not know is that the financial sector and the real estate sector are the two sectors with the heaviest amounts of insider buying over the last 6 months. The buying actually outweighs the selling, and I think it's the only two sectors in the market where that is the case. So we are focusing a lot at the moment on real estate and financial stocks that have these qualities. And this is a REIT listed in the financial sector. So, yeehaw. It also, when we bought it, paid a 28% dividend. Now, dividends can be cancelled, but that's not a bad extra potential upside to have. So we've got a potential 25%, let's say, dividend, and we've got insider buying, and we've got the smart money divergence long. In we go, and still holding that. But it all comes back to smart money. comes back to tracking these moves. Tesla, right? Even on the famous 5. So as you can see, like this is process instead of guesswork. Like there's always going to be an element of risk to any trade. And that's why we have stop losses. And that's why when things go the wrong way, we try to get out quickly and have those stop losses in place. Because it's really, trading is meant to be about your money working for you. But so many people end up working around the clock, glued to the screen, working very hard for minimal returns. And so all of that can change, and all that can change right now. At least you can take a big step in the right direction. And as I said, that's why we put together this exciting smart money trading bundle that will take you to that next step. And we've touched on a lot of things today, but it's just scraping the surface. And what you're going to get in the smart money trading bundle is everything you need to then take this through to fruition. And so first and foremost, of course, the smart money divergence indicator is included, and that is normally $9.97 on its own for that indicator, and we are giving it to you for life for only $3.97. So that's you can install it on, of course, you can install it on Metastock, Wealth Charts, TradingView, TradeStation, and Think or Swim with NinjaTrader around the corner. So whatever you use, you can get it set up there, no problems. And on top of that, we'll also be giving you a really big bonus, again, as part of today's Metastock event. We'll also be including for you the Smart Money Divergence Scanner. And this is how we find them. So every day, it's not even necessarily every day, every few days, I will run my scan. And I love to scan on the weekly the most. But you can scan on the daily, the hourly, you can even scan on 15 minutes if you want. You can scan on any time frame to look for these signals. My personal preference is to scan on the weekly and then and really look at those ones where big trends are potentially shifting. So you'll have lifetime access to that as a bonus. If you get set up today, that's going to be yours for life as well. So really big bonus. Once again, the link for that is acornwealthcorp.com/meta. But we wanted to give you that extra step. We didn't want to just give you the tools, but we also wanted to give you a little bit of help on the way. We are in some very exciting markets. We're right at this potential shift in direction on the market, as we talked about earlier today. We're right at it. We're either at the beginning of another big short-term move up, at least, or we've topped. We're kind of at that point right now. So I've spent almost the whole weekend running my scans, going through all my watch lists, and we've prepared, we just sent out today our favorite watch lists for the long side of dividend payers in the real estate sector and financial sector, stocks with massive insider buying, and ones that are reporting this week. We did a really special report for our members, and you'll get access to that. And you'll also get access to 3 months of these ongoing alerts. So you'll actually get a video report every week with our 5 favorite setups and in video format and written format, breaking them down, the patterns, the insiders, the sector they're in, kind of everything you need to know to feel like you've got the information at your fingertips so you can make a confident decision by the rules. And we're also coupling that with our Tuesday and Thursday live trading room. And so there you get to learn the why behind the what. So we're giving you the indicator, we're giving you the scan on how to find it, we're giving you the alerts of the ones we find, and every Tuesday, Thursday for 3 months, we'll be going live at 4 p.m. Pacific, 7 p.m. Eastern. It's also recorded for you, and it's a 1-hour session where we teach the strategies behind it. So you get to learn in live markets. It's not just a trading room where we talk about charts and chat about the market. It's actually there to teach. It's actually our 2 hours a week. We get to be live with everyone and go through winning trades, losing trades too. On Thursday, last week, I talked about a losing trade I did where I broken my own rules, and I was talking about, well, what do you do when you break your rules? Sometimes it's useful to learn from that perspective also, so you don't do it again. So all of that is included for $397. The indicator, the scanner, the 3 months of alerts, the 3 months of live trading room, and all of that for only $397. Okay, so I know we were running a little over time, so I'm not sure how many minutes I have left here.
Well, we have a couple questions, so
Go ahead.
let's go for it. Let's see. Well, a couple comments. First, Stanislav says, amazing, thank you. TW Pickett says, thanks. Maria says, thank you for sharing this with us. It's amazing work. Do you recommend primarily using your indicators on weekly, or can they also be used on daily? And I'm going to add, how about intraday? So there you go.
Yeah, I mean, you can absolutely use it on intraday charts. Let's just see if we can pull one up. Yeah, you can use it on the daily, the weekly. So let's take a look at something that I'm in at the moment. So this is just buyer beware. This is a speculative setup. It's, obviously it's a therapeutics company. It's lower price, and I do believe they report earnings tomorrow. So again, just full disclaimer, and I do hold this position. But so here it is on the daily chart. So you can see smart money divergence long before the first move, and then smart money divergence long signal again recently. Let's go. So what I like to do, one of the best practices of how I use this is, oh, sorry, we're on the weekly. Okay, great. So this is the weekly chart. So there you can see the indicator and the system alerting the smart money divergence potential shift happening on the weekly. And so when I'll scan on the weekly, and then what I'll do is then move on to the daily. So if we then go to the daily chart, you can see the daily signal then confirmed on the 29th of August. So what I love to do is to start with the weekly and then go down to the smaller time frame of the daily and confirm with that. And then, yes, if you wanted to go even further in and go down into, say, the hourly. So bring that up. So my default times on Metastock are slightly off. So as you can see, that's been a lot of signals firing off on the hourly chart. So as this thing has been basing, we've been getting lots and lots of indications of smart money divergence long, and of course, most recently, right here is as we turned at 180 before the push up to 220 here. So yes, you can use it on the weekly, the daily, the hourly, and my favorite way to do it is to use it on all three. Start with the weekly, down to the daily, and then time my entry all the way down to, say, the hourly. And if you're a shorter term trader than that, say on the 5-minute or 50-minute, you can certainly do that too.
All right, thank you. Thank you. And so the link for that is acornwealthcorp.com/meta, or you should be able to just click on the link that we've pasted out there. John, thank you so much. I appreciate you coming in.
Oh, it's an absolute pleasure as always. And thank you so much for all your participation, everybody. And Jeffrey, great to see you.
Oh, yeah. We'll see you again really soon. Thanks for coming in.
Thanks, mate.
All right, cool. Let me go ahead and do this. We'll just make a couple little changes here. Okay. And then, let's see, make me the presenter. Go ahead and show my screen. And we'll get right to it. All right, very cool. Real quickly, want to say thank you to Stocks and Commodities for sponsoring today's event. They've been a huge sponsor of us over the years. We really appreciate what they do. And thank you. We appreciate them as a sponsorship. We are, of course, Metastock, scanning markets, testing trading ideas, forecasting, real-time alerts, commentary, signals, all that stuff starts at $69 per month here in the US, $59 a month internationally. What we're doing today is if you do a trial, like if you pay for a month, we'll give you the second and third month for free. You can do that at metastock.com/conf promo. You can give us a call at metastock.com/sales chat, at least chat with us. Or you can call in at 800-882-3040. So real quickly, I hope everybody's enjoying the event. Let us know how we're doing. Make sure if you're watching us on YouTube to like and subscribe. It helps a great deal and we appreciate it. I hope you're enjoying the session today. In the interest of moving straight along, a good friend of mine, Jake Bernstein, is next. He's going to be joined by Brian Latta. I remember I used to live up not too far away from Jake, actually, and we'd do a lot of classes with the Silicon Valley Options Group. And he did such a really, really good job. He's been trading for a number of years. He started trading eggs, as a matter of fact, if I remember that story correctly. Jake, you'll have to correct me if I'm wrong. I like his setup, trigger follow-through method. So Jake, there you are. I can hear you.
When you say a number of years, being very polite.
It's been a few.
Last time we saw each other previous to San Jose, I believe, was Singapore, right?
Yes, correct. Let me go ahead and make you the presenter. I'll make sure we can see it. We've been all over the place. All right, so you should have a screen share. Is it you or Brian that's going to be sharing your screen primarily?
It is going to be both of us.
Okay.
We're working the same PowerPoint, so let me figure out the screen share here. Hold on one moment, please.
I'm here to help you if you need it. Kurt says, go SVOG.
Yes.
I'm not sure you remember Kurt.
Valley Options Group.
Yep.
Okay, let's show the screen. Hang on 1 second, please. And do you see my screen?
Not yet, but it usually takes a second or two.
Okay.
I'm watching though to see if it comes through.
It's not being cooperative.
Here, let's try it again.
Okay, there we go.
Okay.
There we go. And let me just get...
There it is. Yep.
Okay, just a moment, please. Here we go. I'm going to go full screen on this now.
Okay.
Okay, see the full screen now?
I can see it. Yeah, and I'll get out of the way. It's your turn.
I'm going to get my pointer. Just a second here. So, there we go. Just minimize the other thing. Just minimize it. Yes, for some reason it eliminated a line, but don't worry about it. Okay, so thank you very much for having me here, Jeff. Appreciate it.
Our pleasure.
Great job that Metastock is doing for so many years. It's been many years we've known each other. I'm joined today by Brian Latta, who is a great individual, great trainer, and really enjoying my association with him these years. And if I sound like I'm getting old, I really am, but it's a bad allergy attack I'm having today, so please apologize for the voice. So wherever you are in the world, whether it's today, tonight, or already tomorrow, welcome. Brian and I want to teach you some things today that are very clear, very specific, and they work. They're not subject to interpretation. So there is nothing that I will teach you, nothing that Brian will teach you that requires interpretation. It's all clear, consistent, it's based on numbers, and it's very specific. And a platform for technical analysis like Metastock is the absolute ideal way to do this because you can look at numbers, because quite frankly, that's really all we do. So I live in Santa Cruz, California, in the mountains, as Jeff said. I look out my window, I see the Pacific Ocean 1,500 feet down from here. It's very relaxing and certainly enjoyable. I love fast cars. I love looking at them. I love driving them. I love collecting them. I love trading them. I love the whole thing. Many times people come to my house, they say, oh, I love that fast car. What is it? I tell them what it is. They say, do you think I could drive it? I say, you want me to let you drive this very expensive car? No, I can't do that. Not unless you show me that you can drive this car, because I certainly don't want to get this car crashed up, and I don't want you to kill yourself driving this car. Trading is very similar. Traders want to do all sorts of things they don't know how to do, all sorts of things they shouldn't do, all sorts of things they don't have the money to do, they don't have the discipline to do, they don't have the knowledge or the patience to do. So one of the most important things in trading is finding what you're good at and doing it consistently, turn the crank and get the music. It's really very simple. So the bottom line is, you're watching television, you see an ad. There's a man sitting at a kitchen table in front of a computer. You can see his screen. On his screen, he's got a chart. He's got red lines and yellow lines and green lines and arrows and boxes and code, and numbers are flashing on and off. He's got all kinds of things going on. In the background, he's got 3 children. They're killing each other. They're throwing things around. They're molesting the dog. They're throwing sand all over the place. They're throwing their sandwiches on the floor. But the man, he's got his earphones on. He doesn't hear a thing. He's happy because he's trading. And you would think that he's making money. But in all probability, he's probably losing his butt because he doesn't know how to trade. But the brokerage firm would have you believe he's a happy day trader. The bottom line is, many traders lose money because they lack a number of things. They lack the discipline, they lack the methodology, they lack the philosophy, they lack the psychology, and they lack the ability. So the first and most important thing I want to share with you, and I'm going to let Brian introduce himself momentarily, is what we do is very simple or very difficult. If it's simple and it works, keep doing it. If it's difficult and it doesn't work, don't do it. Now, 2 speakers ago, they talked about commitment. Was it commitment or conviction? Talked about conviction. In order to avoid getting convicted of anything, we are going to give you the disclaimer. In other words, this is all for educational purposes, it's hypothetical, blah, 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 etc. You've seen it 100 times. No conviction here. So, first I'm going to introduce myself, tell you a little bit about me, make it quick. Been a trader for a long time, specifically 52 years. I've written books, a few of them, 43 to be exact. I have clients all over the world, and many major hedge funds buy their service and advice from me in terms of the statistics that I produce that they use in their trading. I've been on Wall Street Week, CNN, CNBC, blah, blah, blah. I've spoken at over 900 seminars and webinars and conferences all over the world. I've taught thousands of traders how to trade and so forth. So maybe, just maybe, I can teach you something today. Now, many traders are brainwashed into common thinking. The first thing you don't want to do as a trader is you don't want to think like everybody else, because common thinking gets common results. Common results means you're going to lose money. If what you learn about trading is ambiguous, if it's not 100% clear, that's the beginning of your losing adventure. You want to think and act objectively, and you can't think and act objectively unless what you have is objective. And fortunately, when you've got meta stock, you've got clear, specific rules, and you've got hundreds of indicators, which leads me to the other issue. There are so many indicators, you need to know how to use the indicator, and you need to know if it works. The only way to know if it works is to test it. And fortunately, we have the ability to do that because we have computers. So if you believe that buying breakouts to the upside is not profitable, you're like everybody else. The fact of the matter is that buying breakouts to the upside is very profitable and very consistent, just like selling breakouts to the downside. So if you're using trend lines for support, the question is, where are you going to put the line? Does it have to touch the line, be slightly above the line, be below the line? Or can you adjust the thickness of the line to make it fit? I say that jokingly. Many traders use unproven price patterns, for example. They say, oh, it's a Fibonacci number. The market has to stop. It's a Fibonacci number. Is there any proof to that? And so forth. Traders try to define overbought and oversold conditions without knowing what they are. So they look at a chart, they say, oh, the market's overbought. Oh, the market's oversold. You need to have a number, a specific indication of what overbought and oversold mean. If you don't have that, you're flying blind. I'm going to give this to Brian now. Brian, as I say, has been a friend and a business associate for a long time. He's going to introduce himself and say hello to you, and then I'll take it over from Brian. And then Brian and I will finish up together showing some expansion and contraction charts and the expansion contraction indicator. Is Brian there?
Thank you, Jake. I'm here.
So here's your stuff, Brian.
Yeah, and everybody can read through that. I'm certainly not going to read through it all again. If I had to boil it all down to what was the big difference, it was making a commitment to do the same thing the same way in a trading plan for at least 5 years. And at some point, you're just going to have to make that commitment because I do like one of the questions I saw from Paul, who was asking, what evolutions and impacts are you observing and the differences of markets over time? And that comes from having clear rules, tracking those trades, and using your statistics or your data to determine better rules. So we can learn to be adaptive. All that, as you can see with Jake's rules and programming, I just learned to follow the whole process and develop my own systems over time. So that's where we are right now.
Thank you, Brian. And Brian will be back shortly when we talk about some of the indicators that we've developed together. And let me say one thing with regard to what has changed. 5 years ago, I told people artificial intelligence is going to be the biggest thing ever, especially for traders. So word to Jeff Gibby and Metastock, I'm sure they're ahead of the curve. You need to develop AI tools for traders because that is where the real future is going to be. In fact, it's not just the future, it's the present. So AI is very, very much part of what we are going to be doing. We've already developed some AI indicators and we'll show how they work, but not today. Today, we're going to show you something else. So let's talk a little bit about discipline. People say, Joe, no wonder you can't make money trading. You don't have discipline. So the question is, where are you going to get discipline? How can you improve it? Is it going to come to you from a book? Is it going to come to you from a psychiatrist? Or are you going to lay on a psychiatrist's couch and say, I don't have discipline, doctor. What should I do? The doctor is going to say, you had improper potty training. If you had good potty training, maybe you'd be more disciplined. No, it's not going to happen that way. Is it going to come from magic mushrooms like the guy who tried to down that plane? No, it's not going to happen. Discipline is going to come from confidence. Confidence is going to come from knowing what you're doing. Knowing what you're doing is going to come from having something that's clear and consistent. So it has to be absolutely rule-based, no interpretation, no analysis. We're not going to look at a chart and say, well, it might come up to the 200-day moving average and then down here to this possible support area, then back up again to the 50. And then if it comes down again 3 times and bounces off this approximate level of support, we're going to look to be a buyer. We don't do that. Now, I am not saying that approach doesn't work. It may work for other people. It does not work for me. It has never worked for me and it never will. So what are we going to do? We're going to look at some very specific stuff. And if it's embarrassingly simple, so be it. It does make money. And that's the key, because we're all here today for the same reason, to learn how to make more money if we're making money, to go from losing money to making money, or if we're already making a lot of money to hopefully make more. So let's take a look. The sad truth is that nothing you're going to have here today or anything on Metastock is going to make money for you unless you implement it correctly. And the rules of implementation are very clear. If the rules of implementation for what you're doing are not clear, you have a problem. And if you don't have a problem, you will have one. So I'm a rules-based trader. and Brian has certainly helped me with that, and he's a rules-based trader as well. We do not interpret anything. So if there's anything we tell you today that you have to interpret or think about for more than a few seconds, something has gone wrong. Either I've been a bad teacher, you've been a bad student, I've been a good teacher and you've got a learning disability, whatever it is, it has to be clear. If it's not clear, you can always write us because we're available. So let's take a look. And by the way, I get lots of emails. You can read this while I'm talking. These are just a couple of the emails that I get. I get many more each week. In fact, I also get letters from people who have been successful who are very appreciative of it. But if you find yourself in the situation as these people did, good news is you're not alone. The bad news is if you keep doing what you're doing, it's not going to work for you. But the better news is we have answers and solutions. So let's go forward a little bit. And here's another one for you. And by the way, Jeff, I forgot. Will we be able to provide the PowerPoint for people if they want it?
Yeah, for sure. If you want to email it over to me, I can send it over to people. And the recording's available for free online as well.
Good, I'll provide the PowerPoint to you when we're done. So let's go forward. So I want you to think about this while I'm talking. All of these things that we have wanted, no commissions, low commissions, faster computers, trading software, fast order entry, fast feedback, fast order fills, courses, you name it, it's now available to traders. And the sad truth is everything that we wanted, we got plus more, and people still lose money trading. And again, I'm going to drive this point home. If you've seen my work before, you know what I'm going to say. It's all about having the proper paradigm, the proper structure, the proper model. So if you're going to be a gambler, the definition of gambling, taking risky action in the hope of a desired result. If you're going to do that, which is the same as trading, if you're going to gamble, do it correctly. The correct way to do it is with numbers and statistics, not with interpretation, because what looks like something on a chart to you may look like something entirely different to me. People have gone to war and lost millions and trillions of dollars and hundreds and thousands and millions of lives over interpretation. Do not interpret anything. It's got to be crystal clear. So we've got a lot of facts to show you, and we're going to share some of these with you. And I'm going to skip over this. You can look at this when you get the PowerPoint if you want it. But oh, by the way, in my spare time, I wrote a few books in case you're interested. These are day trading books. I've written about 35 other books, but not important right now. So solutions. Number one, trading model. If you've seen my work, you know the trading model. My trading model is called STF, setup, trigger, follow through. The setup is a pattern. Everything in the markets is a pattern. You know patterns from your work. Support, resistance, overbought, oversold, flags, pennants, reversals, island tops, island bottoms, you name it. Those are all patterns. Fibonacci is a pattern. Elliott wave is a pattern. Overbought is a pattern, etc. A pattern is a setup. It simply says, if this particular configuration or algorithm shows up on your screen, then something is likely to happen. If you look at most patterns on the computer and ask the question, does the pattern you're looking at predict anything? Does it have predictive validity? The answer most of the time will be no, it predicts nothing. So the first needle in the haystack is find setups or patterns that work. Seasonality works. Cycles work. Open, high, low, close configurations work. Typical moving averages of closing prices in the long run do not work. They have a huge number of incorrect trades. They have big drawdown, and even though in the long run they make money, in the short run they would lose so much money that you go broke if you try to follow them. So we need setups or patterns that work. Once we have a setup that works, that setup has to be triggered. In other words, will it work this time? if it has been 67% correct over the last 50 years or 30 years or 20 trades or whatever, what can we do to give us a higher boost of accuracy? Will it happen this time? For that purpose, we use a trigger, which what most people call is timing. The third part of the equation, follow through, which consists of two parts, actually three. Number one, where are you wrong? Number two, where will you be right? Number three, how will you maximize your result when you're right? If what you're doing does not fit into this paradigm, into this model, setup, trigger, follow through, chances are you're not making money, you're clairvoyant and you are making money, you're lucky and you're making money, whatever. But if you're losing money, take a look at what you're doing and ask yourself the question, does my methodology have setup, trigger, and follow through? And if so, are each of these conditions specific, algorithmic, and capable of being put onto the computer? That's what we need. If you don't have it, you better get it. So let's talk about something else. So for my trading, this is what I do. I always trade based on facts. I will never make a trade based on intuition or a gut feel. It took me 15 years to learn that when I first started trading. I don't believe anything until I see it myself. So if someone teaches me something, I want to see it working before I use it. To make money trading, I have to not care. And this one is very important. It's counterintuitive. What does it mean, I have to not care? It means I have to be able to walk away from the machine, not look at the chart and not think about it, not take my work home with me, not talk to people about it, not get nervous when it's not going my way. As soon as I start to care, I'm cooked. My goose is cooked. I like to take my loss mentally before I make the trade. My job is to manage risk. If I'm managing the risk part of my equation and I have a methodology that's even 60% correct, I will make money. Next, the law of parsimony. I want things to be simple. I want the simplest answer to the question. I don't have charts with all kinds of stuff all over them. I want the fewest amount of indicators to get the job done. I want to be a specialist. I want to specialize in what I do. I don't want to do everything. I just want to do a few things, but I want to do them well. And remember, last but not least, it's easier to follow the rules than it is to break the rules. Because once you break a rule, you don't know where you are, you don't know what you're doing, you don't know where you went wrong, you don't know where to get in, you don't know where to get out. If you follow the rule, it's either black or white or in between. That's it. And most of the time, it's going to be all black or all white. So remember, if you start following rules, it's going to be less intensive and work for you. So what do I mean by all that? Okay, so let's go here. Read this in your own spare time. You don't need me to read this to you. Okay. Just bear with me. There are three types of patterns, three types of indicators: lagging indicators, leading indicators, and concurrent indicators. What does that mean? A lagging indicator usually turns after the market changes direction. Lagging indicators are always late to the party. They're late to get you in, late to get you out. They're usually right 30 to 40% of the time, and in the long run, they may make money, but in the short run, as I said before, you are dead. You've lost your money, you've lost your confidence, or both. The leading indicator, so lagging indicators, moving average, closing prices, the 20 versus the 10, the 50 versus the 200. These are closing moving averages. Do not use them unless you're okay with a lot of money and you can withstand a lot of consecutive losses. Leading indicators. These are indicators that tell you ahead of time that something is likely to happen. A seasonal, a cycle is going to bottom at a certain time or top at a certain time. A divergence is a leading indicator. Prices begin to go in a certain direction, the indicator goes in an opposite direction, something's going to happen, and you're getting ready for it. Concurrent indicators, indicators that change with the market. Very simple. You want to avoid You want to avoid lagging indicators. You want to embrace leading indicators. Example, leading indicator, small trader sentiment. Look at this chart. A great big picture chart of S&P futures shown at the top. At the bottom, small trader sentiment. What does the small trader think is going to happen? When the small trader is very negative, in other words, the bottom line, the green line, 20% of traders are bullish, 80% are bearish. The top line, 80% of traders or more are bullish, 20% are bearish. So look what happens. Right over here, before this major low, the small trader is extremely negative. Wrong. Over here, they're very bullish. They think the market's going to go higher. And guess what? They were right for a little while, but then they were dead wrong. Over here, they were very negative in advance of one of the biggest up moves in the history of the market. Over here, very bullish, market goes down. Over here, very negative, market goes up. And not too long ago, in early 2023, the small trader was very negative. And what has the market done since then? It turned around and it's gone up. So small trader sentiment is a very important indicator. And you can see how it looks, for example, on the monthly chart of gold. Take a look at the chart as I speak. Extremely low sentiment, market goes up. Extremely low sentiment, market goes up. Extremely low sentiment, market goes up, and so on and so on. So try and be aware of what the small trader is doing. How do you know that? There's a number of ways. One of them is called the Daily Sentiment Index, available at my website, jakebernstein.com. Or you can monitor odd lot short sales, or you can monitor put call ratios. These are all leading indicators of small trader sentiment. And of course, the crude oil, there's the top in crude oil right over here. And isn't it interesting that the top in crude oil was accompanied by the strongest bullish sentiment in a number of years. And this bottom over here, and this top over here, and this top over here, which we didn't remember to put in, and so forth. So we're not economists. We're not trying to predict the economy. All we want to do is to predict price, and that's all there is to it. So another methodology, use seasonality. If you took a survey and you asked the question, has there been a strategy you could have used prior to all major U.S. holidays? Yes, that was explained in the book by Art Merrill, Merrill, one of the best books ever written about the market. It's called The Behavior of Prices on Wall Street. So if you had bought the Dow Jones on the day before the Christmas holiday and gotten out the next day, you would have been right 69% of the time, all the way back to the 1950s. And Merrill went even farther back to the 1880s. This is the one that's coming up, the Thanksgiving trade, which is explained specifically in Merrill's book. Let me show you something else. Here's a seasonal chart of the Dow Jones. We've taken every year of the Dow Jones back to 1901, and we have made the low of the year 0, and we made the high of the year 100. In other words, we've detrended the data. So this shows the typical Dow Jones year for the last 122 years. Look at the consistency. This is where we are right now, right over here. And this is what's just beginning. At the bottom of the screen, we show the percentage of time up or down. But remember, just because the market has been up 60 to 70% of the time during these last few months of the year does not mean it's 100%. Can we zero in on this more effectively? Yes, we can go to a website like seasonaltrader.com, and we can ask the question, show me the exact entry date, the exact exit date, and the percentage accuracy. This chart shows, and it's as I said before, I'm a numbers guy, buying the Dow Jones end of day on the 26th of October, getting out on the close of trading the 10th of January with a 15% stop loss close only, has been right 83% of the time. An amazing figure considering how many years it's been. Let me go forward. And by the way, Jeff, when is our ending time?
Hello. I'd say you probably have, based on till about 10 after, based on how
Very
behind
good.
we are right now.
I don't want to jip Brian out of his time. So
For sure.
you can look at short-term trades, for example, S&P, January 13th through January 18th, a specific number. Here's the percentage accuracy, the average profit, the average loss, all the statistics that you need, plus a visual of the statistics showing what it did. So that's what I mean when I say specific, clear indicators. We also like to use the moving average channel, which is available at Metastock, where we use a combination of 10-period simple moving average of the high and an 8-period simple moving average of the low. Note, these are not closing moving averages. These are moving average high, moving average low, 10 high, 8 low, and we use a specific pattern that occurs with Williams accumulation distribution and its moving average. So this is very clear, very specific. And if 100 people looking at this independent of each other can't reach the exact same conclusion every time, then as I said before, either I taught it wrong or you don't understand it. It's totally clear. Using this methodology, we notice some very specific patterns developing. So for example, prior to a top, the width of the channel, the distance from the high to the low of the channel, becomes narrow. Prior to a bottom, the moving average channel gets wide. And so we have a pattern that we can look at, and we've been able to take that pattern with Brian's help and put it onto a methodology called expansion contraction. An expansion contraction chart looks like this. So we've been able to take the moving average channel right over here, 10 high, 8 low, and Williams accumulation distribution and its moving average, and convert the whole thing into a more meaningful indicator that's either red light, green light, stop or go, so you don't have to think about it too much. What I'd like to do is bring Brian in now and have him show you some details of the expansion contraction so that you get an idea of it. We don't have time to go into the whole thing, and it's not going to be the kind of a thing where you're going to have to pay $997 for it. That's not the case. I just want you to see how it works so that you can understand the consistency, and I'll jump in from time to time and explain my view of it with Brian. So Brian, it's yours.
Thank you for that, Jake. Again, you can see on the terms here, and if you want to continue to work your way forward, Jake, again, expansion contraction was built on what Jake said, we're expanding moving average channel characteristics and contracting, hence the name expansion contraction. So, and you can see on this chart, we're at the very bottom where that indicator does turn green, the two parts, the short-term red and green line and the longer-term cone or cloud in the background, gives us some characteristics of swings, short-term moves up and down, and the trend, long-term moves, and you can see it's very stable.
So Brian, the lines that you're referring to are these thinner lines in between, like this one here and this one here, right?
Correct.
And so when they cross, they indicate a change in the short-term trend, whereas the bigger trend is indicated by this bigger cone right over here, correct?
Correct.
Okay, go ahead.
So basically back towards, it appears to be the 19th of August, we would have had a buy trigger that is still true today. It would have given you an opportunity to take a long trade as well as be a buyer at or near support, which Jake defines as the lower moving average channel line.
That's right, and you can see the beauty of this methodology. And by the way, this will work in any time frame. It's not perfect, but the bottom line is this: the big money is made in the big move, and that's where the third part of the equation comes in. Setup, trigger, follow through. The follow through part is right over here, where it will keep you in a trade for a long time. And because it's a very forgiving methodology, it will give you opportunities to get in at the bottom of the channel support. And of course, the methodology comes with a specific first profit target and stop loss. We'll go to the next chart, Brian.
Thank you, Jake. Of course, this is showing with the red and the green arrows how price expands on the uptrend with the green arrows pointing higher, and contract slightly into a weak uptrend where there are red arrows. A weak uptrend is evidenced by the green cloud or cone in the background, but the short-term lines have started dropping. This just helps us identify support in an uptrend that we'd still prefer to be a buyer at. This chart is the bearish example. You can see the longer term arrows are red as we continue to go down. Trigger looks back towards the 29th of August is still in a downtrend. If you hadn't taken the original trade, you'd be a seller at support, of which there were several opportunities to either get in later or add to a trade.
You mean seller at resistance, right?
Correct. The upper blue line is resistance.
Correct. So again, I want to emphasize the important consideration here. Traders love short-term trading. They love day trading. Fine, no problem. But the bottom line is, even if you're a day trader, you have to be in for the big move, even though you're forced to be out by the end of the day if you're a real day trader. But the most important thing is, if you're not getting the big moves, you're not going to go anywhere in this trading business. Never. Let's go to the next slide, Brian.
Again, this example is showing you with the green arrows pointing up, the weak bear areas where the trend was still down, but price was in a short-term move higher, as evidenced there by the green arrow showing short-term swings up and down in a longer-term trend.
So these are some older charts. What I'd like to do is go on to some other charts. So here's another one. And again, you can see the consistency of this move. It basically caught the entire move. And of course, if you didn't have the discipline to keep the trade or to buy the bottom of the channel, it gave you numerous opportunities to buy in at the bottom of the channel. And again, specifically because the methodology has clear, consistent rules associated with it, you always know what to do. And here is the same chart. Let's go to this. Go ahead, Brian.
In this instance, this is showing a trend reversal far left where there was the green cone in the background evidenced by the green arrows rising. The market turned bearish, there we go, in mid-August or towards the late third of it, and turned into a downtrend. So we can clearly see trend reversals. As I said, 30 tradable characteristics in here are just too much to go through on this webinar right now. But it has been tested long-term and in short-term markets, and it's just very accurate within a few bars of tops or bottoms and identifying long-term trends. So again, they start shorting another chart in here where the cone is showing some strong bull movements, turning to bear movements, and far on the right side, where everything has contracted very narrow, right? That is just showing either not trending or a consolidation pattern that broke out to the upside, gave us a buy trigger.
Yeah, and the bottom, the bottom line here is this. It's not rocket science. It's either green light, red light, green light, red light. That's really all there is to it. Let's go to the next chart, Brian.
Okay, this chart really just shows the indicator without any markings on there, but we are looking at the E-mini S&P, and currently over the last few days, that pattern was bearish.
Right, and these are still older charts. I had Jeff make some newer charts for me. Let me get to those examples.
Of course, as you pull those up within a second, I'm going to say whether it's bullish or bearish, just based on the characteristics of the cone. And again, that is very simple in that one, and we'll give you some longer term trades. And sure, we'll get some sudden reversals and the markets will stop us out pretty quickly. There isn't any single indicator that eliminates those sudden reversal patterns. But the idea is to be clear and objective with just say Jake's rules of setup, trigger, follow through. Have made this consistently profitable, trading in the top weighted stocks of strong trending sectors.
That's correct.
Bullish.
So here, bullish, right?
Yep. Bearish.
Right.
Bullish.
And you can see again, the beauty of the indicator is that even through thick or thin, it's going to keep you on the right side of the market for a long time. But then again, most people cannot hold a trade unless it's a winning trade, unless it's a losing trade. People love to get out of their winning trades very quickly, but they love to keep their losers until they grow hair on them, as they say. Let me get to some current charts, right? Here you go.
Bear.
Is a chart of the U.S. Treasury bonds.
All bear, right?
Be bearish, absolutely. And again,
Right, so you're already in, or you're a seller at resistance. We just hit resistance, right on that last bar.
right over here.
That's it. So that's a bear trade.
And these are all very clearly resistance trades, consistent with the trend. And if you wanted a swing trade, easy. You would sell the top of the channel, get out at the bottom of the channel. Sell the top of the channel, get out at the bottom of the channel. There are many things you can do with the tool as long as you know how the tool works. One thing we didn't address, Brian, is the fatness or thinness of the indicator. So in other words, when the expansion contraction gets very wide, like so, as opposed to very narrow, like so, what does that mean?
When the range expands very wide, it exceeds its levels of being considered to be overbought or oversold. So the red cone in the background, very wide, would be oversold. We're at or near support. Or if we had a green cone, right, would be at or near resistance, overbought.
Right, and we don't even have to think about those terms because if we're just red light, green light, that's all we need. Let's go to the next one. And again, a current chart. This is the S&P.
Sorry, Jake, the contracting markets are showing weakness counter trend. So the idea there would be, are we still in a counter trend corrective pattern on the right half of the screen as price traded higher? And the channel started rising closer towards September 12th or so, where the moving average channel was rising, Jake, straight up.
Right over here.
Right.
Correct.
How do we know that that is to go long or go short? We are seller at resistance and a defined downtrend. The cone is red. All of this area is an area you would prefer to be short at.
Right, and there'll be specific stop loss and target associated with this trade, as it is with every trade. Otherwise, we don't do it. Let's look at another one.
Bearish.
Japanese yen has been a huge bear trend for a long time. And again, I want to emphasize every single time, without fail, that we have come up and touched the top of the channel in a bear trend has been an opportunity to sell. So you can't say that the methodology doesn't give you many opportunities. It most certainly does. You just have to make sure that you're there to see the opportunity and then to take advantage of that opportunity. Here again is the euro currency versus the US dollar, the same basic situation. Every test to resistance, top of the channel, as defined, the 10-period simple moving average of the high has been an opportunity to sell. And here's one that's been a little more difficult, Amazon.com, which has been bearish since all the way back here and has been a sell at the top of the channel every time in terms of the expansion contraction indicator. Let's do one more, Brian. This one,
that had just triggered a buy.
Yes, it did. It just triggered a buy right over there. The last
I was looking to see if that was current date, but it appears to be a few days ago. But again, we just want it to be clear. And Jake's insistence on clear rules of when to get in and when to get out at a loss and where to take profit helped me immensely in just being systematic.
Now, here's an interesting one. Alcoa has been bearish for days and days and days, all the way back to here. But if you look at seasonality, you will find that from mid-November to the end of the year has been one of the strongest periods of time of the entire year on the upside for Alcoa. So what would I be doing now? I would start looking for timing indicators to buy Alcoa. And then when the next one comes along, it will probably be an indication not only that the cone has bottomed, but also that Alcoa has bottomed. We'll see how that plays out. And here's another chart for you. We'll go through these rather quickly because we're running out of time.
Bullish.
Yes, it's so easy, Brian, that even you and I can do it. So this
you want to know in a split second because your first observation, right, or blink really is true. You don't need more than that.
That's right. And as I've said many times today and in the past, the bottom of the channel is a beautiful support. It's not 100%. We know we don't do anything that's 100% because we don't have that. But the bottom line is very clear. If you're dedicated to the methodology, it will treat you well. Here is Bitcoin turning bullish all the way back here and continuing bullish not only on the moving average channel method, which would be a buy here and here, but also on expansion and contraction, which is a buy and remains clearly bullish. So here is the T-bond.
Yep, bear. The entire chart. Bull.
This is the goal, of course, not surprising. The goal turned bullish right over here before this big move will achieve all of its profit targets. And so let me do this. I'm going to scroll through these a little quickly. If you need to reach us, Brian, email address. We have a website, expansioncontraction.com, where you can see the indicators. There's also a couple of webinars there. I strongly suggest you attend my annual forecast by clicking this link. I think you're going to get a lot of information about it, about the coming year. Very clear in terms of cycles and other leading indicators. And Jeff, we got you back on schedule.
Did, and I, to be clear, you could have taken a little bit more time. But
well, I do have a comment if I could interject for just a second.
For sure. Do you have the actual link for that though, Jake? We can't get to they can't click on the link for the 2024 annual forecast, but we could put something out.
I'll get the link.
Okay. Go ahead, Brian. I didn't mean to cut you off.
Oh, no problem at all. No, because it was just back as I was explaining at the beginning, what do most people miss? Having clear rules of when to get in and actually following those rules all the time, tracking the results. And that database of results is how you make your system better. So hopefully that's either one or two or three things you're missing. Clear plan, track everything, test the results. That's your process from now on. And Jake's clear rules have made it sure easier for me.
Cool. Jeff, if they go to jakebernstein.com, there's a sign-up link for the annual forecast there.
Okay. I'll send that through right now. Also, here's a really good question Paul had from a little bit earlier. He's like, over the decades of markets and trading continue to evolve. What are the biggest evolutions and impacts you've seen since you started trading? And how do you adapt to them?
Well, the biggest one now would be artificial intelligence, and there's no way to know how to adapt it because we don't know for sure how it works or how well it works. Other than that, for me, the biggest change has been getting my orders executed immediately, promptly, efficiently, without slippage, and certainly not having to deal with the broker.
And cheaply, right?
And cheaply. Thank you so much. Yes, and cheaply.
I will say in there, though, with the impacts, have they made any changes for me? Nope, the rules are the same. No impact.
It's not changing the rules. It's just made the rules look a little bit better.
Jake, it's been a great pleasure to work with you. Appreciate all the time you've spent with us today and over the years. And Brian, it's also thank you for joining us as well today.
Thank you, Jeff. Appreciate it. Thank you, ladies and gentlemen. Have a great afternoon, evening, or day. And Brian, thank you so much.
Thank you, guys. All right, very cool. Let me go ahead and show my screen. There's a couple things I want to point out before we get over to Larry, who's our next speaker. A lot of what Brian had to talk about was the JBXC indicators. And if you come up here onto our website, you can actually get a free copy of those indicators that he designed with Jake's methods in mind for free. So I just put the link in the chat, but right down here, you can just download those indicators. They're totally free. They do require Metastock, I think 18 or higher to use. And yeah, 18 or higher to use, but they're just absolutely free for you. So go ahead and take advantage of that. Get those. They're a great little indicator package. One of the things that I wanted to highlight was actually one of Jake's products that we designed with Jake. I'm going to turn on my lights, but it's called the Setup and Primary Triggers Toolkit. And this is something that we've had out for a couple of years. It's a very, very inclusive collection of the systems that Jake has kind of talked about in his books and taught about over the years. In it, there's 33 commitment of trader systems for futures and trading futures. So if you're interested in that, but there's also 6 technical systems that follow his setup, trigger, follow-through mentality. So these also have full integrations in Metastock, which means you get buy and sell signals, you have commentary, you can go in and run scans for them, of course, and they're very, very thorough. So here's a copy of the technical systems that are included. You've got this 15-minute open range breakout. You've got the 5-bar moving average channel pattern, the MAC with ADMA, the momentum moving average, the power momentum, and the stochastic pop. And these systems, the thing that I really like about them is, like Jake says in his class, they have to be objective. Together. Normally they're available as a $499 one-time cost. At the conference, as part of our conference promotion, you can actually get them for $349. We are going to actually include a trial to Metastock for free. If you get that, we'll include a 30-day money-back guarantee on them as well. And you can do that. You can give us a call at 800-882-3040. You can visit us online at metastock.com/conf promo to do that. And you can also chat online with us at metastock.com/sales chat. So, Paul, very good question. Thank you for sharing that with us. But yeah, take advantage of that. 800-882-3040, 30-day money-back guarantee. If you don't have Metastock, you can find out why it's been rated #1 30 years in a row. Metastock.com/conf promo, metastock.com/sales chat. So there you go. All right, moving along. Let's go ahead and say thank you to Stocks and Commodities Magazine for sponsoring the events that we've been doing. Somebody asked you a little bit earlier in the chat how long we've been doing the actual conference and the different summits and that kind of stuff. So the multiple day sessions that we've been doing those for about 3 years. We started them in 2020, but we've been doing actually single day sessions where we bring in about 8 different speakers and talk about techniques and stuff like that for about 10 years. And Stocks and Commodities has been an absolutely great sponsor. They've supported us with all the events that we've done. They've sponsored them since day one, and we certainly appreciate that. It's a great magazine. They have 17,000 different trade articles, 1.3 million subscribers. They've been doing it since 1982. So thank you, Stocks and Commodities, for sponsoring us today. Of course, we're Metastock. I'm going to talk a little bit more about Metastock as soon as Larry's done. But I want to talk, let's go ahead and get straight over to him. Larry he wrote Options as a Strategic Investment. It's considered the Bible of options traders. Very, 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 that's like 5 Aries. Very good, 6 now. Very good options trader. We love having him in here. We love bringing them in here. I'm interested to see, because it's been May since I've actually kind of seen what Larry has to say about the markets. And so I'm interested to see what he has to say. So Larry, how are you doing today? I see your mic's already on.
I'm good. Jeff, you hear me all right?
I can hear you great, yeah. And I just sent the presentation over to you, so it should be asking you if you want to share your screen.
All right. You see that okay?
I can, yeah. It's all nice and animated too.
Right.
Very fancy.
You thank PowerPoint for that.
Yeah, I know we're starting a little bit late, Larry. I'm next, so don't worry. Take your time, and it's your turn. We'll let you go.
Okay.
Before I do, though, Larry is the Mr. E.F. Hutton of the markets. This is from William in chat. When Larry speaks, people listen. So I'm gonna shut up and I'm gonna listen now.
Okay, thanks. So we're going to spend the next hour or so talking about the indicators, current indicators. It's a very interesting market, I think, right now. And I'm also going to talk a little bit about seasonality, which Jake was talking about there at the end of that last presentation. So just a little background. When I started the company, we were this research company over 30 years ago. We were selling research and recommendations, data, that sort of thing. But then around the financial crisis in 2008, we had some pretty good calls on the market. So in response to those, we started a money management business. So we're both a CTA on the commodity side and an RIA on the stock option side. And we just basically do a very specific sort of option-oriented strategy. And then we also do option education, mentoring, webinars like this, etc. I'll come back to this later, but the PDFs of this presentation, well, the reason it's plural is because one is in color and the other is in grayscale. which won't kill your printer if you print it out. But at that website there, optionstrategist.com/Metastock, you can find the PDFs and also some special offers. I'll come back to those later. So the four main indicators we look at for the stock market, of course, number one being the price of the market itself, SPX. Then we also look at equity-only put-call ratios and other types of put-call ratios. Market breadth, where we have an option-oriented approach to that. And then volatility, basic volatility indices, and also the volatility derivatives that are available for trading. So it's interesting right now, most of these are lining up as buy signals, except for the chart of SPX itself. And I have seen in the past when that happens, you really don't want to jump ahead and assume that SPX is going to fall in line with the other indicators. But anyways, we'll work our way through this specifically. There's two really important rules that I adhere to. One is that oversold does not mean buy. So this last time when the market went down from late July through about a week ago, we were oversold several times on the way down, but the rallies were weak and we kept going lower. So you really need to wait for confirmed buy signals. And then there's a companion saying, and that is that overbought does not mean sell. So we're already starting to see some overbought indicators, but they haven't issued any sell signals yet either. So here's the 2-year chart of the S&P, and well, there's a bunch of lines in here that really is fairly simple. The blue lines are the trend. So we were trending down from the beginning of 2022 through really October of that year. And then we started here in October, started to move higher, and we're still sort of in this uptrend, I think, although we did come all the way down here. So there was a less steep uptrend here that was already violated. But in any case, the market stopped trending down and began to attempt to trend up around October 22. The loss in that bear market was 27%, which is a pretty substantial bear market. Most recently, we've backed off the highs. We've backed off 10% at the lows on October 27th. We had backed off 10.4% from the highs of late July. So significant numbers. If you can, carve out a good piece of that, there's certainly things to trade within there. The red lines are resistance areas, the ultimate one being the all-time high at just above 4,800 set in late 2021. And then this first rally back there in March, April of 2022 is also an important level. You can see we almost reached that last summer, then fell back from there. If we take a little bit closer look, this is the current chart, 1-year chart, but really on the right-hand side is what I'm talking about now. And you can see the downtrend lines that are present there. That's the lower highs and lower lows. And once you have a series of lower highs and lower lows, you're in a downtrend. You can, try to couch it any way you want, but it is a downtrend. So we're still in that downtrend. You can see we've not penetrated through on the upside. Now, the purple circles there all identify gaps. So first there was this large gap left after the FOMC meeting in September, and we haven't filled that gap yet. We came close here, but didn't really fill it. So right now we're looking at filling that gap would be just above 4,400. Breaking through this resistance here in the October, mid-October resistance is also about 4,400. And then finally, you can see the downtrend line here is also about 4,400. So guess what? 4,400 is important. And we haven't broken through there yet. This morning, the highest we got was 43.72. So we're still, in this downtrend zone. And that's important. As I said, the S&P chart is our most important indicator. So I wouldn't really want to get wildly long until that downtrend line was broken. So this just sort of summarizes, I guess, what I just said. We've got the downtrend. We fell down to the lower bound of the downtrend. It bounced off of there, and now we're looking at this heavy resistance at 4,400. When the S&P is trending, we usually carry a core position and then trade other positions around it. So we've had a core bearish position since early August, and we've traded many other positions around. We're still holding that core position. Right now, it's out of the money options, but that can change quickly too. So another thing we do with an S&P chart is we draw Bollinger Bands on it, but they're slightly modified. When John Bollinger invented Bollinger Bands, he used as the definition of volatility, of realized volatility, the standard deviation of closing prices. And while that might seem logical, that's really not what the math guys use. So we're sort of constrained to use what Black-Scholes does, Black-Scholes being the main option model for pricing options. And in Black-Scholes, they use the standard deviation of daily percentage price changes. So it gives you a slightly different number. We plot the 3 and 4 standard deviation bands. When the market moves outside of plus or minus 4 standard deviations, that sets up a trade. When it comes back inside, we have the trade. So here's the current chart of this. And on this graph and most of my other ones, a red letter is a successful trade. So this top band here is plus 4 standard deviations. The one just inside is plus 3. So you see we came outside 4 standard deviations here and then went back inside 3 there. That gave us a sell signal, which was completed by reaching the minus 4 standard deviation band a few weeks later. So we have a very long track record on this, but on our website, we've been trading it in the option strategist newsletter for years. But recently we've had 2 failed buy signals. Very rare to have 2 failed signals in a row, but we did. And now we just got another 3rd buy signal here. You can see we came outside last week in October, came back inside here, and that was a buy signal. I believe it was on October 31st. So that's operating on a buy signal now, and it's shooting for the upper 4 standard deviation band, which in this case is right around 4440, right here. So when you're using a number of indicators, of course, some agree, some don't, but that's the point where we try to assess the major trend in the market and then trade these other indicators around it. By the way, if you like that approach, we actually have that's just a review of what I was saying. But if you like the approach of these Bollinger Bands or modified Bollinger Bands, we have a system which we call Mcmillan volatility bands, which we run on every stock, index, futures, ETF every day, and then we notify you or subscribers. We notify subscribers of the setups that are taking place in those various markets. And just recently we had a buy signal in the consumer products area. A lot of those things have been, sold off very sharply in the last month. And so that had its own MVB buy signal. All right, so enough about the S&P chart. Let's move on to put-call ratio. So put-call ratios were invented as a contrary indicator by Marty Zweig back in the 1950s. I'll get more into that in a second. We use the equity-only put-call ratio, that's all stock options that trade, as our indicator for what the broad market is going to be doing. So I'll show you a chart of that in a minute. What Marty determined, in those days, he would get option volume from the ads that the put and call dealers ran in Barron's on Sunday. And he added up all the puts that traded, add up all the calls that traded. He soon realized that if there was a lot of put buying going on, especially in those markets, the stock market then went up. And he also realized that if there was a lot of call buying going on, then pretty soon the stock market went down. So it's a contrary indicator, and trying to determine what too much call buying and too much put buying is of course, the crux of the matter. So we do it this way. The let's say it's IBM. At the end of the day, we sum up all the puts traded in IBM. Separately, we sum up all the calls. We divide the two, and that's the put-call ratio. So since puts are in the numerator of the fraction, an increase in put buying or put trading will make the ratio go higher. But when is there likely to be an increase in put trading? Well, that's when the stock or the underlying is going lower. So they move opposite to each other. The same thing can be confirmed with the calls. Calls are in the denominator of the fraction. So when the denominator of a fraction increases, the fraction goes lower in price. And of course, when is there likely to be heavy call buying? Well, that's when the stock goes up. So again, moving opposite. We keep a 21-day moving average just in case there's something to Fibonacci. And we post about 1,600 of these charts on our website every day in an area called the strategy zone. It's a fairly low-cost area. And there is some analysis as to new buy and sell signals emanating from these charts. But how do we determine if there's a buy or sell signal? So here on all of our put-call ratio charts, and I would suggest any ones that you are using, you should plot the stock price and the put-call ratio together because they do have a relationship. So in this particular case, the stock is falling, and as the stock is falling, people are buying puts, making the put-call ratio go higher. Eventually, the put-call ratio forms a local maximum. It begins to roll over and go back down. That is a buy signal for the stock. So now the stock is going up. As the stock is going up, people are buying calls. That forces the put-call ratio lower until eventually it comes to a local minimum. And a local minimum in the put-call ratio is a sell signal for the stock. So you would like to see this inverse symmetry existing. If I'm taking a trade, I'm going to show you some charts in a minute. If I'm taking a trade, I want to see that this has worked in the past and recently in the past. The put-call ratio can be distorted by certain fundamental things such as, takeover rumors, even dividend trading, dividend-based trading, that sort of thing. So this is not a current chart, but on the top is the S&P 500, and the bottom is the equity-only put-call ratio, the one that I said we use for determining where the stock market is going to go. And you can see the inverse symmetry that exists here most of the time, and in which case, that's why we use this ratio, because it has the inverse symmetry to the S&P 500 index itself. So here's the current standard ratio. And you can see that on this one, we pretty much every significant local maximum we mark as a buy signal, every significant local minimum we mark as a sell signal. There was a great sell signal here at a very low level. 60 just means that 60 puts were trading for every 100 calls. But this sell signal was a local minimum. And of course, that was what coincided with the sell here. Now, this ratio gave us a little bit of a premature buy in early October. It's sort of since resurrected itself. But I was not happy that I thought this ratio came in a little bit early. But it's not the only ratio we use. As computers came along, we were able to do more complex calculations. And so moving beyond what Marty Zweig had done originally. And so we can calculate the weighted put-call ratio, which measures how many dollars are being spent on puts versus calls. So in this particular case, what we do at the end of the day, we take the option closing price multiplied by the option volume that traded that day, and that's the dollar volume of that option. Now, we could do this on a tick-by-tick basis. We tried that for a while. It's pretty expensive, pretty time-consuming, and it didn't give us any better results than doing it this way. So let's say it's IBM. We do that for every option. We multiply the option's closing price times its volume. We sum that up for all the puts. Separately, we sum it up for all the calls, divide the two, and now we've got the dollar-weighted put-call ratio. And so now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. Pretty much the signals come in a very similar spot. You can see here in late July or early August, we got the local minimum. That was a sell signal. However, this one, despite a little head fake there, kept on going until just last week. It began to roll over just a little bit. Now, we have a computer analysis program that kind of works like a chess playing game. It forms a tree of possibilities. It works its way down the chess tree of possible moves, in this case, put-call ratios. So when this was happening, the computer program said, no, that's not a buy signal. That's not a local maximum. It's going to go higher, and it did. It's saying the same thing right here now, which is why I have a question mark here instead of a buy signal. And so I'm not sure how things are going today. Today, the market is actually up a little bit, but internally, it's really doing pretty poorly. On the New York Stock Exchange, there's 800 advances and 2,000 declines today. So the market's not doing so well. So who knows? This could start to go back up here again. But soon, we'll get a designation from the computer program itself. I found that relying on the computer for this is a lot better than just making a guess of my own. There are other put-call ratios. So one is the CBOE equity-only put-call ratio. That gave a buy signal back in also early October, as the standard ratio did. That's the first buy signal that indicator has given since early March of 2020. Now, if you remember March of 2020 being the disaster that it was, the bottom occurred more in late March. So that signal was premature, but again, it was this time. And then also the total put-call ratio we pay attention to, and that's all stock and index options that trade. That gave a buy signal, but it already reached its target. So that one's out of the picture right now. But in general, I would still say this is a mixed picture because that weighted ratio has not rolled over to a buy signal. But in any case, when we get a signal, what do we buy? Well, we trade SPY options for these broad-based SPX type signals, and we trade slightly in the money options. The delta of a call option ranges between 0 and 1. 0 means the call doesn't move at all when the stock moves, and 1 means the call moves exactly along with the stock. So the lower the call's delta is, the more speculative it is. It's an out-of-the-money call. It's not really all that responsive. We're in the business of trying to predict where the underlying is going. I don't want to be in an option. I don't want to be right about the underlying and then be in an option that loses money. So that can happen with time decay, but at least, I've got my delta to help me out. So typically when we go to buy an option, we'll buy a slightly in the money S&P or a SPY option, and that option will have a delta, let's say 0.7 or so. If we're buying an at the money option, which we'll do in a little bit longer term trade like a put call ratio, then an at the money option has a delta of about 0.55. That's a call option. So we're in the game. If the stock, the underlying moves in our favor, the S&P moves in our favor, we're going to be making money. On TV, you see so many times they'll spread an option. They'll say, we'll buy a call spread or buy a put spread. And they always seem to couch it as it has less risk. It doesn't. But on the other hand, it doesn't really make any sense because what you're doing, well, the call spread works like this. Right? Let's say you're bullish on this stock and you buy a call at this strike. Then when they want to spread it, they'll sell a call at a higher strike. Well, what that does, it cuts off your profit potential once the stock reaches that higher strike. Well, most of the time, that's a bad idea to cut off your profit potential. Only if the options are really expensive does it make sense. But here's a comparison picture. The red line is if you just buy the call, and the black line is if you buy the call and also sell an out of the money call. And as I said, typically people will say, well, there's less risk. Well, what they mean is you're spending less dollars. The risk is the same. The risk is 100%. Your broker will ask you to put up 100% of the possible loss on a call spread or 100% of the possible loss on a call purchase outright. So the risk is 100%. You can control how many dollars are in the trade, but to say the risk is less is really false. So what we typically do, there's two, if you're spreading, I still want to make sure I'm going to make some decent money if the thing moves in my favor. So one thing you can do is widen the difference between the strikes in the spread. So right now, if we're trading SPY, I'll make a 13 to 15 point difference in the call strikes. And if I'm trading puts, we're about 30 points wide right now. Right now, VIX is back at a relatively lower level. And when VIX gets higher, you can widen these things out to maybe 20 points for calls and 50 points for puts. But in general, you'd always want to have, in SPY terms, more distance between the put strikes and the call strikes because of the skew in the implied volatilities. Second thing you can do is roll if the short strike is hit. What do I mean by that? Let's say this morning, perhaps you're bullish, you bought a SPY 435 call. Those are trading, I believe, around 9. And you sell a SPY D's 450 call. I think those are trading around 2.5. So you didn't want to spend the 9. You'd rather spend 2.5. Maybe you can buy 3 instead of 2, whatever. But now, what I mean by rolling is, let's say next week SPY trades up to 450. It hits your higher strike. So now what you want to do, you're almost out of profit potential now. There's not a whole lot more past 450. Remember, the call bull spread cuts your profit off at 450 in this particular case. So what I would do is sell out that spread, take my profit, and buy a new one, using 450 as the lower strike and keeping the distance still the same at 15 points. Sell a 465 call for the upper strike. So in our newsletters, our speculative newsletters, this is what we do. And we're very specific about how often to do this and when to do it and why we're doing it, etc. In any case, let me just, before we leave the topic of put-call ratios, let me show you some individual put-call ratio charts. Now, in the individual charts, we only take the extreme signals. So even though this is a little local maximum here, which would technically be a buy signal, we don't take that. Even though this is a local minimum, don't take that either. We're only looking for the ones on the outside of the range where it's been in the prior 600 days. So you can see here, there was a local maximum back here, and you can't see back past what was happening in earlier 2022, but that was the highest, so that was actually the 100th percentile had gotten that high. So if you bought in there, you had a pretty good trade going on. So now we just had another one of these. We formed a local maximum, not quite at that level, but very high, more than 95th percentile of all points looking backwards. And so we just bought these calls on HOLX. Similar CarMax, you can see here the extreme signals, the buy signal about a year ago in October of 2022, right here. It was a short-lived one, and later on kept going some more. We probably would have only just caught that little bit there. This one, much stronger buy signal. Now we've got a new one, just occurred here at a very high level on a high percentile of these data points. So we just bought calls on that. H&R Block, this is the opposite situation. The long rally in H&R Block persisted through this summer, even though the stock market's been backing off quite a bit. This rally is going on quite a ways. As a result, it forced the put-call ratio way down here. People were buying calls all the way down, and now it just popped up, formed a local minimum, and that's a sell signal. So we're buying puts on H&R Block. You can see back here, by the way, that sell signal was, short-lived, but made some money. This sell signal was a little bit longer. And then this buy signal here was a good one. But this buy signal here marked with a blue B was not. That was not successful. So again, none of these are 100%, but they do have high probabilities when we approach them this way. One other one, Quest Diagnostics. We got the buy signal. When we first got the buy signal, it was still below some resistance, below this red line, but it now is broken out above there, so that buy signal is in place. And similar with Yum Brands, this one, we put this line here for resistance, and the stock did break through there on Friday. So that's a buy signal as well. You can also do this with futures options. In this particular chart, this is not a current chart because I don't really have a position in futures options right now. But the bottom graph, this graph down here on the bottom, is drawn using the volume and the weighted volume of the corn options that trade on the Chicago Board of Trade. The top black line is the continuous futures chart of corn. So in this particular case, we had a buy signal, local maximum there, buy signal, local maximum. Now way up here, another local maximum for a buy signal there. And you could either trade corn options on the Board of Trade, or in many cases, there's an ETF. In this one, there's an ETF called CORN, which trades options on the regular American stock exchanges. And so you wouldn't necessarily have to have a futures account to trade that. All right, so moving on to our next topic is market breadth. And there's a couple of things you can do with market breadth. It's just, you can keep a running total of advances minus declines. Breadth is advances minus declines. So you can keep a running total of that, or you could keep an oscillator. We do both. The oscillator is, today's oscillator value is 90% of yesterday's oscillator value plus 10% of today's difference between advances minus declines. Now, typically when you're talking about advances and declines, you think about the New York Stock Exchange advances and declines, and so we use that. However, there are things on the New York Stock Exchange that are not stocks, and they'll distort that ratio sometimes. So we also calculate what we call the stocks only oscillator. And for that, we use all optionable stocks. Are listed on the New York Stock Exchange, and it's a very broad-based representative set of stocks. Has NASDAQ stocks, has big caps, small caps, everything. So it's really a pretty good measure for advances and declines. So this is the stocks only oscillator going back really to 2013 here, so almost 10 years. And you can see that in the bull market that existed, we didn't get oversold too often. The green areas are oversold. Yes, there was a nasty one there in 2018, right before Christmas. Then there was the pandemic sell-off in March of 2020. But again, rather infrequent until we went into the bear market of 2022. Then we started to get oversold a lot more. And then just here most recently in this market downturn since July, which is shown up on top here, we got pretty oversold again. And so remember one of my earlier statements is oversold does not mean buy. So don't actually buy till it stops being oversold. In this particular case, that wasn't until last Thursday. And so it immediately rocketed all the way up here to overbought status. So it really happened so fast that we didn't trade that because we have some confirming indicators we like to see. So now we have our breadth oscillators are technically on buy signals, although we're not long because of them. But when the market is moving, especially when it's moving to a new relative high. So if, like, let's say the market were to break through 4,400 and to go into another leg of the bull market, we'd want to see breadth stay overbought. That's important, that breadth is overbought when the market is really taking off. You can see these heavy overbought times, like here's one of them right here, was at the beginning of a long rally in the market. This is another very serious overbought condition, again, at the beginning of a rally. So we want these really overbought conditions, we like to see them accompany a strong breakout. So right now we're just sort of watching this. It will give a sell signal, of course, if breadth deteriorates, and I already told you breadth is bad today. So this might not be going the way the bulls want to see, but right now we're waiting to act on this for a new signal. So this is more or less encompasses that. I will say this is a very short-term indicator. It has a lot of whipsaws in it. Whipsaws are very quick in and out. You're stopped out for a small loss. They're annoying, but better than, hanging on for too long. So this indicator is a very short-term kind of indicator. New highs versus new lows. This is another thing we pay attention to. I don't have an option twist on this one, except that I use stocks only data, NASDAQ, and the New York Stock Exchange data. But our indicator itself is based on the New York Stock Exchange data. And so it's very simple. If the new highs or new lows number more than 100 for 2 days in a row, that's a signal. So right here, back in September 21st, 22nd, new lows on the New York Stock Exchange were more than 100 on both days. That's a sell signal. It stayed on that sell signal all the way down here. Now, one day there was more new highs and new lows, but we need 2 days to stop that out. So it stayed on the sell signal all the way into here. Now, look how bad these numbers are. And you look over here at stocks only and some of these. They are, supposedly this bull market is a year old, and yet all these stocks are making new 52-week lows. This bull market is not representative of the average stock. It's representative of a few big cap stocks, and I'm sure you know that, but this just illustrates it quite obviously. Anyway, the last 2 days, more new highs than new lows. So this very nice sell signal was just stopped out. Right now, it's neutral. This signal has no trade right now. We're waiting to see either 100 new lows 2 days in a row or 100 new highs 2 days in a row. So this is the kind of thing we keep track of in our daily indicators. And this signal only occurs a few times a year. And it's been very, very strong over the year, especially earlier this year. The buy signal that came in was really quite good. So the fourth thing that we look at is volatility, VIX, and the various things having to do with VIX. So there's two things about, if you're looking at a VIX chart, two things are really important. One is the trend of VIX, and the other is spike peaks on the VIX chart. So the VIX should be trending opposite to the stock market, which it does most of the time. And then occasionally there'll be a little panic buying of VIX and it forms a spike peak. That's a buy signal for the stock market. A low VIX, which we're starting to start to get back towards a low VIX right now. But a low VIX is overbought, but again, overbought doesn't mean sell. So just because VIX were to get low is not a sell signal in and of itself. So here's a 1 year VIX chart. And all these B's on here are the spike peak buy signals. So the red ones are successful signals. We defined a system around this, and the system has certain parameters, one of which is that the signal, once we get the buy signal right here on that one, it lasts for 22 days, which is about a month. If a second buy signal occurs within that same month, we don't take it. So that's what the orange B means. There was a second buy signal. We ignored that in terms of actually trading. So we had this buy signal, this one. Now the blues are losses. We had a blue loss followed by a non-taken blue loss. But now most recently here, and I believe this was October 31st also. Oh no, I'm sorry, October 23rd. We got a new buy signal, VIX spike peak buy signal. VIX spiked up to 23 and then fell back. And so we're still on that. And this is current chart, at least as of Friday. Today, VIX is up a few pennies at 15 or so. So
Hey, Larry, I'm not sure if it's just me or not, but I all of a sudden lost audio for you.
Oh, really? Can you hear that?
Yeah, you're back.
Okay. It's weird. Our trend, the trend of VIX is determined that when VIX and its 20-day moving average are on the same side as the 200-day. So, for example, back here, this is the 200-day, this slowly moving line here. VIX fell below it, and the 20-day fell below it. So that was a trend of VIX buy signal, and so that turned bullish in November and stayed that way all the way until mid-October. So that was a trend of VIX buy signal. It was briefly stopped out here, but you can see the 20-day never went back above. So it's briefly stopped out when VIX went above and then came back into force when VIX came back below. So anyway, we got this trend of VIX sell signal right there, but that's already been stopped out. So that indicator is neutral, but the trend of but the spike peak is still in place. Now, we'll just back up that chart, knock out a few of these lines here. You can see that when we got down to 13 last summer, it didn't go any lower, but that's pretty low for VIX. In the last few years, it hasn't been anywhere near that. Now, in the big bull markets of 2019, 2016, and all those 2017, it got down to 10. So 13 is still quite a bit higher than that. So in 2021, it really didn't go below 15. In 2022, it didn't really go below 19. Now we're slipping back to a lower level, or we were last summer. Still, it seems to me to be a little bit high, and what's causing that is VIX, the price of VIX is determined by SPX put options in Germany. That's the main force on them. And if people are buying SPX put options, they're probably a little worried about the market. And so the fact that VIX really hasn't gone as low as it maybe had in other bull markets, there was a bull market going on at least for a year, indicates that there's still some fear among large traders. It's not, I'd say it's not a panic fear, certainly not that at all, but there's still a little bit of worry amongst those traders. So you can't trade VIX. You can trade VIX options. You can trade VIX futures, which are options on the futures. VIX options are options on the futures, but you can't trade VIX itself. It's a complex thing, and there's no products. It's just an index. But if we look at the futures and we look how they line up in price, that's called the term structure. If the term structure of VIX futures is sloping upwards, and let's say VIX itself is right here, then that's a bullish situation. So when you see that, that's a normal bull market. The VIX is below all of the futures prices, and the futures prices slope upwards as you go out in time. Occasionally, this will happen. And the last time that it happened was March of 2020, actually very late February of 2020. Huge warning sign, but the futures term structure slopes downwards, and VIX is above them, not below them. That's a very bad thing. The market reacts typically in a really terrible fashion when that happens. The first time that it happened in a big way was 2008. VIX futures started trading in 2004, so we didn't really have anything before that to compare to. But this hasn't happened in this last bear market. Last week, the term structure flattened out. That caused some worry with some people. Before the market rallied, so late October, it flattened out. But it really didn't invert. And so here's the current picture right now. I took these are Friday night's closing prices. But VIX was 1491. The front month VIX futures are the November futures. They're actually based on SPX options that expire in December. I'm not going to get into all of that. But you can see that each successive futures month is higher priced than the one before it. And they all are trading at a premium. So here 1610 minus the price of VIX 1491 equals 119. So they're all trading at a premium. And some of these out here are pretty big premiums. So that's all bullish. That's a bullish picture. Term structure slopes upwards. They're all trading at a premium to VIX. You can go to the CBOE futures website to see delayed futures prices at any time. But there's also, I call the poor man's futures. The CBOE publishes 6 volatility indices. So VIX here probably is the most familiar one. And VIX is a 30-day volatility index. But there's also a 1-day, which they put in there to trading of the 0-day expiration options. There's a 9-day, a 93, a 3-month, 6-month, and 1 year. And of course, they have the symbols to look like the symbols used to be something else. Anyway, again, these all slope forward, so upwards. So that's, again, bullish. So the term structure right now is bullish. what we watch most closely is the price of the front month future, in this case November, and the price of the second month, in this case December. Right now they're 75 cents apart. D's over no 75 cents. That's fine. If they invert, especially if they invert by $1 or more, that's a big negative warning sign. So that's happened a few times. And when it does, you should really head for the hills as soon as it happens, because you probably have less than a week before the, whole market really tumbles. But this has not really happened in the bear market of 2022. And in fact, I don't want to get into it a lot now. You're seeing less and less articles about it since the bear market is over in many people's opinion. But during the bear market, they kept saying, oh, there's something wrong with VIX. It's not going up. Well, VIX doesn't spike upwards. VIX stays close to realized volatility, to close to 20-day realized volatility. Well, in a steadily declining market, yes, realized volatility will slowly go up, but it's not going to explode. So in that steady bear market, it got up into the 30s, never got to 40. But in the crashing market of March of 2020, it got to 90, both realized and VIX. So, the thing, if you ever want to just do a gut check on VIX, look at where the 20-day realized volatility is, and you'll see that VIX is probably not too far from that. So to summarize what we've been talking about here, we have one bearish signal. That's the SPX chart, because it's still in that downtrend. We also arguably have a weighted put-call ratio sell signal, but that was unclear. We have buy signals from the Mcmillan volatility bands, the constructive volatility derivatives, we just talked about that, VIX spike peak, breadth oscillators, and the standard put-call ratio. So mostly buy signals. A couple are in neutral status right now. That new highs, new lows indicator was stopped out, so it's just waiting for the next signal. And the trend of VIX was also just stopped out, so it's waiting for its next signal. So by and large, this looks like a bullish picture, but because the only bearish indicator is the most important indicator, we're reserving judgment on that. So we're still holding that core bearish position. As I said, it's now out of the money. It made some really strong money back in August, September, October. But we would reverse our course on that if there is a clear breakout over 4,400. But if there's not, we'll continue to trade these other signals around this. So I want to finish up the last few minutes talking about some seasonal trades. Between the middle of September and the end of January, there's several seasonal patterns that exist. I know Jake was talking about a lot of seasonal patterns. He trades a lot more than I do, but these are a few and far between. One of them was, we call it the September expiration. Sell the market the week after September expiration. Well, it's already happened this year, but it'll be coming around again next year. This year, that S&P was down 130 points that week, so that was a good, strong trade for that system. In other years, it hasn't fared as well. It has a long positive track record, but we trade it with options. So if SPX were to go way up in price, you'd still have your limited risk with your option trade. This is another one that we just had. I was fairly highly publicized on this. I have been over the years, but it's very simple. You buy the market on October 27th, and you sell your position back out in the close of November 2nd. Well, you only take the signal, though, if SPX has been down at least 3.2% sometime in October. So the track record on this is 32-6, winners over losers. Eight years we didn't have that 3.2% decline, so we didn't take it. But this year we bought on a week ago Friday and sold last Thursday. That was a 200-point gain. So that's the best seasonal we've had. The best percentage seasonal was actually in the middle of the financial crisis, believe it or not. The market rallied during those 4 days over 13%. There's a reason for this. I'm not going to get into it now, but as these come up in our newsletters, we talk about them. We explain, why they work, or if we know why they work. Anyways, the next seasonal pattern is coming up. are the ones right after Thanksgiving. There's actually 3 of them. We tend to combine them all into one to make one trade. So there's usually a rally right after Thanksgiving. Then and that can last anywhere from a few days to a couple of weeks. Then the January effect takes place where small caps outperform large caps. That used to happen in January. That's why it has that name. But as with many things on Wall Street that work, people start front running it and moving it back in time or up in time. So now the January effect takes place in December. So you would favor small caps over big caps. And then finally, there's the Santa Claus rally, which is invented by Yale Hirsch. And he determined that there's a very strong pattern. The last 5 trading days of 1 year and the first 2 trading days of the next year should produce, a decent gain in the stock market, 1% or more. If it doesn't, that's a bear market warning. But most of the time it does. So we combine all 3 of these together, and we buy Russell 2000 options. We track it in terms of Russell 2000. In the last 30 years, it's been right 23 times, wrong 8. Again, when we're wrong, we only lose a fixed amount on the options. When we're right, we're seeing the Russell go on average go up 2.5%. The reason it's a larger number, of course, is that you're in this position for like 5 weeks. So the average win is actually more like 5%, but you've got these losers in here too. So a couple of years ago, we had the best trade ever in Russell points, 134 points. But in reality, in 5 of the last 6 years, S&P has outperformed Russell. So we're going to be taking a closer look at that trade before we recommend it this year, but we will definitely be trading this seasonal coming up. There's just some other quick anecdotes about Thanksgiving trading. Really, the Monday, sometimes you'll hear people say, oh, you got to trade the Monday or the Wednesday or the Tuesday. Really, they don't amount to much of anything. Trading the Monday, the Tuesday or the Wednesday, the day before Thanksgiving. That's total S&P points is the best one, 99, 95. But that's over 33 years, so that's less than 3 points per year. So really nothing. And even worse is the day after Thanksgiving. Don't even bother. Nothing's happening there. But there are a couple that come up in January that are really strong. One is what we call the January defect. We sell the NASDAQ on the 8th trading day of the month and covered it on the 18th. And immediately flip around and buy the S&P on the 18th trading day and sell it out 4 days later. And there are some other, seasonals during the year, but this is like the height of them, of the ones that we trade. I don't trade really many more than these. You can see that 2 years ago in 2022, when the bear market started, as the NDX was down 1,900 points on that January defect. So, down is good. We're short the market there. And then in this January seasonal trade, it has numbers comparable to the October, but this number's not as big. But it has had strong gains the last couple of years. So I said before, if you go to this website, you can download the PDFs of this presentation. Also, we're offering this, I think, pretty attractive bundle. Typically, the cost of this is really $804. We're offering it for $249. You get the Option Strategist newsletter, which comes out twice a month. I'm sorry, it comes out every week. Used to be twice a month a long time ago. It comes out every week, and we cover all of these systems in that newsletter, plus a lot more. There's articles and as well as other kinds of interesting option trading, straddle buying, things like that. You get a copy of my book, Options as a Strategic Investment. And then perhaps most importantly, you get this 14-volume home study course, which is 14 1.5-hour webinars that I recorded last year that really cover option trading from the beginning to the more exotic advanced stuff. And if you want also a consultation on how our money management works. So the Option Strategist has been in publication for 32 years, track records on the website. The daily strategies and daily volume alerts are not included in that package, but they're the ones that we come out every day talking about the market and about these various systems. And of course, we have a YouTube webinar channel that I record a market comment every Monday morning. We put one up there this morning. Then there's 2 other newsletters, Daily Put Writer, which is writing out of the money puts for, I say 90% wins. Of course, any put writing system always says 90% wins. It's what happens the other 10% of the time you have to worry about. And then we have one on special situation alerts as well. So, as I said, you go to the optionstrategist.com/metastock. And if it asks you, it shouldn't ask you for a coupon code, but if it does, it's Mcmillan Web 2. If you're interested in our money manager, you can visit this website, mcmillanasset.com. So, Jeff, I think that's just about an hour. I'm going to shoot it back to you.
All right. I have a couple comments for you and one question.
Okay.
So I just wanted, this one was from June. She came in a little bit earlier and she said, just wanted to tell Larry he's awesome. I attended his webinar on October 26th, and as he mentioned, I decided to play the seasonality with November calls and sold on November 3rd. Thank you, Larry. So a question from Paul, since not all cyclical charts are created equal, how do you determine which ones are worth or of quality?
Okay, well, so I guess you're referring maybe to the put-call ratio charts there. So we look for those extremes that I talked about there, and then I'll analyze it. I look at the extreme. First of all, one thing I do not want to do is buy into a downtrend, even though the put-call ratio signal might say buy. I will not buy a stock that's in a steep downtrend. I'll wait for it to improve, make a lower high, low. I mean a higher low. That sort of thing, or even just a breakout over some resistance or something like that. So we filter out some of the charts that way. So that's done with humans, not with computers.
All right. Ken says, avoid the day after Thanksgiving. So talking about the seasonal play, why would you not look at buying puts?
Well, that was I'll go back to that one. It's a very tiny decline on the market that day. Here, day after Thanksgiving, the average move in the market is 0.1%. The total of all S&Ps moves since 1990 has been a decline of 58 points, and on average, that's 2 points per year. So that's probably not enough to even cover your bid-ask spread, really.
You might as well sleep off the turkey.
Pardon me?
You might as well just sleep off the turkey that you ate the day before. All right, cool. Michael says, awesome book for options. Thank you very much.
Oh, great. Thank you.
And I think that's it. Let me just check YouTube real quick, see if we have any questions. Vince wants to know, do you look at the transportation average?
So only if it falls within these other things. Typically, it does not, so don't really see it too much. The ETFs that we follow most of the time are IWM, SPY, and then some of the commodity-based ones like TLT for bonds and that sort of thing. But again, they have to fall within the confines of these put-call ratio extremes or other things that we're looking for.
William says, is it possible to get the slides? So yes, it is. I'll just put that website right here and you can click on that. You can download a copy of those slides. Jesse asks, what is your website again? So it's optionstrategist.com. And here you go. And Williams asks if you could briefly show the January defect trade again.
Just tell what it is, you mean?
Mm-hmm.
So let's see, where do we have? I have it in here. Oh, the January one. Okay, hold on. So we're buying on the 18th trading day of January, and we're selling 4 days later. We used to sell 5 days later, but we noticed that people were front running that one. That one is sometimes more publicly circulated than the October one, although we did a pretty good job of getting the October one around this year, so I think a lot of people are going to be looking for that next year. This one, they were exiting early and causing the market to actually sell off on the 5th day. So we had to move the sell point back to the 4th day. But I usually talk about those things before we actually make the trade.
All right. And then Jesse said, no, what's the other website? Is there a Mcmillan.com?
So McMillanAsset.com is our money management website. And there you can get our track record of our money management and also set up an appointment or what have you, and that sort of thing. I will say that our account size is $100,000 minimum.
Okay, cool. And we just posted that in the chat as well. Larry, always great. Always really, really great to have you. I really appreciate your coming and spending some time with us.
All right, thanks, Jeff. Always good to see you. Although better in Vegas than here.
I don't know. I kind of like it right here.
Okay.
All right. Very cool. Good to see you, Larry. Thanks for coming.
All right, sure. Thanks.
All right. Larry, another comment. Larry, it's awesome. Thanks. Always great to have Larry here. Let me go ahead and do this. Let me go ahead and go here real quick. And I want to say thank you to Larry. Let's go ahead and turn on the camera. And everything should look good here. So real quickly, I want to say thank you to the CMT Association, one of today's event sponsors. CMT, if you want to get CMT at the end of your name, you can go to cmtassociation.org. And if you trade as a professional, if you have money under assets, or if you want to have money under assets, actually, there's a lot of research that Tyler's going to share us later in the week that will talk about how CMT and having that CMT designation could be really, really helpful. For us, we really appreciate the sponsorship of the events. They've been supporting us for a while now. You can find out more about them at cmtassociation.org. They do a lot of stuff from, risk management, system design, portfolio management, behavior finance, all that kind of good stuff. And we definitely appreciate it. So there you go. All right, and we are pretty much on time. It's my turn. We're going to talk a little bit, or quite a bit, about Metastock for a little bit. But I do want to say thanks to Metastock for having it up. Let's just go ahead and get started. Here's my high school picture. Actually, before we get started with this, we're going to give away our first prize of the day. I just realized we haven't been doing prizes, and so we have quite a number of them to give away. But before I get underway, I'm going to read another legal disclaimer just because I'm supposed to, and it keeps our lawyers happy. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So there you go. I'm going to go ahead and send that Larry's awesome comment to the general chat. And I'm going to ask you guys, we're going to, like I said, we're going to give away a prize. And so what I'm going to do is I've got a list of all of the registrations here. And I'll just have a big, because the reason I'm going to go into a little bit of detail about how we do this is because several people were confused. So what I've done is I've pulled a list of everybody that's registered. And if you've registered for the event, if you're in GoToWebinar, you registered for the event. If you're watching on YouTube and you haven't registered for the event, but you want to be able to qualify for our great prizes, what you'll want to do is go to metastock.com/traders-conference. And Greg is going to put that in the chat in just a second, so you don't have to remember it. But as long as you're registered, you're going to be on this list. And what we're going to do is we're going to be giving prizes for the list. And I'll update the list every now and again. So if you haven't registered now, go register. Okay. Now to get the first prize that I'm going to give away is this beautiful hardbound $95 value book that was written by Adrian Matz called Around the Horn, a trader's guide to consistency scoring in the market, consistently scoring in the market. This is a really good book. We're going to have a conversation with Adrian a little bit later, but I like it because it has a lot of illustrations. It talks a lot about the patterns that he does, et cetera, et cetera, et cetera. So what I would like you to do is give me a number between 1 and
Jeff,
9,377.
You talking to me?
No, I'm talking to Chad. So
Talking to chat.
if you're
You,
in chat,
you told me I've been waiting here patiently on the sidelines because you said you wanted me to help you.
I changed my mind.
Oh, well, then I'll just get out of your way.
It looks like Michael was the first one to select a number, though, and it was 7277. But Greg, I'll have you help me with the next one, so don't worry there. 7277. Let me go ahead and figure out who that is real quick, and I'm going to be careful because we try not to dox people on the internet. So, Michael, thanks for that number. Let me go ahead and figure out who is 7277. So. Okay. Mike S. Okay. Mike S. Mike S. up in the Canada. You've won a prize. We're going to go ahead and give you the Around the Horn guide to consistently storing the market. So I will reach out to you with regard to claiming that prize in just a little bit. And thank you for all the numbers. We got about 100 numbers there. So thank you for everybody for coming in and giving me a number. Appreciate it. We got one, and there we go. And Greg, I'm very sorry that I didn't allow you to go first. So to allow you to pick a number.
Oh,
My name's Jeff Gibby.
Thank you, but I'll be fine. I mean, I was a little hurt. I was just waiting here. I had my people could see me waiting here. I was all ready, but it's okay, Jeff. By the way, I should mention while I'm yammering on that you are a fantastic presenter, and everyone should stick around and listen to you because you know a lot, except for when to have your control room guy help you out.
Yeah.
Break a leg.
Well, okay. Thank you, Greg. All right. Very cool. Just to kind of give you a little bit of background on me, I'm not going to spend a lot of time on me, and certainly I'm going to make sure that we end on time because, it's nice. I also use this as an opportunity to kind of get caught up in the schedule. But for me, about, I think it's 27 years ago, 28 in March, I started working for Metastock. And I started in inside sales, and I love working in this inside sales. If you had questions about the software, what it could do for you, how it could help you, I'd be the person that you talk to. And I did that, and I did it for about 10 years, and it was great. And for the last 15 years or so, I charge a lot of the events that we do, like this online event, the partnerships that we run, our sales team. And it just depends. Like I do everything from kind of programming the software to talking to people to organizing events it just depends. It's a great job. I wear a lot of different hats at it, and I certainly have enjoyed the opportunity to work here. Certainly speaking just on behalf of myself, it's a very tight-knit company, and we all work really hard. And one of the things that I take great pride in when we start talking about Metastock, there's a couple of things that I'll highlight, and then we're just going to talk a little bit about some things that I like in Metastock that are kind of maybe hidden gems in Metastock, if you would. But some things that I'm super proud of is number one is going to be our support team. I don't know if you've called a support team for a software company recently, but I want to tell you that all of our support desk, all of our sales desk, everything here, they're all located right here. And one of the things that I find really cool is a lot of times if you call or chat or email our support, you'll get a survey afterwards. And it's not uncommon for them to get a 100% on the surveys, meaning everybody had good things to say about it. They're happy with their support experience. And that's hard to find in a company these days. The other thing that I like to talk about is, well, it was right here. 30 years in a row now, and hopefully 31 when this year ends, Metastock has been rated the best software program by the readers of Stocks and Commodities magazine. And I like to look at kind of the demographics of the customers that we've got. And it makes me happy to see that a lot of our customers have been with us, using Metastock to help them find better trades for like decades. And in fact, Greg, our marketing and video and web guy, often surveys our customers. And it's not uncommon for a big chunk of our audience of our Metastock users to have been with us for decades. And, you know, the reason I think they keep using Metastock is because it helps them find better trades. It helps them identify better trades and all that kind of stuff. So there you go. So in any case, Michael, thank you for that comment. So, and Carl, I'm not sure what your question is, but I just see the question. So let me go ahead and do this. Let me go ahead and do this. And anytime I look over in this kind of general direction at this monitor, it's because I'm looking for questions. If you have questions as we go, feel free to ask them. I'll do my best to answer them, as long as they don't get us too far off. A lot of times we'll have somebody pop in with a formula question, and I'll take that offline. I'll take it, but I'll take it offline, just because I don't like to present and write formulas at the same time. So today what I wanted to talk about, though, is a few of the things in Metastock that I love. You know, we're going to talk a lot about Metastock later on this week. Kelly's going to come in and he's going to talk about like the power tools of Metastock, and that'll include like the system tester, the scanner, all the systems that are built into Metastock that you can use right out of the box. Scott's going to talk about our patented forecaster a little bit later in the week. What I'm going to talk about is, you know, over the years, what we have is a software that I would call extremely mature. And I'm going to go ahead and take this out because I'm getting a little bit of feedback on it. But very mature software. It's been in development for 30 years. Over the years, I've seen a lot of software come, seen a lot of software go. But when you've developed a software for over 30 years, there's definitely going to be things in there that people don't use or maybe not be aware of that I'm going to highlight now. So there's 3 of them in particular, and based on kind of how long it takes, that's going to be, we'll cover as much as we can. If you have any symbols that you want to look at, type them in the chat. Because what I don't like to do is actually prepare like static demonstrations of perfect examples of breakouts and stuff like that. If there's a stock that you're interested in seeing, go ahead and type it out. Let me go ahead and jump into Metastock. The first tool that I'm going to talk about is a tool in Metastock called the dynamic trading tools. And this is something that's included with every version of Metastock. What I'm going to do is let's just go ahead and go to Meta, I guess. And what I'm going to do is actually apply that particular template to the chart. So there's a collection of indicators, and just recently in one of the recent versions of Metastock, I said, hey, we should make a template out of this so people can see it and can see what's in there. GE, you got it, Marius. Let's look at GE instead. Meta was mine, so I could make meta jokes about how we're the original Meta, but GE works. So what I'm going to do to kind of apply this, if you're using Metastock 18, open up a chart. What I'm going to do is I'm going to go ahead and right-click here and go to Apply Template. And the template that we're looking for is called the Dynamic Trading Tools. So we're just going to go ahead and come down here a little bit. You see it right here. It's just a template that we're going to apply. Okay. When I do that, you're going to notice a few things. I'm going to adjust it. I'm going to kind of adjust the look back a little bit so you can kind of see a wider view of the chart since we're dealing with long-term support and resistance. And then I'll just kind of point out some of the things that are being drawn on the chart. All of the lines that you're seeing are automatic, so I haven't actually drawn them on at all. It's just what the software is seeing based on kind of the algorithm that's put in there, or the algorithm, I think is the best word I could come up with. So right here on GE, what you're going to see is this red line that's happening right here. And if I'm going to actually kind of make it a little bit thicker just because it's a little bit easier to see it that way. And with Metastock, I can just kind of double click on something. I'm going to come in here and just make it kind of super fat and then go ahead and click on apply. This line right here is our shorter term trend line. And as you can see, I'm going to kind of zoom in just a little bit again. As you can see, we have a bit of a trend line that's been pointing down. Right here, we've got a trend line that's shorter term, this green one right here. And go ahead and make that a little bit bigger as well. And it's obviously pointing up, okay? So that right now, what we're kind of getting is a bit of a, based on kind of the algorithm in here, we're getting kind of a bit of a squeeze or a triangle where this trend line is coming down, where this and this longer term are coming up a little bit, okay? Now you can see based on the coloring, this and based on the term, this is a bit of a shorter term resistance level, okay? This is a shorter term up, not resistance level, but a shorter term down trend line, a shorter term up trend line, and a shorter, longer term trend line, okay? In addition, some of the other things that have been kind of put on the thing are going to be support and resistance areas. So right here, this is a longer term resistance area that was penetrated right here. Okay, I'm going to make that a little bit fatter. Go ahead and click on OK. This would be the longer term one. There's also a shorter term that's automatically drawn. It's drawn right here. And I'll make that a little bit thicker, but not quite as thick as the other one, just so that we could kind of see what we're talking about. Okay. In addition to that, you've got a shorter term support area and a longer term support area as well. I'm going to make that longer term support a little bit larger instead. Okay. Now, he didn't say it today, but he does talk a lot about how, and a lot of the experts that we talk about will talk about looking for stocks that are breaking through long-term support areas or breaking above trend lines or being held up by trend lines. So if we're looking kind of right here where GE broke above this longer-term resistance area, that would have been an incredible area to kind of look at. Okay. So initially it came, it busted up, it kind of came back, started to form this trend line up, but then it kind of broke up kind of permanently and kind of stayed up above that. Okay. And a lot of times when something breaks pretty strongly above support or resistance, it's a really good time to buy it because you know that that support area is going to likely turn into a resistance area. And so when I find a stock, or when you find a stock that's breaking up above kind of one of these longer term resistance areas, that could be a really good time to buy it. And obviously, in this particular instance that we're looking at right now, it's been really, really good because it hasn't set a resistance area again, and it's gone from about $79 to about $115. Okay. And the thing is like with the Metastock scanner, I can actually scan for these breakouts. So if I'm looking for a stock that's doing something like this, where it's breaking above support or resistance, and something that I want to buy, that's basically going to be kind of a scan that I can run. So let me show you how to run that. So Jerry asked, do you have market profile and volume profile? We do in our real-time product in Zenith. Thank you for that question, Jerry, appreciate it. And let's go ahead and do this. What I'm going to do right now is run a scan. I'm going to show you how to find stocks that have broken above that resistance area. You can also scan to find stocks that are breaking above a shorter term resistance area or down below. I'll show you that at the same time. So what I'm going to do is I'm going to click on the Power Console right here, and that opens up all of the tools. And so if you're doing charting, this is the button that you click on. You can open up any chart you want. We cover hundreds of instruments, hundreds of exchanges, literally thousands of instruments. Quote Center, that's basically a quote screen, and you can kind of keep an eye on things. What I'm going to go right now is absolutely the tool that I use most often, besides maybe charting in Metastock, and that's what we call our Explorer or our scanner. So I'm going to go ahead and click on that. And what I'm going to do is just look for breakouts on that. So if I come over here, I'm going to do a search. They all start with DT, the particular scans that I'm looking for. And what I'm going to look for is a longer term breakout of support or resistance. So you see right here where it says longer term, what I'm going to do is I'm going to select that. And if I want to find trend line breakouts for longer term, I can actually run that at the same time just by selecting that. So, I have a few selected. You'll notice there's Elliott Waves, which is another system, part of some other tools in Metastock. We actually have a really cool Elliott Wave program in there. But what I'm going to do basically first is I'm going to unselect those because we're not going to run those today. What I'm going to do, we're just going to run this longer term support and this longer term trend line breakout. Okay, so these are the two explorations that we're going to run, and I'm going to be able to define what universe I want to look for. Okay, one of the things that I kind of mention a lot is where we get our data from, and basically we're getting our data right now from LSEG, the London Stock Exchange Group. They have a service that basically used to be the Reuters data product, but we get all of our data for that Reuters infrastructure that they created, and then they sold it to LSEG. okay? The benefit of that is I can scan just about anything that I want. And you, if you're watching us from Asia, or if you're watching us from Europe, or whatever it might be, you can scan just about any market on Earth. In fact, if I just look at the instruments that are available right here, there's 321,122 different stocks, futures, ETFs, coins that I could trade, okay? If you're watching us from Asia and you want to do like the Australian markets, we have Australia, we have Singapore, we have Hong Kong, whatever is it that you're interested in. And we do have a lot of traders in Asia that we're really grateful for. If you're interested in Europe, Middle East, Africa, those are regions that you can do. And then, of course, North America. A couple of things that I like to scan is there is a list in here. If I just want to scan everything that's optionable, I could just select this optionable list right there. Right now, there's 5,832 optional stocks that I could just run a scan on like that. Okay. I could also select markets like NASDAQ, New York Stock Exchange. I think you get the idea. There's a lot of data coverage. For the purpose of the demo, though, there's futures. For the purposes of kind of just showing you this, what I'm going to do is we're going to do the Dow Jones Industrial Constituents. So there's about 30 shares there. I'm going to do the NASDAQ 100 and the S&P 500. So let's go ahead and start that. What we're going to do is we're going to look for stocks that have broken through support or resistance or have had a trend line breakout. So let's go ahead and run that. Okay. And yeah, Metastock says, if you have any questions for Jeff, he's good at monitoring chat, so ask away. Definitely ask. All right, so we're gonna run this right now. What I want to point, this scan works a little bit differently than some of the other scans that we've got, because it's gonna tell you stocks that broke out of those particular levels that I showed you on the chart, but it's also going to show you how many days ago. So right now it's running through about, 526 stocks. It's already done with the support and resistance one, okay? So all of these 293 stocks, they either broke up through resistance or down through support, okay? And so right here, I've got the close. Right here, I've got breakup, and there's a number in here of either 0, 113, some sort of a number here, and then breakdown and a number here. This is the up volume. So if it broke up on what type of volume, and the down volume. What I'm going to do is I'm going to actually sort this based on the breakup column. So what I'm going to do here, go ahead and do that. There's a whole bunch of nons, and I'm going to go ahead and sort it again. Okay. So what we're seeing here is there's a number 869. 869 days ago, this broke through longer term resistance on 11% more volume than normal, okay? Now for me, that's a long time ago. I'm not interested in stuff that broke that far away. And so what I'm gonna do is I'm actually gonna sort it again. And what I wanna do is find stuff that is recently broke. So all of this stuff that has 0 days, right here, the first one that has 1 day is Gartner. So that means it broke on a yesterday's bar because I did a scan on a daily basis. The close price of that is 392. It broke up on 276% more volume than normal. So that's actually kind of interesting. Let's go ahead and open up the chart. And what I'm going to do, oh, wow, okay. What I'm going to do here is I'm going to actually apply that template so we can kind of see exactly where that support and resistance level is. So I'm going to come back in here. We're going to apply that dynamic trading tools template that we just created. And right here you can see, I'm going to make it thicker so you can really see it. But right here you can see, apply, okay, that just 1 bar ago, we broke over this resistance level. The volume that we had was over 260%. So if we're also, at the same time, you see this right here is this trend line going down. It gapped up above both of them. So not only did we have a good move on good volume, we broke both a resistance area long-term and a trend line long-term as well. Now, not recommending that you buy that, but we did break above that particular level. That looks like a really good opportunity. If I was looking to take advantage of this, I would be looking to put a stop where resistance is. So either here or here. So again, very, very easy to find. Let's look at another example, and then I'm kind of just going to move on. Again, this is a pretty cool tool because it allows you to find stocks that are breaking above support and resistance. So right here, we've got Hilton, HLT. It broke up 1 bar ago, but the volume was kind of low, so we're going to skip it. Let's look at Microchip. It has a price of $75. It had a break up 1 bar ago on 120% more than average volume. So I'm going to go ahead and open that up. Again, all I'm going to do is I'm going to apply the chart, or apply the template. The template is called Dynamic Trading Tools, so you can use it at home if you want to. And let's see exactly where that came in. So I don't like this one as much. You see kind of this big trend line that we're going to kind of make a decision around. Let's look at kind of where we're at in terms of the longer term resistance. Shorter term, we've got a little bit of a resistance here. We've got a longer term that we broke up above. If I was trying to decide between the two, the one I just showed you and this one, probably looking at the other one. But what I do see here is we've got a trend line that's coming up. We've got a resistance area that we just broke above, but we're kind of got a bit of a triangle formation. If you kind of extend these lines out, this is going to do something. So, but I don't really want to make a decision about what it's going to do until it does it. So you've got this supporting trend line that's kind of being drawn on here that's coming up. You've got this descending trend line that's coming down. I'm going to wait until a decision's made there. So that's it. Anyway, that's how you found it. Any questions so far? Maverick, it's good to see you. All right, now I'm going to show you a little something totally different, and it has to do with tools that I like in Metastock. And Marius, since you gave us this chart, if you have any other tickers that you want to look at, let me know. I'd be happy to kind of look at different charts. But I'm going to talk a little bit about another tool in Metastock. And this is one that we've used for years. I've probably done 200 or 300 demos on this particular methodology. It was actually the first methodology that I invested my actual real money with. I got a little bit itch right here. It's a trend following strategy, so I put a little definition of the trend, and sometimes I'll come in and say like, the trend is your friend, befriend the trend, rising tide lifts all boats. It's a cliche. There's a whole bunch of cliches in the market. CBOE comes up on a lot of scans. We'll look at that one, Maverick. Thanks for the recommendation. I've actually, see, that's an interesting stock. I actually want to look at that one anyway. All right. So this is a trend following system. It's called the Rahul Mohinder oscillator. And it was put together by our dealer in India, a gentleman by the name of Rahul Mohinder. And we're actually having him speak, I think tomorrow morning. I think he opens up for us tomorrow morning, if I'm not mistaken. Okay. Just to give you a little bit of a background on Rahul, he's a panelist. He often appears on CNBC and CNN in India. He has quite a few local offices around India. And what he does is he brings people in and he teaches them how to trade. And he is one of our most prolific dealers in the world, and certainly one of our most longest running dealers. And we certainly appreciate all the work. To tell you kind of the story of how we got the system, real quick, I have a tendency to kind of blather, as somebody said a little bit earlier. But to tell you the story real quick, he was in the office and his sales were going just gangbusters. He was doing such a lot of revenue for us. And we're like, what are you showing people how to do? What is kind of the method that you're using? What are you doing with your trading? And that's what we had him do, is show us. And he kind of showed us. And what we then did is we liked the method and we bought it. We've included it in Metastock since, I think, version 10. It's been in there for, we're on almost 19 right now. It's been in there for over a decade. And we just had him show it what it was. We liked it. It's a method that he uses with a lot of the tradings that he uses, but it's designed to show you the trend. I probably, like I said a little bit ago, demoed this in hundreds, if not 1,000 times. I've shown it all over the place. And there's some real key reasons why I like to show it. I've shown it in Singapore and India and you name it. I've shown it in thousands of webinars. And the reason I like to show it is it's somewhat easy to use. So as long as I do a pretty good job of showing you 3 rules, and you understand those rules and you can implement them, it's something that you can kind of apply and use. It's also 100% objective. It's rule-based. So again, as long as I explain the rules to you, you'll be able to apply it. I like it because you employ solid money management. And it also works on a lot of different instruments. When I go into India, I'm like, show me it on India. Or show me on what some stocks you want to look at, and we'll use it with those stocks. And it's a simple 3-step process. And those steps that are involved have to do with identifying the trend. Okay. And when I start to talk about trend, we're going to talk about the primary trend or the prevailing trend. And that's just a long-term trend. Okay. We're also going to talk about the short-term trend and the intermediate trend. But the first thing that we're going to do is we're going to identify the primary or the prevailing trend. So let's go ahead and take a look at these with GE. And I'll also open up CBOE, and we'll go through the rules on that as well. So what I'm going to do here is I'm going to change templates again. I'm going to go ahead and go to the Armo trade model. Okay, we'll go ahead and apply that as a template, and that'll apply all the indicators that we want to work with. Okay, and since I promised that we'd also show it on CBOE Maverick, we're going to do that as well. And what I'm going to do here is we're going to open up the chart of the CBOE, which actually came up on an exploration not too long ago. So I'm going to go ahead and do that. I'm going to go ahead and apply the Armo trade model here, which is another place I can just apply the indicators from. We'll just take a look at it. Okay. R. Okay, there we go. Okay. Question that we get a lot when we show charts that are bar charts is, can I use candles? We'll get the other question too, is can I use bars? And so if that's a question, I think I have the wrong symbol in here. For the Reuters terminology, it's CBOE.K. And that'll pull in the per opera symbol for us. Okay. All right. If you have the question, nobody asked it yet. Oh my goodness. Okay, I just lost myself. Okay, well, let's look for the 2 Armo charts that we've got. We'll start with GE here. If you want to make any changes to Metastock, I know a lot of you might be privy to using candles or something like that. You can use whatever charting style that you want. Anytime you want to change from bar charts to candles or the charting style. The thing to remember about Metastock is you just right-click on it. So I'm going to right-click here, going to go to Properties, and I'm going to change this to Candlesticks. I'm going to go ahead and apply that, and we'll be looking at candlesticks. Okay, and it's that easy. If you're more comfortable with candlesticks, it's easy to make the change to candlesticks and back and forth and back and forth. Okay, let me get back on tack. Step number 1 is we're going to identify the trend. Okay, and when I talk about the trend, we're going to identify the long-term trend. Okay, and when we talk about the long-term trend, what we're going to do is we're going to look at this indicator that's called the Rahul-Mohinder oscillator, and it's designed to kind of analyze and tell us long-term what is this chart doing. Okay, Rahul says to keep it very simple when you're using the Armo oscillator. What you're going to do is it's either going to be bullish or bearish. If it's above 0, as it's been for a good chunk of this bar, if it's above 0, it went above 0 here, and it's been above 0 till just recently. We've had a little bit of sideways movement on GE, but for the most of this chart, for the most part, it's been above 0. Okay, if this is above 0, the Armo is going to be bullish, which you can see either by looking and seeing, hey, this indicator's above 0, or you can look at the chart, and right here it says Armo is bullish. Okay, if the Armo is bullish, that means the long-term trend is bullish. And that means 2 things when it comes to the Rahul-Mohinder oscillator. Okay, number 1, you can take long positions. Number 2, you can't take short positions. And then the other thing is, the third thing that's important is you do not use it as a signal. So just because this is below 0, just because it pops above 0, that doesn't mean go long. It just means you're allowed to go along. So if I'm looking at the last part of this chart where we've kind of been in a pretty decent trend, I wouldn't say a great trend, but on GE we went from about 63 to right now we're sitting at about 111. For the most part, we've only been allowed to go long. Okay. unless this is bearish, if it's down below zero, then we can go short. But I'd say already we've already put the odds in our favor because we're trading in the direction of the overall trend only. We're not going to take any short positions while this RMO is bullish. Okay, that's rule number one. It's that simple. Identify the primary prevailing trend. If it's bullish, we're allowed to buy. We're not allowed to short. Very, very simple. Okay. Rule number two. We're going to get through all of these. And I'm actually doing okay on time. I know it's 40 minutes after, but we're actually doing okay. The second thing we want to do is identify the short-term trend. Okay, so let's go back to GE. I'll show you how to do that. It's actually also pretty easy. What I'm going to do here is I'm actually going to kind of zero in on this. I actually prefer this as a filled line. And I prefer both of these as a filled line because I just think it looks better. So I'm going to go ahead and change these to a filled line. If you like these as a filled line too, you can make the changes. Again, I'm just double clicking on what I want to change. And I'm changing it from a histogram to a filled line. Not a step line, a filled line. We're going to apply that. Okay. And to me, that looks a lot better. But I analytically also like it because I can tell where the crossovers happen a little bit better, which is important, but it's only important when we get to rule number three. Rule number two is I've identified the long-term trend. So if I'm trading GE right now, long-term, we're bullish, I'm allowed to go long, okay? Short-term, I want to identify what that trend is. And to identify that trend, we're going to look at the swing trend 2 indicator, which is kind of the pinkish color of these indicators. I'm sure there's a better name for that color, and you can type it in the comments if you want, and I will forget it by the next time I talk about this thing. But the way that we read this particular indicator is the same. You'll notice it's a lot more sporadic. It's a lot more sensitive to price movement, and that's because it's looking at a shorter time frame, but the way we read it is the same. I'm going to take this off the side. If this is up above zero, short term, we're also bullish, and we're allowed to take a long position. If it's down below zero, like it is right here, and ignore the blue line for now, if it's down below zero, we're not allowed to go long. We're only allowed to go short. Okay? And we can tell where that's at. Actually, that's not what I mean to do. We can tell where that's at either by looking at the color, but every time that's in a bullish zone, you'll notice that it's coloring the price as blue. So every time this goes up above zero, you're going to have blue bars. When it's down below zero, you're going to have red bars. Okay, and that's another way that you can read it. Okay, so if I'm looking at this chart right now, because I have we had to trade on the right end of the chart. Long term, we're bullish. Short term, we're still bearish. We're still down below zero just a little bit, and so we're not allowed to go long. If this pops up above short term and we get a signal, we could consider using that. But for now, we're long-term bullish and short-term bearish. There's indecision in the market. As a good friend and mentor of me, used to always say, Steve Bigelow, we want to trade the decisiveness of the market and not the indecisiveness of the market. So what I'm going to do just to kind of show this system and how to use it is we're going to kind of come back here. And I'm going to do it from here. We're going to pretend, actually, let's pretend that we're doing it from, yeah, this will work, from right here, when I went from bearish to bullish, okay? So if I'm looking at the market right now, and let's just actually decide a day. If I'm looking at the market in this area, let's say right here, okay, that's bullish long-term, but I'm not allowed to go long, okay? Not until it actually goes bullish short-term. So right here, we're bullish long-term, we're bullish short-term, we're allowed to go long, okay? It's that simple, okay? We haven't talked about triggers. We're gonna do that as step number 3. But to recap the rule on that, just so that it's clear, if the primary trend is bullish and the short-term trend is bullish, you're still allowed to go long, you're not allowed to short, and then not a trigger. And you just reverse it for the if you're shorting. If your primary trend is bearish and your short-term trend is bearish, you could, in that case, go long, okay? But you want them to match. You want them to be decisive, okay? Cool, all right. Step number 3 is to determine an entry signal, okay? Also, if they don't match, you can wait, all right? We wanna wait for the decision. We don't want to trade when it's indecisive. If it's bullish long-term, but it's bearish short-term, long time, there's a good opportunity for us to kind of get whipsawed. We want to wait until there's decisiveness, okay? And so you can use the scanner if you want. If you really want to take a trade and there's something out there, you can run a scan. The Explorer is a really good tool for that. And it allows me to find, I'd rather focus on the ones that have good opportunities. But in the case of if they don't match, we're not going to make a trade. Now, how do I identify the triggers? Let me go back to our chart of GE that we're working with. And we're going to go back to these two indicators that we were kind of playing with before. This is the swing trade number 2 and the swing trade number 3. As we just talked about, the pinkish color is the short-term trend. This bluish color is the medium-term trend, okay? And to kind of make it a little bit more simple, we don't really care about if the medium-term trend is below 0 or above 0. That's not something that kind of feeds into the calculus that we use. What we're looking for is what Rahul calls a change of momentum, or a shift in direction, or a shift in force, okay? And so what we're looking at is, if we're looking right here on the chart, let me make this a circle right here, okay? If we're looking right here on the chart, right here, bearish short term, okay? Now the trend kind of starts to change. It starts to get more bullish. There's been a shift in the way that the market looks. When this short-term trend crosses up above the medium-term trend, what's going to happen is you're going to get a signal on the chart right here. It's a buy signal, okay? That's a positive shift in momentum, or a positive shift of force. That's where you can execute this trade, as long as you're bullish long-term and you're bullish short-term. And in both of those scenarios, we are. So if I'm looking at the GE, let's just pretend it's December 30th of 2022. I'm probably getting ready to have New Year's Eve party. But if I'm looking at this chart of GE, long-term I'm bullish, short-term I've been bullish for 3 days. I'm getting that shift of momentum, or that shift of force. That's where I can execute the trade, okay? And when it comes to Rahul, he's very, very specific about what to look for when you're doing a trade. So the first, and we're not even going to buy here. Everything matches up here, but what we want is a little bit of another confirmation that it's going to go up. So the way Rahul teaches to do this is I'm going to grab this horizontal line tool. I'm going to look at the high of this bar where we're getting everything lined up. I'm going to look at the high of the bar before. And what I'm going to do is just put a little bit of a horizontal line right above that high, okay? Just a little bit. I like to see a little bit of white space, and that's the higher of those two values, okay? And what I'm going to say is, if we go above this value, I'm going to buy, okay? Very, very simple, okay? So in this case, the line is at 66. I'm going to go ahead and write that on the chart so I don't have to kind of refer to it later, okay? And then the other thing that I want to do, and there's two different ways that Rahul teaches to do this, but the other thing that he wants to do is he wants you to determine a stop loss. So if I get into this trade and I'm wrong, how much am I willing to lose? I think that's so important, to decide what your stop loss is going to be before you get into a trade. And in the case of the first method that he uses is you can use the lows. So if I look at the low of that bar and the low of the bar before, that would be the low that I could go with, and you could put in a stop loss right here. The other thing that Rahul says is look for a recent support area and put it below that, okay? And that's actually the one I use. I like to give it a little bit more room. The specific rule that I use is I look for a pivot low. And if you're not familiar with a pivot low, I'm just looking for a low that has a higher low on one side and a higher low on the other side. That's called a pivot low. That's what I'm looking for. So if I'm looking to buy right here where this buy signal is, if I'm looking for the most recent pivot low, it's really easy to spy. It's right here. It's this low that's surrounded by these two higher lows. That's where I'm going to put in my stop, okay? So now I know that if this price goes down below about 62.8, I'm going to get out, okay? I'm not going to decide to stay in and just give it a little bit more room. I'll just get out. I can buy more if I'm wrong. I can buy back in if I'm wrong. But in this particular case, I'm going to know that I'm going to get in at about 66. If I get out because I'm wrong, I'm going to get out at 62. And that gives me a good idea of what my risk is going to be going into that trade. And I love that a lot. Now, sometimes stocks gap. Actually, Melissa's coming up in just a minute to talk to us about gapping stocks. And so sometimes you'll get out way lower than this if the stock upside down. But I have a good idea most of the time exactly where my entry is going to be. It's going to be at 66-ish. And my stop loss is going to be about 62.8. I know what my risk is. And I'm not making those decisions while I go. Okay. Next day we pop in. I have to hurry now. I am actually kind of getting a little bit low on time. Next day we pop into this trade and it starts to go up, which we're happy about. Okay. As has been said a few times, the market moves up in, well, actually, I like it better said, the market moves up in steps and goes, takes the escalator up and the elevator down. But when we're going up, you're going to have an up move. You're going to have kind of a bit of a pullback. You're going to have a bit of an up move. Okay. Whenever you get a pullback, you're probably going to get that shift of momentum to the downside. It happened right here. Okay. When that happens, as long as you're bullish long-term and bullish short-term, don't worry about it. Okay. If you get that pullback and things start to look bearish, your equation, if everything goes bearish, you're going to get out of the trade. But most of the time, what's going to happen is you're going to have a nice little move up. You're going to have a little bit of a pullback. It's going to determine a new support area. And then it's going to start to head up again. Okay. And when it starts to head up again, that shift of momentum is going to happen again. And that's where you move your stop. So right here where you had this bullish shift of momentum where it went up, you're going to look and you're going to identify your new support area. Okay. And for me, there's your pivot low. Right below that, right before that bar, here's your low surrounded by two higher lows. We're just going to move our stop. Okay. Right there. Okay. So now 79. Okay. It goes sideways a little bit. You have a bit of a pullback again. Here you have another buy signal. Guess what? You're going to move your stop. Okay. Where's the pivot low? I'm going to say it's right, probably there. Actually, I think that's the lowest low of those values. If not, it's close enough. So then you're at about 80. Okay. Have a nice little run up. Here you have that shift of momentum. You have that pullback. We're going to move up that stop. And it becomes just kind of checking on it. So if I'm looking at the pivot low, it's right there. Okay. Nice move up, pull back, shift of momentum again. You're going to move up that stop. And most of the time with the Armo system, you're going to be getting out on the stop. In the case of GE, let's see where we finally get out on this. I'm just going to go a little bit faster here. Okay, so here we would have moved a stop. Here we would have moved a stop. Here we would have moved a stop. Did we hit that stop? Nope. Here we would have moved our stop. Here, we probably would have put our stop right about here on that pivot low. Okay, I'm going faster because I'm running out of time. But here we would have moved our stop. Okay, so would we have stopped out of this trade? Yeah, probably right around here. Okay, we would have stopped out of that trade. We got in about 66. We got out at about 108-ish. Did we get the exact high or the exact low when we bought and sold? No. But did we take good chunks out of the trend? Did we have a money management method in place every time we kind of had a stair step up? Absolutely. So we don't have time to look at it exactly on CBOE Maverick, but let's just kind of eyeball it. I had to close down some of these charts. We've had a nice little run. This came up on a scan I was running the other day. We've had some indecisiveness. But again, right now, we've had that long-term move up, or that long-term Armo bull has been bullish since early July. Okay, we've been moving up nicely. I would say that if we've moved up about 138 to about 174, that's a nice positive close. If we're only taking long positions during that trade, we're probably putting the odds in our favor quite a while. How does the medium-term trend factor into the analysis? So the only thing, and I think I might have actually answered that question before you asked it, or before I saw it, but the only thing we're really looking at with that medium-term analysis is determine the shift of momentums. So when we have a spike up above of our short-term goes above the medium-term, that's when we get our buy and sell signals. So the shift of analysis or the shift of momentum and stuff like that. Ganna says, hey, can you quickly show an exploration for Armo? Yes. And I'll just show them to you since that's what you asked for. And then we'll talk a little bit about it. I'll tell you what the third tool is, but I didn't have time to talk about it today, but that's not unusual. And I do want to stop on time. So the RMO, the explorations that are in there, if I just do a scan, you can find everything that's in a bullish zone or a bearish zone. You also have the market trends, new blues and new reds. And so those are the explorations that are available for that, Kenna. Thank you for the question. And there's also another one, but I think it's called Swing Trade. Buy arrow and sell arrows. So between the 3 different scans, you can kind of scan for just about anything that you want. But there they are. Yeah. And there are, Ghana, if this is something that you want to look at, we do full hour-long trainings on youtube.com/Metastock that I'd recommend that you go through as you start to play with this, because I did kind of run out of time. Let's just say it that way. Okay. So that's the RMO system, though. I'd very much recommend you look at it. It's a great system. Again, it's a system that I've used in Metastock for a number of years. Another system that I'm kind of proud of, and I'm just going to give you a 30,000-foot view of. We do have trainings on this. So I created this with Gary Burton, somebody that I met with the Australian Technical Analysis Association down in Sydney many, many years ago. But he has a method that was written about by Siki Shimizu that classifies bars and shows you how to use them. If you're using Metastock, start playing with the Haguro method, maybe go see some of the other trainings. This is a method that's actually really, really cool that just has to do with candle breakdowns and looking at bars and kind of identifying significant movements in charts. It's designed around a weekly basis, and it's a very, very cool thing that I built. I had Dennis Peterson review it in Stocks and Commodities magazine, and it's a really, really interesting system that I think you'll like. Anyway, watch the YouTube on it. So there you go. Okay. Let's talk about Metastock for really just a few minutes. As I kind of stated, we kind of showed a few of the things. We're going to talk a few more times about Metastock. I certainly just covered some of the things that I like, but we're talking about scanning and how you can test trading ideas. And the thing that I want to kind of reiterate is Metastock's been rated #1 in its price category for 30 years in a row. And I want you to try it. You know, there's a reason that so many of our customers, like I said before at the beginning, have used Metastock for just decades. And I think, and I might be wrong, that it's because it helps them find better trades and it helps them trade more successfully. And that's what our surveys say when we kind of talk to our customers and ask them what they're doing. So what we're going to do here, we have a real-time version and we have an end-of-day version of Metastock. The real-time will start at about $265 a month. Not only does it include everything I've shown you with like the Metastock and all the charts that we're using, it actually includes a institutional level data feed that includes institutional news from Reuters. It's really literally a very similar product to what you would subscribe to if you subscribed as an institution or a hedge fund. Some of the best news on the planet at a fraction of what you'd pay for it. So the normal cost on Metastock for real time is $265 a month. That includes the Zenith, it includes Metastock, it includes data. It doesn't include some of the real-time exchanges that you might pay for, okay? We also have an end-of-day version of the program that starts at just $69 a month. The difference is if real-time data is available or not, and it's $69 per month, okay? What we're gonna do here all week long is if you're interested in trying Metastock, we're gonna give you basically what we call our extended trial. So you'll pay for a month of Metastock and we will give you the second month of Metastock and the third month of Metastock for free. So like if you do the DC version, you'll pay $69. Right now it's November 6th, and yes, I had to check, December, January, February. You'll be running this until February 6th as part of that 3-month trial. During that time, you'll be able to play with Armo, Haguro, the support and resistance stuff, test trading ideas, all of the hundreds of systems that are built in there. And you're gonna have a really good idea. Is this something that's gonna help me be more successful in the market or not? And for that trial, if you go 69 divided by 30, or by 3, it's about 23 bucks a month. You'll pay $23 a month to literally try the software that's been rated #1 in its price category for 30 years in a row. So that's how it works. You'll get Metastock 18, you'll get the data region of your choice. We're going to give you a training CD that's called, or not CD anymore. It's an online training course, Unleash the Power of Metastock. Normally it's a $99 value, but we throw it in every time. We want you to understand how to use Metastock. We want you to understand why it's so popular. And in addition to that, we do what is called a white glove installation support appointment, where we'll have somebody sit down with you. If you want to learn how to run scans, they're going to show it to you. If you want to learn how to use Armo a little bit more, they'll show it to you. Basically what they'll do is they'll sit down with you and just say, hey, what do you want to do with Metastock? And they'll help you accomplish it. That's a 2-hour appointment, and you get unlimited support. So as long as you have a Metastock subscription, if you ever have any questions, you can contact our group over here and right here across the office from us, and they'll answer your questions. It's $23 a month. It's been rated #1 30 years in a row. So we'd be happy to send you more information. We'd be happy to get you set up. It's an easy decision. 800-882-3040, metastock.com/sales chat, metastock.com/conf promo. Get in touch with us. Try it out. If you don't like it, there's no ongoing commitment. But I actually hope you try it out. I hope you're one of the customers I'm talking about in another 10 years that's been with us for a decade. So give it a go. It's a great software program. And I have seen, over the years, I've seen so many programs come and go. This is something, the thing that I love about Metastock is it grows with you. The more you understand how to trade, the more, it's not something that you're going to quickly outgrow. Spend $1,000 on and forget about it. It's something that will grow with you as a trader. Marius says, I have it, same, like Bloomberg. It's like a Bloomberg terminal and I love it. Marius, thanks for using Metastock. I appreciate that compliment. So there you go. 800-882-3040, metastock.com/sales chat, metastock.com/conf promo. Let me get this earpiece in again. Hopefully nobody's been trying to get attention. And let's kind of move on. Marius, thanks for using Metastock. I appreciate you coming in and kind of giving that compliment on it. Okay. All right. Let's say thank you to AAII. You can find out about AAII at AAII.com. They're a great, very well-respected, well-reputed organization. We're happy that they're supporting our events. Again, AAII.com. If you want to find out more about them, thank you for the sponsorship. So, and we just talked a lot about Metastock. I spent a whole hour on it. So let's move on to our next speaker. Towards, it's just going to get worse, folks. As we get further into the week, I'm gonna be worse and worse about pronunciation. But our next speaker is Melissa Armo. Melissa likes to talk about gaps. I love to kind of hear her take on finding opportunities in the market. And she always does a really good job. And so we always bring her back, and she always does a good job. It's a circle. Melissa, how you doing?
Hello, can you hear me?
I can, yeah. And I just remembered it. I just realized as soon as I said, Melissa, how you doing, that I didn't check to see if you're there. But you're there, so it's good to see you. Let me go ahead and make you a presenter here. Okay. That came through, or that should be coming through. How are you today?
I am doing wonderful. Thank you for asking. I hope you're doing well too.
The show is going awesome. People are asking great questions. Everything's gone well so far. So yeah, everything's good. So I'm going to go ahead and get out of your way. It's all yours. I can see you, I can hear you, and I'm here if you need me.
Terrific. Thanks so much. Welcome, everyone. Good evening. It's 5 o'clock here in Manhattan, and with the time zone change, it is pitch black dark out right now at 5 o'clock. Now that I'm talking to you, we had daylight savings time yesterday. So it is a very interesting time to trade the U.S. stock market. And of course, I am here to talk to you about trading, about making money, and specifically about shorting. So we're going to talk about making money fast shorting. If you have questions as we go along, I can see them in the chat. If you want to ask me questions as we're going through, that's fine. This is me. If anybody doesn't know me, I appear on TV. I talk about the stock market. I talk about economic issues that come up. And again, all of these things are related. If you have questions, you can always go to my website at www.thestockswoosh.com. You can also email me at melissa@thestockswoosh.com or call me at 929-3200-GAPS. So again, I appear on TV mostly to talk about the stock market. Where do I think the market is going today, tomorrow, next week? Again, we're living in very interesting times. We had quite a bit of a rally. I'd say almost a few power trend days in the last week and a half. And now today we've seemed to stall. So it'll be interesting to see really where the market goes between now and even Friday. But trading is a great job. Trading is a great job. It really offers a lot of freedom. And one of the reasons that I like to trade and why I'm interested in trading the market is because of the fact that I don't have to be chained to my desk for 40, 50, 60 hours a week. So when I first started trading, I actually was doing mortgages and I worked a lot of hours. And then I got into the stock market. And one of the reasons was I wanted to switch careers and I didn't want to work as many hours. Not only is the market only open from 9:30 to 4, but I focus on the morning trade. So I'm really pretty much done trading within the first hour of the day. So you don't have to be even at your desk during the full time the market is open. And of course, you also get weekends off. So this is a picture that I took, actually. It looks like a postcard. It's a picture of Central Park. I live in Manhattan along the park. And ever since I moved to the park, I have such an appreciation now for Central Park and for nature. And it's so nice to be able to trade in the morning and then go outside and enjoy the fall and the park and everything that Manhattan has to offer. And obviously, if you live somewhere and you want to go golfing in the afternoon or spend time with your children or whatever the case may be, you have that freedom as a trader, specifically as a day trader, that you can do other things with your life. Because again, this is not an 8-hour-a-day job, but you've got to make money. And you have one goal when you trade. And that one goal obviously is to make money. So a lot of people attempt to trade the market and they fail because they don't know what to do. But really, why do people fail? They fail because they don't have a successful strategy. And I'm here to tell you that you can be successful trading. So this is a video, actually, I have a video on YouTube. If you want to go to my YouTube at the Stock Swoosh, of a woman that did my class many years ago. She is a full-time trader. When she came to me, she never traded before in her life. So people always ask me, what if I don't know anything about the market? You can learn from the ground up. And when she started with me, she was working 2 jobs. Then she quit the one job. Then she went part-time, and now she is just full-time trading, and she quit both her jobs. So it may take time for you to get where you want to be, but I'm telling you that you can get there. I'm telling you that you can do it. And that the reality is that you don't have to take forever to do it. I think that so many people are at this for so many years. And then after a while, they just they keep trading, they keep losing money, but they never really believe that they're actually going to make it. But I'm telling you that you can make it. You can. I see a hello there from Alan. Good to see you. And anybody else, you can chat in the room. So again, getting back to what I was saying, many people find trading success elusive. Why? They just don't have a whole idea of what to trade. They have no idea. They don't have a system. They don't have a system to make money. They have no idea. I get up in the morning and I have a whole list of stocks I want to trade. I have them all figured out, a whole list of things I want to trade before the market even opens. And how am I able to do that? Using my strategy. So I get ready in the pre-market. I make a list of things I want to do or things I'm going to watch as a watch list, so to say. And I put in also the stats here. I don't have time to go over all of this, but this is all the trades that we've done in the day trading room so far this year, 2023 through, this is actually, I have to update this. This is through the beginning of October. But 450,701 to date stats in the day trading room. This is day trading on margin equity trades. So my day trade room is a day trade room where I'm calling the trades live in and out of the room quickly. And if you're interested in a trial of the trading room, you can email me as well for a free 1-week trial. These are the stats for the options newsletter. So I risk more money in my options. That's one of the reasons why the stats here are more 1.739920 million for the year to date for options. And this is because I'm risking more in my options trades. One of the reasons I'm risking more in my options trades is because I want to hold overnight and I want to take larger positions to get bigger moves in stocks in the market. And again, you can trade options even with one contract with a small risk if you want. You do not need a margin account. Now, I get this question all the time. The room is not an options room. The room is a day trade room. The options is an options newsletter. So if you want to sign up, if you want to do options with me, you would sign up for the newsletter, and that's what you would do if you wanted to get my options trades, just so you know. So anyways, we're going to go through and we're going to talk about some of these trades. But before I even get started, I want to talk about this. Let me just move this here. Trading really takes a positive attitude. So again, as I said, I live in New York City. So the New York City Marathon, the 2023 Marathon was yesterday. So it's the first Sunday in November. I did not run in the marathon, but I was a spectator of the marathon. And it was an unbelievable experience for me yesterday to watch the marathon and watch people go through. So if you could have watched it on ESPN, it was actually on ESPN. But it was so motivational, so inspirational to watch people yesterday run this race. It's 26.1 miles. It starts in Staten Island. They go over the Brooklyn Bridge, which is a famous scene. And people train for months, some for years to run the race. Some people don't train. They just want to run it. It's their dream. They want to do it. I saw old people, young people, skinny people, fat people. I saw people from every country, 153 countries, 50 states were there yesterday. 50,000 people ran this race. They had a wheelchair division. It started out the race where people were in were actually started the race and moved their arms through 26.1 miles. And they were the first round. Then it was the women. Then it was the man that won, who actually broke a world record. It was just unbelievable. And I watched it. I watched it all yesterday. It was the whole day. So it started at 8 a.m. and like the last people came through like around 8 o'clock at night. And I could see the whole thing because where they rounded the bend into the final stretch was right where I live. And I got tons of videos, which you can see on YouTube. I didn't even have time to post them all. But yesterday was so inspiring to watch these people. But the people at the end were the most inspiring to me because they were not professional runners. So there's different waves. There's like 5 waves when you run. Like obviously the people that won were very, very fast runners, but the people towards the end were barely getting into the end. I mean, they could, like I took videos again, I haven't had time to post it. Like they're towards the end, people were carrying people over to the end, over the finish line. Like, and there's one person that was hanging on the edge of the gate, and somebody came up, just total stranger came up and helped them move along. Because by the time you get to the point, where you enter Central Park and you go through to the finish line is at, in Central Park, you've got to make it. You've got to cross. If you don't go over the finish line, you do not get a medal, and everybody wants a medal. This is where people were taking the pictures at the step and repeat. But it was so inspiring just to see the people the last couple hours, people that could barely walk that were pushing through. And the thing about trading is so many people trade the market and so many people give up, quit, want to quit. And what I found, and again, I've had the business now for 11 years going on 12, where I've taught people what I know. I've been trading for 15 going on 16. But it's like so many people trade, risk money every day or every week trading the market, and they have the shittiest attitude you would ever find. They'd never make it to the end of a race. They quit before they'd even give up. And what's crazy to me is people trade and risk money and actually lose money, and they have a crappy attitude. How do you think you're going to make it in this business if you don't have a positive attitude? You need a positive attitude. And we all need inspiration. The motivation should be to make money. That should be your motivation to do it. For me, it was a combination of money, and I really wanted a different career. I was so tired of doing mortgages and dealing with the crap with banks trying to get loans approved. Again, this was 2007, 2008, when mortgage companies were going under. So I was extremely motivated to change careers. I was working way too many hours, and I wanted to work less hours. And I was also really motivated by money. But there's far too many people that attempt to successfully trade the stock market that have a terrible attitude. So you say, well, why do so many people lose? They don't have a good strategy and they have a terrible attitude. And they may say they have a good attitude because they trade every day, but they do not. They would never be able to run the 26.1 miles that the people did yesterday where they're barely getting over the line. They would quit. They would quit right at the end. And you can't. So yesterday, just watching people, and again, I caught people on video. I mean, it was insane. I just haven't had a chance to put all the videos up on YouTube, but it was extremely motivating for me because in a world and an industry where so many people give up, so many people quit, so many people have a negative attitude, it was motivating for me because, again, part of my job as a teacher, as a trading educator, is not just to teach people my gap strategy. It's also to motivate people to keep going. Because again, everybody has a different situation. Everybody has a different circumstance. Everybody has a different amount of money that they're risking. Everybody has a different learning curve, so you have to have a positive attitude. But in order to become successful, you actually also, besides positive attitude, you need a system and you need a niche. And for me, it is shorting. But again, there's only, one winner on the opposite side of every train. Just like the marathon, there was only one winner yesterday. And again, another similarity, I was thinking about this too, because like I said, there was different waves of the marathon. The guy that won was so fast, like 2 hours and some minutes or something. Then there was a couple guys that were in the original pack with him, the fast guys that were right after him. Then the amount of time from those fast few people to the first wave of people was a long time. And then the amount of time from that wave of people till all the rest of the people up until 8 o'clock was far off. And it's just very similar comparing it to trading because, again, you have people at the top that are making tons of money. And then you have the people in the middle that are making a little bit or maybe break even. And then you have all the rest that are losing money trading. And again, the dichotomy between the winner and the loser is so vast, so wide. Even though yesterday everyone that finished that race was a winner as far as I was concerned to make that distance. But it was 8 a.m. to 8 p.m. at night, which was 12 hours. So the similarities with trading is, again, everyone wants to make it. You have to look at it as something that you have to keep pushing forward. It may be 10 steps forward and 2 steps back, but you need a good system in order to succeed, and you have to follow it daily. And for me, it's gaps, and that's what we're going to talk about. I'm focused on momentum. I'm focused on volatility. I'm focused on shorting, and I'm focused on the fast trades because I like the idea of having the rest of the day to myself. Like I said, I also like the idea of shorting because it's something called pattern. So let's talk a little bit about what is a gap. A gap is the difference between the close and the open. This is a chart of the SPY. Back here in September, you saw a gap in the market. So a 4 o'clock close was here in the SPY, a 9:30 open was here. So a gap is the difference between the close and the open. In the case here of this was a gap down, the market fell. There are also bullish gaps in the market where the market gaps up, closes at one price, opens at a higher price. That happened in here. This was early October. Market closed here, open higher, rally, okay? So I try to focus on gaps and specifically bearish gaps, but I'm looking for momentum. I want the gap to go fast. I want to make money. I want it to go really fast. Hopefully it'll go within 5-10 minutes if we're doing a day trade. And if I'm doing an option, I'm doing the weekly options. But again, if someone said to you, if you can make $1,000 in 5 minutes, you'd rather do that than make $100 in 5 minutes. I mean, it's just like a no-brainer. And again, so many people are scalping. They're trying to get 10-cent moves, 20-cent moves, 25-cent moves. I'm trying to get $1, $2, $3 or more. Okay, I really want to get, lots and lots of fast, big moves. And I'm typically not doing things for pennies. But again, getting back to it, the key to day trading stocks successfully is using a system and trade a system that sets up daily. So again, I'm looking to one that sets up daily. That's what I do. And particularly that doesn't really need the market, because again, if you need the market, then you better read the market right every day. And that's very difficult. Even I don't get the market right every day. Now I do get the market right a lot because the market gaps almost every day. And then I'm reading the gaps in the market, but I don't trade the market every day. I don't even want to or try to trade the market every day. There are trades that I do in the market, and you'll see some in this lecture, but they don't always set up to be what I call predictable. But my system is called the Golden Gap System, and you can use it to trade options. You can use it to short in an option, which is what? It's called a put. So a put is a short. So we buy puts and sell them, buy calls and sell them, okay? And again, if you're day trading in the room, we're on calling the trades live in the room, we're trading on margin, we're all short 2,000 shares of something, you have to have a margin account to do that, all right? Now, I'm gonna go over, this was 1 week here, and I could have put in any week, but I put in 1 week of trades from the options newsletter, the week expiring October 20th. This is an average week. It may seem like a busy week. There was 15 trades. This was earnings season. We've had weeks where we've had more trades than this. We've had weeks where we've had less. And I'm using an advanced trader risk because that's what I trade. And that was the stats I showed you earlier. You can use a beginner risk. You can risk $500 per trade. You can risk $250 per trade. Well, some trades you maybe won't be able to do if we do like a NVIDIA and it costs $15 for one contract, yes. But most of the trades we do, I would say, are between $1 and $4 per contract. So I'm going to go over a whole week here of trades with you, and then we're going to go over some stuff at the end. If you have questions as we're going along, you can ask me. But the win ratio for this week, and again, these were all gaps, all based on gaps. We had 12 winners, 0 break even, 3 losers, and 15 trades. The average return investment was 136%. With an $8,000 per trade average risk, and I know that's a lot, but again, you can risk less. But the profits for this week was $162,100. This shows you the potential that you can make if you can get to this point in your trading career. And again, I think this is important. I think this is important to motivate people. If money doesn't motivate you to trade, then you need to do a status check. Because trading is about making money. Because you're going to lose if you're not motivated to make it. Now, while there may be other reasons that you want to trade and you're motivated to trade, as I told you, I wanted to change careers and I wanted to work less. The fact is, you have to be driven by the money to do it. Because it's a zero-sum game, like I was explaining earlier. You want to win. There's one winner and one loser. Now, how do I come up with these picks? How did I come up with the 15 picks? And again, there were a few that launched, and we're going to go over them here. I get up in the morning. My process is I rate the gap. I get up in the morning, I rate the gap using the checklist. So the checklist is what you would learn in my class. It is a 26-point checklist where you rate the gap. If the gap rates 20 points or more, okay, I take it in the direction of the gap. So in other words, if the gap's down and rates 20 points or more, I will buy a put. The gap's up and rates 20 points or more, I will buy a call. I'm looking to trade momentum. So I have my whole list of trades, everything picked out in the pre-market. When I see the gap, everything rated before the open. So many of the trades that I call on the options that are sent in the pre-market before the open. Now, as far as the day trades, I'm just doing the day trades live in the room. If you're in the room, you got to be there live to get the trade. The day trades are not emailed to you. You don't have to be in the room to get the options trades. They are emailed to you. I may send a trade out at 8 a.m. You can't do that options trade until 9:30 after the open. Someone says something about the Boston Marathon. Yeah, if you're in Boston and you watch it or you ever ran it, again, another very motivating race. Anything that challenges yourself to accomplish something or do something that you never did before. And again, getting back to relating this to people who trade the market, that's telling me, I hear people's sob stories. I hear people's stories. I can empathize with people. But if you tell me you've been attempting to trade the market for 20 years, 15 years, 10 years or more, and you're not successful, what is going on? You obviously do not have a strategy that's successful. That's number one. Or number two, you're not motivated enough to make it happen for yourself and do it. And something has to change. You can get motivated like that, okay? It doesn't take weeks and months and years to get motivated. And again, you could say, well, I don't have the money to do this. I don't have the money to trade. I don't have the money to do. Listen, if you're motivated, you will find the money that you need to take my class. You will find the money that you need to open up a trading account and trade. You will get motivated and open up an options account with $2,000, which is all that you need in the bare minimum to trade options. You would only be doing a small position size if you did that. And you will build it from there. So everyone says, well, I want to have 100 grand before I even start. Okay, whatever that is. Meanwhile, again, weeks and months and years of your life go by and you don't get anywhere with it. You know, the other thing, again, I don't want to get too off topic here, but the other thing about yesterday that was so amazing, and again, you can really see it in my videos of YouTube of the runners, is that there's one moment in time, like right now tonight, it's 5:24 and we are here together and I'm here live with you. And Jen, you can ask me a question and I will answer it live. We will never have this moment again. This moment right now is the most powerful moment in the present moment. And this moment will never exist again. And it is very similar to when you're running a marathon and you've got to do it and it's only one day. And it's very similar when you have opportunities in the stock market to trade or take positions or put positions on or make money, make a lot of money, or even if you make a decision that creates a loss for you, where you take a trade that you don't know what you're doing and you lose. So you know, live moments, the present moment is so powerful. And so many people get so caught up, particularly traders, in the past and mistakes they've made and decisions that they made that they regret and trades they've taken and losses. If you're living in the past with your trading, you are working against yourself. And the sooner that you stop working against yourself is again the first step to the beginning of your trading career, which you could actually be successful. Because opportunity exists every single day in the market where you can make a lot of money or you can lose. And the choice is yours. The choice is yours. So, I mean, again, it's so incredible for people to understand this. And again, all of this should help motivate you to actually do it, to actually get somewhere, to actually be that person that you want to be. And it doesn't have to take forever, and it doesn't have to take a long time, and it doesn't have to take a million years for you to get to the point to make this kind of money either. You know, when I was started out trading, when I first started out, I did not know what I was doing, and I had to teach myself. That was a process of 3 years. You don't have to do that. You pay me for my class. You get the information in one weekend, and you learn it. Then I'm here to answer questions for you. That's invaluable, because I didn't have that. I didn't have that access. I didn't have, you know, one person to go to ask questions about because I created the system myself, you know. Anyways, let's go over the trades here. So this is what the newsletter looks like, okay? Let me just move this here. This trade I sent out at 10:05 in the morning. I call the LMT calls. I give you the symbol. I give you the strike. I give you the expiration date. The type is a call or put, okay? And this trade, so again, what was the date? Let me just see here at 10:09. So this we went long, actually. Even though I prefer to short, we did go long here. This had a move, rallied. This was a positive trade. This was a small one here. I held it as long as I could. I was trying to hold it. This did not work out the way that I thought, even though I made money in this trade and I exited with a profit. I wanted this to go much, much bigger than it did. I will give something till almost the very last day, to try to go. I gave this a long time, days actually, and then I got out of it. So this trade was positive. You would have made money in this. The stock rallied, but it didn't go the way that I anticipated when I first did the trade. Then I did BA. This was on October 9th, same day, October 9th. I did the 185 puts again that expired. The 20th, I like to do the weekly options. And again, depending on the date, if it's the middle of the week, I might do the farther week out. So 10-9, here was the BA. Where are we? 10-9. Oh, here, October. So again, this was one that we did that started to look like it was going to go and then flipped. Lost in the BA, held it into the very last day, ran it into the 20th. It rallied, then dropped, and I ended up losing in this. Now, I got out of it with something. I didn't lose the whole thing in this. It wasn't a total bust. You can see how the stock fell, and it was late. So again, timing is very important with options. I was early in this trade. We did another BA, which I'm going to go over here later. But again, I get out of it with a loss. Not a full loss, but I still lost in this trade. Then we did Oracle. This was the biggest trade of this week. We did the 109 puts in Oracle. 10-11. 10-11 was here. So again, I did the 109s. You see where the stock is trading here, right around 110. Fell off a cliff. So this one went the very last day. It was an absolutely huge trade. It cost $1.50. 60 contracts was a risk of $9,000. Sold at $725. Profit was $34,500. Return on investment was 383%. This was a huge trade. So let's just pretend you had one contract of this, or 10. Let's say you spent $1,500. look at what you could have made, 383%. And this is in, a couple of days, a week and a half, not even. You would have taken the trade here and you would have got out of it here. That's the type of trade that can also make your whole account if you have a small account, where you can double or triple, quadruple your account. Again, and that doesn't mean risking some absurd size. It's because of the return on investment that this trade offered. And again, we were talking about shorting. We were talking about momentum. What happened to Oracle? This was a put. This was a put. This fell. The stock fell. This is a big fat red bar. The stock got dumped. It was a dump. And the movement, again, is to the downside. Okay. One of the reasons I like to short is, again, you get big moves to the downside. Why? Panic comes in when stocks fall. This was a gap down. But again, it continued. We were already in the trade. We were actually already in the trade at the time. Then we did the BA puts, the 190s, but this was after that original date 10/12, which was here. So this one here was the one that was really the good one. Stock closed here, gap down, fell, dropped, boom. You see it? Again, here is the selling. Here is the stock falling. So again, we did the 190s. You can see this. So again, so many people, well, I want to do options because I can open up a small account. I don't need a margin account, but I don't understand the time value. We're trading momentum. Whether you pay a little more or pay a little less or hold a little bit longer or get out this point, this was a positive trade. You couldn't have screwed this trade up. If you got in here and out of it here, you made money. If you got in here and out of it here, you made money. If you got in here and out of it into the drop here, you made money. You couldn't have screwed this trade up. The stock price dropped. In fact, you could have held it down the very last day, which I didn't because the trade was up already, got out of it and made the most. It came down in here to 180 on the last day. So this was another really, really cheap one, in my opinion. $1.60 for one contract, 60 contracts was a risk of 9,600, sold at 750, 369%. This is a profit of $35,400 with this risk. So again, you could have bought one and paid $160, okay, which is $160. And you could have sold it at 750, and this isn't even the best price out. And you could have made 369%. And anybody that trades should be able to take one contract at this price, but if your risk is even like 500 or something, again, that was a put, that was a short. 10/12 in the afternoon, I called Tesla, the 260s. Again, another put. Let's take a look at 10/12, what Tesla did. Back, here we go. This was a nice one here, close here, gap down, boo, and there it went. Look at it. Beautiful, beautiful, beautiful trade. Again, this is one, I get out of it the 19th, you could have held it to the 20th, you could have held it to the very last day and made more money. It came all the way down to 210. This went 50 points through the strike from the point that I called the trade. So this is expert professional technical analysis to look at this to see it. It is my gap rating method that allows me to see on this particular date that Tesla will have the momentum to the downside and then take the trade and do it. So this was another really good one. This wasn't cheap though. $875 for one, 10 contracts, $87.50, sold at 38. Again, could have held it into the last day and made more. Profit was $29,250, return on investment 334%. So again, if you want to do one contract, you would have to be able to risk at least $875. Or what you could have done if you wanted to risk less, you could have actually did a contract farther away than that. That's another idea. Then we did do the market the same day, 126, the QQQs, the 369 strike. Again, this was a put. So 10/12, let's take a look at it here. Where are we? Again, boom, got the drop. Again, here's the momentum. The momentum here in the market's to the downside. We got it. We were already in it. We were already in the market short. Okay, again, a put is a short. So again, people want to trade and get a little bit here, a little bit there. You want momentum. You want a big move. This is a big move. You get in a trade a good spot. Whether you hold it or get out soon is neither here nor there. You're making money. You can take something, get out of half. You can hold the whole thing. You can even add. That's an advanced concept, which I'm not going to go over here today, but cost was $345. Number of contracts was 25, 86.25 risk. Again, sold at 9, 13,875. Return on investment was 161% for this trade in the market. We did the 369 puts. You could do the daily expirations of the market. I'm not doing those, but you could. Same day, Did the SPY, again, saw the market was going to drop and fall, which it did. We did the 434s. Let's find that here again. Boom, there it goes. And again, this is a sell-off. You're short, you want to be short. So again, if you think the market's higher, here, we were already short. We were down in trades before they went. So I was in the trade, held it through, rallied, the trade was down, made all the money, then stayed with the trade. Again, this is expertise. This is the point of coming to me and learning what to do. This is all about the right knowledge. This is how you make this kind of money. You have to know what to do. If you're going with a crowd of traders, you're not going to know what to do when you're going to lose. And that's above and beyond the negative attitude stuff we talked about earlier. Cost was $3.80. Number of contracts, 20, with $7,600 risk, sold at $750. Profit, $7,400. Return investment, 97%. Again, a nice trade in and out. Could have held this the last day too if you wanted to. Again, you take a chance when you do that, when you're up that much in a trade. Then we did Netflix's. Again, we did this one, 360s. Let's see where this one went. Showed 10, 12 here. And again, beautiful drop. Got it? Drop down. And there it was. Again, you see where it came down to. Went through the strike, through 360, through 350, came all the way down close to 340, and you're out. And you're out. Trading, you're in, you're out in the day trades in a couple of minutes. In an option, you get the move, get out. You get the move, get out. You chunk it out. How do you make money in the market? You get in, get out. Oh, this one I held. I screwed this up. I lost in this one because I held it too long. That was my fault. Here's what happened. You would have made money in this if you got out. I held it. So what happened here? This was positive. Then it had earnings, and I held the trade. So that was my error. I held it, and I lost in the whole thing. Look. I forgot that one. But this trade was a good trade. I was up in it. I didn't get out. So again, you kind of have to decide what you want to do. I thought this was going to continue lower. So that's rare, but I was up a good amount in that trade, and then I lost in it. I held it through. My expectation was that it was a 50-50, that it could go in my direction further through the number, and I decided to hold it. But what you could have done here with this one is you could have actually got out of half, booked half, and then held the other half. But this was a personal decision here. But this was a positive trade. But I'm showing you my results. I lost in it. The stock had earnings this night, gapped up, and then it failed. So that is the price that you pay. But this was positive. It was expensive. I'm just thinking back in my mind what was going on in my head. I think I wanted to hold this because it cost so much. It's like 2 weeks ago. I think that's part of me thought it was going to be lower in the earnings. That was number one. And then also it was just so expensive. But that trade was positive for some people who trade with me that got out. The conservative thing to do was to get out, actually. IBM, we did the 140 puts. Again, expired this day. We did this on the 13th, 9/11. 9/11, 10/13, let's find it. Oh, here. We did IBM, this was earnings. Stock closed here, gap down, dropped, boom, fell. So again, we did the 140s. So we didn't, got the drop. You could have got out here, or you could have held it into the drop here. This gap down here, this particular morning, dropped in here into 136. Again, I'm someone that does tend to try to hold my options a little bit more. So I get out of the day trades fast, and I try to hold the options a little bit. $1.50 was the cost for this. 50 contracts, 7,500, sold at 3. Profit was 7,500. Good trade. Again, if you can't watch your trades for the targets, even though I give targets in the newsletter, you can just get out when you're up at 50% or 100%, put a sell order. It's a day order. It'll cancel out if it doesn't hit by 4. Then we did the BA again, the 180s on the 13th. This was another one here. You see here, we did the lower strike. So again, this dropped, fell into 180, got the drop. So again, that one was a nice one, but no, I lost in this one. I didn't get out of this one either. Boy, I was a pigger this week. I forgot that too. No, I got out of this with a partial loss. I should have got out of that when I was up too. This was a good, this first drop in here in the second day was the best exit here. I'm just looking at this. You see that? Or even here on this day here. See it? But I'm losing the whole thing. What about 365 Qs we did on the 13th? Here, this was the one we were talking about. I did a different strike. Different day, different strike, fell, dropped. Again, same move, same downward momentum. This was not expensive, but $3.40 for one. 25 contracts, risk was $8,500, sold at $950, profit was $15,250. Return on investment, 179%. It was a good trade. So we've been talking about this as far as, you know, getting out with positive, whatever. I think you have to decide what camp you're on. So like I told you, how I manage trades is I'm trying to hold them for a little bit longer with my options. Fast trades for the day trades, hold options a little bit longer. As you see here in some of these trades, I was up in some of these trades and the options, and I didn't get out, and they reversed against me. So you have to decide what camp you're in, because some of these trades that I got huge, huge moves in, you know, 200, 300%, almost 400% return on investment is because I held them. So again, you know, if you decide to do that, you will take losses in some like I did that you were up in. That is a personal choice of something that you want to do. I found that if I take quality trades and I give them a chance to work and hold them a little bit more, I will get something more out of that. It will benefit me more in the long run, that the ones that I lose in, that I was up in, that I will make far greater by holding the ones to get the bigger move, if that makes any sense. Any questions here as I'm going along? Nice presentation, thank you. Then we did the SPY. This was late in the day for me, 11:26.
Hey, Melissa?
Yeah, go ahead.
Yeah, we do have some questions from YouTube if you want me to, if you have a chance for them.
Yeah, go ahead.
Lewis wants to know, do you work in the money only?
No, some of these are at the money.
Okay. And what indicators do you use to get the entries?
I'm not using indicators to get the entries. I'm using the gap, my gap analysis. Like here with this SPY, again, we were talking about a gap. This SPY was on the 1013 here. I'm playing the gap. So I'm playing the gap. It's nothing to do with moving averages or indicators or anything else like that. I rate the gap in the morning using a checklist, which is what I teach in the class. And if it ranged 20 points or more, like I said, I will take a trade in the direction of the gap. That trade could be a day trade, or that trade could be a put. And going back to the strike question, I will do it at the money, or I will do it away from the money. I'm rarely doing things that are in the money. Maybe they seem like they are here with these charts, but rarely am I doing them in the money because I find that those are too expensive. If the market was trading today at 400, I might do an at the money 400 put. If I wanted to short the market, I'm not telling you to short the market tomorrow, I'm just saying, or I might do something that's 395, where if I see 395 is going to be the target, that I feel like it's going to drop into 395 or it's away from the money.
Okay, we're caught up on questions. Except Douglas just had one. If option trade is up big, do you protect profit by selling an option? Thanks for the question, Douglas.
Yeah, I buy the put and sell it. I buy the call and sell it. I am not selling options. If that is your question, I am not doing that.
All right, you're all caught up. Thanks.
Yeah, if you want to protect your profits, then what you should do is get out of half. You should get out of half or just get out of the whole thing, you know? So again, I don't use stops for my options. The risk is the stop. Again, I did this SPY. This is it. I can't lose any more than this. If I take 25 contracts of this and risk 81.25, this is my stop. I can't lose any more than this, and I'm not killing it in the middle of it, as you can see. So, I mean, again, if you did 25 contracts, get out of 10, get out of 15, hold the rest. You can't lose then. Anyways, the cost of this was $325, sold at 7, profit was $93.75, return on investment was 115% for this one. Again, a drop in the SPY. CVX was a call, if you can even believe it. We did a call in this on the Friday. And again, this was 1013. 10.13, and this one I got out of 10.19. So this was 150% return investment, but I got to be honest with you, this one didn't work as what I thought it would either. So I had a good trade. I was up more than 100%. I got out of the trade, but this didn't really do what I anticipated either. It was a good trade. It was a positive trade, but it didn't go as big as I thought that it would. So again, you know, you have to book money. You have to watch it. If you're up in a trade the day before the expiration, this was the day before I decided to get out. Then we did the SPY 425s on Friday the 13th. This dropped, fell. That was a good trade. This one I got out of the very, very, very last day, which again is rare, but it was up 33%. Then I did the 360s and the Qs and got out of this one the last day too and made 85%. Again, the market was cooperating the last day. So there were some that I was up in, but barely, and some of it was down or flat and going into the Wednesday of the week. And I just wanted to hold them, and I was up so much in the rest of them and I gotten out of stuff that I decided to hold it. So, you know, I will try to do a video on YouTube, a beginner risk for this week. I have other weeks on YouTube. I'm trying to do the whole month of October. It's just, there's too much going on in my life right now. I don't know if I'll get to that, but I will try. But anyways, to show you how, like we were talking about, being motivated, something that can motivate you to do it, whether it's half this risk that I'm taking, whether it's more risk that I'm taking, whether it's the same risk that I'm taking, whether it's everything that you can do for yourself. It's the idea of being motivated. I do not show my checklist because that's what I charge money for and teach in the class. Whoever asked that, that is what you pay me for in the class, which we'll talk about at the end. As far as, again, technical indicators, we talk about that more in the class, but I make the decisions based on the ratings. I think that's it. If you want to learn more about candlesticks or charts or any of that, you should ask Jeff. Jeff has all of his programs with the charting. And again, that's very important to have live charts as well. So getting into the end here, just a couple more minutes here. I'm just going to talk about how my niche is shorting and how you really, I think, need a niche to be successful. I'm looking at institutional money when I'm making the decisions and the choices that I make about the market or about stocks or anything else that I'm doing. I'm looking at something and I'm trying to determine if institutional money is going to sell it, in which case I'd want to short the stock, or if they're going to buy it, in which case I'd want to go long the stock. We went long Microsoft. It was, you know, one of those ones that got bought. That was the recent long that we did. But again, my niche is shorting. Okay. So how do you make money shorting? You make money shorting when the stock price drops, and buying a put is a short. And again, I'm not selling the put. I'm buying it and then selling out of it. That's it. And I'm not doing fancy dancy, you know, options configurations, but anyone could short. Anyone could short it all. You could buy a put, like I said, in an IRA account, in a retirement account. You could buy a put in a cash account. You need a margin account to short as a day trade. And for the day trades I do, I'm in and out very, very quickly early in the morning. But again, fast day trades are very important. So we are going to talk about a couple of these here. I mean, as far as this goes, okay, this is one that we did. Just want to show you here. This was Tesla. And again, these are small, but we shorted Tesla on a 1 minute chart. This was a day trade and we got in, got out. We've been talking about options this whole time, but I day trade every single day. So I want to show you, this is a trade that I called in the room. I did in a live room. You would do it with me if you were there. I tell you where to get in and where to get out, and we're done. And we were done in 5 minutes. So again, you have to have a margin account to do this. As far as another one we did CLX. This was 10.5. Again, very similar. This is a 1 minute chart where you would get in and get out. And you can see how fast the stock moves, how big the drop is. Again, here's the gap. This is the night before at a 1 minute chart at 4 o'clock where the stock was closed at CLX. This was earnings. Open in the morning here. And we got in, we shorted it. It was a nice trade. And again, these moves all happen very, very fast because panic comes in fast. Fear creates selling. And how do I make the picks? The rating system. So you would pay me for the information to learn the rating system. This is what took me 3 years of my life to figure out. I couldn't tell you it now in an hour if I tried. It's a 14-hour class, 16 hours, 1 hour break each day for lunch. And this is the meat and potatoes of what I do. You learn my system, you can use it for the rest of your life. I have been teaching people now for 12 years, going on 13. And again, my business is called The Stock Swoosh, but I started trading personally in 2008. I did not know what I was doing. I had no idea. but I started shorting early on, and I started trading gaps early on, and I realized there was something to that. And in fact, I made a lot of money trading gaps and shorting at the beginning, and that motivated me to try to figure out how to find the best gaps every day. It's the criteria. It's honing it down. You only need one good trade a day to make money. You only need one good option a week, really, to make money, quite frankly. You don't have to do 1 million trades a week. You don't have to do 1 million day trades. You do not have to sit at your desk and trade all day or even trade 15 options a week. You only need to get one good thing a day. That is all you need, a couple of trades a week. It's the idea of having a high win ratio, That's why I showed you the stats at the beginning. You have to win more than you lose. And that is another critical thing in reference to trading that people just don't get with traders. All traders who trade the market win some days. And they keep going thinking that they're winning, but they're not. They look at their account is down. They got to refund it. And it's a cycle. It's a vicious cycle until you get out of it. I know, because I was in it when I started. I was losing when I started. I did not know what I was doing, but that was the investment that I made in myself and then trading and figuring it out. But gaps are created with large institutional money. That's what makes the gap in the first place. And professional gaps that happen to play out in stocks are formed by one thing and one thing only, large institutional money. Therefore, you need a way that will help you pick the correct direction to play the gap and confirm that the large money will flow with it. By following the 26-point rating system, you have a daily blueprint. It's like a blueprint to follow to pick the stocks. I'm not just picking them out of my head. I like this. I think this is going to work. No, I go through the rating system and rate it, and I go with it. That's it. Again, and if I lose in a trade, it might rate good and the trade may lose. That's the odds. When you trade the market, you're playing the odds. Again, just like the racers yesterday. The runners yesterday, the men's runners and the women runners. I caught the women. I caught the girl that won. The women, there were 3 women. They were neck and neck yesterday till the end of the finish line. Any one of them could have won until the girl that pulled ahead that won. So again, it's trading is odds. You have to put the odds in your favor. Sometimes you're going to lose. And that's the whole point of having to set your risk in something that you can afford. And again, when I do day trades, I do use a stop. It's a limit order stop. It's a hard stop. When I do options, my risk is my stop. And I say, if you're worried about a trade and an option, it cuts your risk back. But anyways, the system is a blueprint to help you pinpoint institutional money in a stock. And again, it's a checklist. It's a 26-point checklist. It's based on common sense. It's the idea that people get scared. They panic. People sell. And again, you can have a small account and trade. This Oracle trade, which was the biggest trade this week, I want to show you here. We already talked about it, but I just want to show you if you had a small risk, if you had risked $1,200, you could have risked less than that. But if you had risked $1,200, you would have made $4,600 in that trade. You didn't have to do anything. Take the trade and hold it to the last day. So, I mean, these are the kinds of trades that can really just grow your account if it's small to begin with, which people always want. You know, you got $5,000 in an options account, $10,000 in an options account, and you can make 30% on your account, almost 40% in one trade. That really gets you where you need to be to get up to the point to even build it up to have a margin account of 25,000. So again, what should you expect? An average of 1-to-1. We're looking for the 26 points. We talked about this. You need a positive attitude, and you really do need to get the proper education, because you're not going to make money if you don't have the right education. You can figure out a system yourself like I did, but that's very expensive, very time consuming, and most people will never, ever get it. But the point is that you must take calculated risk when you trade, and you need a plan of action for what you want to do. Now, I see some questions here I'm going to answer before I continue. Don't follow the off exchange. Don't follow the dark pools. Don't follow anything with that. No. As far as the day trades, someone's asking about the day trades and options. I call day trades in the room. There are people in the room that are doing my day trades as options. For example, the market, if I short the market and they didn't want to short the market on margin, yes, they're doing the daily expirations of in the day trade. If I call a day trade and a margin in the same thing, which I don't in every trade, and you're getting the options newsletter and the day trades, you can do both. I do both. If I call a day trade and I don't call an option in it, that means I don't think it's going to continue. Therefore, I would do it as a day trade, and I would get out when I get out of the day trade. Does that make sense? So that's up to you. If you're saying you want to be in the room, but you want to do options, then you got to get out when I get out. Unless I call an option in it. Does a pattern day trade apply in options? You can open up a cash account. You have to set it up as a cash account. If you set it up as a cash account, you're okay. If you set it up as a margin account, then you need 25,000. So yes, you can trade options without a margin account, but you must set it up as a cash account. That you work out with a broker. I'm not a broker. These are all good questions to ask a broker, but you can do it. And there are people trading options with me that actually have their account set up that way. And again, if you want a referral, let me know. Anyways,
I have another YouTube question.
Go ahead.
Lewis wants to know how important volatility is for your option trades.
If you're, again, volatility is your friend if you're trading it in the right direction. But I'm usually in trades before the volatility has hit. So, there was a couple back there. I don't want to go back because we're running close to time, but where I was in the trade was in my favor, then it booped up and I was in a put, and then it was against me, and then people were going long. This was in the market a couple weeks ago, and then we were already short. I was down in the trade, and then the volatility went back in my favor, and it helped me move to make money. So volatility is actually your friend. But again, if it goes against you in a trade and you've got a week left, if you know what you're doing and you rated the gap and the gap rated good, you should stay the course. And that's why I hold trades out to win or lose. Volatility is your friend. It will help you make money if you're in the right direction. If you're in the wrong direction, you're going to lose. But whether you have volatility or not, if you're in the wrong direction, you're going to lose. It doesn't matter. That makes sense. Something about 10-4. I don't know what you mean by that, Douglas. Anyways, penny wise and pound foolish. Just really want to quickly bring this up. So many traders that act like this, and again, I'm not British, but they get out of trades with pennies, and because they're worried about losing dollars. You saw some trades here that I was up a lot, and I held them through, and I lost. I'm not saying to do that, but the reality is that people get out to make a couple pennies. They'll risk dollars, and they'll make a couple pennies. Then they take cheap price stocks because they think they're going to make more, like low float stocks, stuff like that, things that I will never trade, or cheap options too. Or they pay for cheap classes or bad, inexpensive classes. They don't think they're bad. They just say, well, this is cheap. Well, I'm going to spend $100 on this subscription, $500 on this class. They say, well, and then they lose money taking the class. They didn't learn anything. And they also lose money taking the bad trades from whatever class they took or subscription instead of paying for quality education. So it's like a double whammy, and people do this. And people then go and take free trials. And then they take trades blind and they lose. I have no idea what they're doing them or not. Nothing, know nothing about it. And people won't trade expensive stocks when they could make money, really good money with, because they don't want to do small size. And then also another mistake, people put the majority of their money in a trading account and spend very little on education, and it should be the opposite. Yes, you need money to trade, but you have to divide it up. Again, I only take credit debit cards for the cost of the class, but the fact is you need money to trade, but you shouldn't be so worried about spending money on a class that you say, well, I only have this much money to put in the account, then I can't risk such much. No. If you are someone that has what I would say is a small account, for example, you have to be even more concerned about not having losses, even more concerned about it. So again, you shouldn't be worried about putting a class on a credit card, even at an interest rate of 30%, if you can make 400% in the trade. I mean, it's just like people just don't think when they make decisions about things because they're too small-minded. I'm trying to get you to think outside the box and to think in a way that successful people think, wealthy people think, people that make a lot of money. Let me just see here. Something about, I don't know anything about that, Hanson, so I can't answer that question. Let me just see where we are. This is a 26-point checklist. If you come and learn my class, you will learn a high probability directional bias for the entire day, big move of the day, early confirmation of the bias of the move between 9:30 and 10 a.m., and precise entries with follow through and a good risk to reward. So you learn the entries in the class, the exits in the class, the targets, the 26 points, and how I make the picks. The purpose of the system is to help you evaluate what gap to trade each morning. I'm going to teach you how I pick those 15 trades. Oracle, all of them. Reading the market. The 26-point checklist predicts the directional bias in a stock or the market. And again, you do not need a general, overall, broad-based view of how to trade. You only need one strategy, but it has to be good, and it has to have a high win ratio. And again, if your reason for doing this is to make money, you will make money. Go back to the original purpose. If you found yourself lost in your trading, lost in your mind, why the hell you're doing this? Go back to yourself. Why did you start this in the first place? You wanted to make money. You wanted to quit your job. You wanted to retire early. You wanted to have more money coming in to combat inflation and everything else. You wanted to save for a house, whatever it was. Get back to that purpose, because if you're trading and losing and it's November 2023, less than 2 months away from 2024, and if you're down for the year, I don't know if you can come back from the year, but you still have time left. And you got to put that positive face back on yourself. Douglas, I appreciate all your wonderful comments, but you haven't signed up with me, and you've been following me a long time, and I don't know why you haven't signed up if you love me, honestly. But I appreciate the nice comments. Anyways, it's a checklist. You go through it. This is a great example of a guy, and I have tons of people like this. He did the class in October. He paid for the class, started trading, and made the cost of the class before he took the class. That is not always the case, but he did. He paid ahead of time. He got in the room. He did the trades. It's just a win for him, you know. And so he's in the room and he's getting the options trades, and he did great. He's somebody that, you know, there's many, many success stories that are out there, but this is a recent one, and he was happy to send his picture and just loving the service. So he's one of these people that has been following me, and he jumped in and he did it. So again, the class is called the Golden Gap course. The class is $69.99. It's November 18th and 19th. It's not this weekend, next weekend. Only 2 more classes this year. 1 in November, 1 in December. I don't have the December dates yet. Class is online. It's a class on how to find, pick, play in professional bearish gaps. And I'm doing a New York City Marathon package. Look at that view. I took that picture. Anyways, the package I'm running is going on through today. And I've been running it for the last week. I know we had the webinar, but I'm offering to people in case you're here. If you think you want to sign up, it's the combo. It includes the Golden Gap course, the Trends course for $74.99. And it includes the options course free. It includes 1 year of the room and 1 year of the Gap Options newsletter. I was running this for a week. I just happen to have this webinar planned, but this does expire today. Again, think about what you're doing with investing your money. Think about the things that I said about what's going on in your head. You've got to stay motivated. And again, you have to think about the ideas that I talked to you about today. Save up, Douglas. I hear you saying save up if you want to take the class, and hopefully you can do it soon. I don't do Forex. It's not your fault, Douglas. It's just you gotta jump to it. You gotta hop skip to it. I'll say one last thing. I'll already go. Remember what I said. This moment in time, today, November 2023, right now, 6:02. This is it. This is your moment in time. We were here today together. You learned something from me. Hopefully you'll take something away from it. If you're interested in more information, email me at melissa@thestockswoosh.com. And please, please, please be careful trading the rest of the week.
Very cool. Thank you, Melissa. And that's melissa@thestockswoosh.com. I'll go ahead and type that in the chat real quick. I think you hit all the questions. I don't have any more. Good job. Okay. All right, let's go ahead and kind of get over here real quick. Let's see. Okay. The stock swoosh. All right. Let's going to do this. We're going to say thank you real quick to CMT Association, one of our sponsors for today. CMT is a very well-respected, great organization. And I just lost the page. But they can talk a lot about portfolio management, systems development. If you are managing money, you're looking to manage money, having a CMT designation after your name can be extremely helpful for that. You can find out for more about that at cmtassociation.org. Also, Tyler Wood is going to be here a little bit later in the week, I think on Thursday or Friday, to talk about how that might be helpful for you. But great company, great nonprofit to work with, cmtassociation.org. So right now we're going to take a little bit of a break. We're going to do a little bit of a prize drawing. And Greg, I'm going to have you help us out. So, Greg, are you there?
Just a second. Yes, I am here.
All right. We have a very, very special prize that we're about to give away.
All right.
You might have heard it. You might have heard of it before.
I'm listening.
Have you heard about Metastock?
Metastock. Is that is that Facebook?
No. Actually, no, it's not. But thank you for asking. And you wondered why I didn't have you help me earlier. But in any case,
I didn't
we're
wonder.
The original Metastock.
Yes, I've heard of Metastock.
All right, so we're going to give away 3 months of Metastock. We're going to give 3 months of Zenith data. Do you know what that is? Have you heard of that before?
Yes, Zenith with an X.
Yes. Very, very good news service. They spent about $1 billion on it. In terms of the initial design, I'm sure they're way over that. In addition to that, they have, let's see, more than 3,000 reporters in about 300 different news bureaus. Very, very good news. Some of the best. It's like getting Bloomberg, but way cheaper. So
I'm sorry, I've never Bloomberg. I've never heard of that.
Yeah,
Metastock and Zenith, I know. Bloomberg, I don't even know what that is.
We're also going to give away 3 months of Learn Metastock. Have you heard of that?
Yes, I have. By one Kevin Nelson.
Yes. So he has hundreds of hours of videos. He runs a service, does 3 webinars a week. We're going to talk a little bit more about that, but it's $99 a month. So we're going to give away Metastock, the data, the Learn Metastock. We'll even throw in, not only will we throw in a Unleash a Bower of Metastock, which normally retails for $99.
I feel like you're giving away the farm.
We'll also give away a white glove installation as well.
That's a lot.
So somebody will actually call you and spend 2 hours.
Our friends or family eligible for this drawing?
Yes.
Okay.
But you have to be random. So what I need
I'm
from you, though,
pretty
Greg,
random. Yes.
I just need any number between 1 and 9,525.
1 and 9,125. Okay. I think the year I was born, 1925.
Okay. Did you say 19 or 18?
Jeff, that's not even funny. That hit to the quake. 1925.
Oh, it's not working. Hold on.
Oh, do we need another number?
My numlocks was off. Amir H. Okay.
All
in
right.
the U.S. So if your name is Amir and your initial is H, and you're in the U.S., you may have won that prize. So
Congratulations,
I'll reach out to
Amir
you.
H.
I will reach out to you next week sometime. Kind of help. I need to get some information from you to kind of get you set up. But congratulations, you won. So, Yogs, in terms of your, thank you, Greg, for the assist. Appreciate that. Let's see. Melissa, does Melissa use the time frame 5 minutes, hourly, or daily charts? So she uses a lot of daily charts and she uses a lot of 1 minute charts. Thanks for that question, Felix. Yogs wants to know if we'll be emailing the recording. We will, but it's not going to go out until the end of the week. Here's a copy of the recording for today. And if you go to youtube.com/Metastock, you can watch all of the videos. They're all up there. youtube.com/Metastock. Like and subscribe. It helps a great deal, and we appreciate it. So there you go. All right. If you also want to get a copy of the 30-year in a row top-rated software, you can. If you pay for a month, we'll give you 3 months for the price of one. You can do that at metastock.com/conference promo, metastock.com/sales chat if you have questions or want to get some more information, and 800-882-3040 if you're in the US or Canada and want to contact somebody. So with that being said, our next speaker is Dan Passarelli. Dan Passarelli is a good friend of mine. I've seen him over the years. Very, very, he's great. He does a really good job. He's going to kick off the finale for us today. And we're happy to have him. Dan, how are you doing?
Hey, what's up, Jeff? I'm doing great. How are you? Long time no see.
Good. I'm doing great. It's good to have you. It's been a great conference so far. And I'm just looking, I kind of messed up my thing, but I'm looking to give you the control right now. So let me make you the presenter.
All right.
Okay. It should be coming through right now.
Yes, sirree. I see it. I see it. Show my screen. Oops, that's not the right screen. How about...
Do you know how to change it or do you need some help? You know. You're like, I've done 2,000 webinars. I know how to do it.
Finally.
All right, Dan, I can see you.
Okay.
I can see you and I can hear you, and I'm going to let you go.
Awesome. Well, let's do it then. Hi, folks. How you feeling? You feeling good? I'm Dan Passarelli, and I'm super glad to be with you here during this presentation right now, and really honored to talk about a key way that I've simplified my trading. It is the easiest, most straightforward system that we've created here at Market Taker. I'm super excited to share with you today. Before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by calling 888 options. Momentum trades are a totally classic trade. Thousands of traders have collectively made billions of dollars trading momentum trades over the years. And the beauty of it is the concept behind it's easy. All you have to do is identify the setup, see when the trade triggers, get a confirmation, and set a target. At the end of this presentation, you will be able to see and easily identify this specific momentum system I'm going to teach you. I was listening to a podcast recently. They were talking about the difference between mindset and skill set, and both are important. Henry Ford once said, "You can or you think you can't, you're right." And there's something like that, isn't there? So I thought, how can I make one of those things, mindset or skill set, really simple? How can I do a lot of the work for our traders so that you don't have to focus on both of these things at the same time? So I put my time into the only one of those things that I can pretty much entirely do for you. That's the skill set. I put this into a system that if you're following along, you don't really need much skill at all. The skill part is built in. So now all you have to do to move forward in reaching your trading goals is to think you can. This is my promise to you. I'm going to share with you how to easily spot high profit momentum trade opportunities using stocks, ETFs, futures, or Forex so that your trading is completely simplified using this tested, evolved trading system we've created for our traders that hundreds of our students have used to go from that demoralized feeling we've all felt at some point to that feeling of satisfaction and self-assurance we all know is possible. At the end of this presentation, I will share how you can take the next step so that you can start getting immediate results. Is that a fair deal? Yes, hit that questions box and let me know. Is that a fair deal? And don't be afraid to participate here. Let's make this fun today. All right, we've got a yes from Charles. We've got a yes from Jennifer, yes from Tina, a yes from James, a yes from Andrew. Excellent. Now, in order for you to get the most out of this, I ask that throughout this training and afterwards, make this about you. Consider turning off your cell phone, close Facebook and all that, and let yourself get immersed in what I'm about to share. Let this become part of you. And be sure to stay until the end of the training. The most important things I'll share come later. And to keep the focus, I'm going to hold all questions. If you have one, write it down. I will get to it. That said, let's keep it positive and have some fun. So this is a slide that shows who I am, what I do, some of the organizations I've worked with. I wrote 2 of the most popular books on option trading. I've worked with every major options broker in the US and abroad, and as well as most of the options exchanges. And I get to be on TV a lot, which is kind of fun. I got my start trading down on the floor of the Chicago Board Options Exchange, and I traded there for years. These pictures literally span 25 years of being involved with the trading floor. I traded some huge stocks like the Ford Motor Company, AT&T, Carnival Cruise Lines, and I traded some little ones no one's ever heard of. And a little secret here, the little stocks no one's ever heard of is where you can make some really great money when you know about opportunities that no one else does. I want to jump into a fairly new discovery I made. Does anyone know what this formula is? Anyone? No? Good, because we're not going to talk about it. Not again during this presentation because we don't need to, and here's why. I have an extensive background in trading, but the fact is I'm no mathematical genius. You mind if I share a quick story with you about a long time ago when I was in high school? Well, here it goes. When I was a kid, I was a little bit of a punk sometimes, and probably not in a good way either. Seriously, I did get good grades. Didn't really have to study usually, but this is a story about a time when maybe I should have. In my senior year of high school, in my advanced math class, instead of paying attention to the lecture, I and a few other of the kids would play poker. And that's all we did all hour long, the whole class. And man, I made a lot of money in that class. But the problem is, with math, the lessons build. If you miss something this week, you're lost next week and you're hopeless the week after that. So needless to say, I didn't learn a lot of advanced algebra concepts that year. I crammed, I passed, but I didn't learn much. Now, fast forward to freshman year of college, and I had to take an algebra refresher. Embarrassing, I know. I always prided myself in being smart, and algebra is not really that tough, you know. So now I had to take this refresher. Now, there's one thing that you might not know about me, and that is that I was the first Passarelli to graduate college. It's true. And I almost wasn't. Here's where the story gets kind of interesting. So I'm a competitive kind of guy, mind you. So my sophomore year of college, my cousin, Michael Passarelli, who's 1 year younger than me, was in my calculus class. Yeah, calculus. I was very intimidated by calculus. I was afraid I would struggle, but more importantly, I knew that if I failed the class and had to retake it, my cousin Michael would be a credit ahead of me, and maybe, just maybe, he would end up graduating before me. There was absolutely no chance that I was going to let that happen. So I put on my A game. I was ready to work as hard as I could to win, and I'm going to guess that there are some of you here who can relate to that, right? Will you do, are you the sort of person who does what you need to win? Hit that questions box, let me know. Put in the effort to succeed. Yeah? Just type of Y, make it quick. Tina, James, Charles, Lawrence. Okay, good. Yeah, because I mean, I am too, you know. So here's the thing. There's another factor that came into play that was a saving grace. I had a great teacher, one that I could relate to, and he made it easy for me to learn, and I did. I ended up acing calculus and had the honor of being the first in my family to graduate college. So thank you very much. So, like I said, I'm no mathematical genius by nature, but I've spent a lot of time in option trading over 30 years, and I do whatever it takes to create great trading systems for myself and for you. So I studied the math of things like relative strength index to see how they tick, and I realized that there are some hidden keys within these equations that can predict when momentum will continue. And now I'm going to share a hack with you. Discovering this specific pattern wasn't a fast process, and it wasn't easy. It took years until I evolved the system and my results were proven that I had a winning strategy. And we continue to improve on it. I put in the investment for myself and for you because now it's finally time for me to share it with you. This is the red knockout. Now, it's a momentum trading strategy that can lead to outsized profits. It's a very, very simple 4-part chart pattern. Easy to identify, and the profit targets are very easily set too. And you know what? You can use it with options, stocks, ETFs, indexes, futures, or Forex. Now, let me start by listing the steps in the red knockout system, and then we'll zoom in and go through some examples. So this stuff is important. Write this down. Step 1 is the setup candles. It's 3 or more green candles that make up the green run. Step 2 is the red knockout candle itself, which is a red candle with a smaller body. Step 3 is the trigger candle, which is a green candle that takes out the red candle's high on higher volume, ideally. And step 4 is the confirmation candle, which is a candle that opens above the high of the RKO candle, and that signals trade entry. So now let's break this strategy down step by step and go through how it works. Okay, so what's step 1 again? Do you remember? Step 1 is the setup candles, aka the green run, which is right here. I like to call it the green run because it's 3 or more consecutive green up day candles. That's easy to identify, right? Now, step 2 is the red knockout candle itself. That is if a red candle immediately follows the green run that has a smaller body than each of the 3 green run candles. All right, so far this is easy, right? Step 4 is the trigger candle, and that is a green candle that takes out the high of the RKO. So that all that means is that it trades at some point above the high of the red knockout candle, which this one did. And then finally, this is ready to go if we get a confirmation candle, which is a candle that opens above the high of the RKO. And if it does, that signals the trade entry. So now this is Bloom Energy Corp, BE, okay? If we have a red knockout setup, how about a little test here? What's the first step we look for? Setup candles, right? The setup candles are, again, what? 3 or more green update candles in a row. Do you see this on the chart anywhere? Well, right here, right? Here's the first one, second one, and the third one right there. So that establishes that the trade is setting up. Are you getting this? Now, what's step 2? Do you remember what that is? Boom, it is the red knockout candle, or RKO. If a red knockout candle shows up on the chart, super easy to identify, and it means the trade might be materializing. The RKO is a small body candle, again, smaller body than the 3 previous ones. And that it could open higher or lower, but the key is that it's down from the open, and thus it's red. Now, step 3 is the trigger candle, shown by this yellow arrow right here. That triggers the trade is indeed setting up, and you're getting ready to time your entry. We call this the trigger candle, and it's sort of like when a marksman is all set to fire upon the target, gets his finger on the trigger, and is ready to take the shot. Then finally, step 4 is the confirmation candle, and that means the trade setup is confirmed. It's got a green arrow. Green means go. Fire away. Now let's slow this down a little bit. Let's go over the roles of each of the 4 components of this setup. So first, there are the setup candles that make up the green run. So what this is, why this is important is this sets up a mini trend. A green candle means that the closing price is higher than it was when it opened. So we're actually looking for 2 things. Green update candles. So it's got to close higher than yesterday's open, which all 3 of these did, and it's got to close higher than today's open. So we're getting this momentum in there. Now, the RKO is next. In any trend, there's got to be like some sort of a pullback, or else it just burns itself out. And that's exactly what this is. It's a little mini pullback, okay? If it pulls back too much, the strength of the trend might be done. So it's just this tiny mini little pullback. Then if we get the trigger candle, that means that the momentum is maybe taking back shape, and all that was a little bit of a pullback, and we could see some more room to run to the upside. So then if we get one more, boom, it's go time. Green arrow, green means go. So now let's run through several examples to see how this might play out in real life. So this is Thomson Reuters stock. First of all, is there an RKO setup on this chart anywhere? Do you see one? Right there it starts, right? Nice work. That one, all the way to that one. There's 3 green candles. Now, we don't always get an RKO candle afterwards, but this time we do. And we don't always get the trigger candle, but this time we do. And that's good news. That means this is legit setting up. How do we know for sure if it's go time? We have to wait, because what we're really trying to capture is a strong little mini trend. And so when we get to this point, that's when we see that it is go time. And what we're looking for is for after the RKO candle, for the same strength that we saw here before it to play out again afterwards. And if we follow our profit target rules, which I'm going to elaborate more on in a second, we would end up taking it off. Whoops. We would end up taking it off here. All right. Okay. So what about here in Humana, HUM? Is there an RKO setup anywhere here? Look closely, look closely. Good job. This one has 6 setup candles. It starts here. And again, we can have 3 or more. So we start the green run here, then we go up, 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 up till the 6th candle. Next comes our red knockout. Why is it called a red knockout? Because in any trend, there's a pullback. And in this case, it's a mini pullback, just enough to enable traders who miss the green run move to get in and provide some follow through. So the red candle just gets knocked out of the pattern and we look for continuation. And that's just what we get. Here is the trigger candle. And we wait one more day for the confirmation and get in on the open. We always prefer to time the entry close to the open. Why? Because not always, but it's my observation that more often than not, if we get this confirmation candle, we tend to see it up over the day. It tends to end up being a green candle. Now, again, not always. There are going to be some times when that confirmation ends up down, even down on the day, ends up a red candle. But if we give it enough time to play out, it can still play out and it can still work out really nice. So here on confirmation day, all right, that's this one. You could have bought the 44 strike calls at $1.19 and sold them, and let's see here. Do I have this on the screen here? No, I guess not. You could have sold the 44 strike calls. Oh, wait a second. That's not right at all. Hold on a second. I think I've got my notes from a different slide here. Oh my goodness. Okay, well, anyway, we'll just skip over that. Now let's look at this example in TSWI. Now, if we look here to here, we have a 4-candle green run. That's followed by your classic RKO. Why is it classic? It's red. It's got a smaller body than each of the green candles. It's just this mini pullback. It's engulfed by the previous green candle, which means it's got a smaller range and it didn't trade lower, which is good because it's not a reversal. It's just a pullback. Then we get the trigger candle with the yellow arrow underneath it. Then confirmation 1, 2, 3, go. Isn't this easy? This is super easy. Our traders that use the more aggressive trade technique of getting in on the trigger candle, which is early, right? It's here, could probably have made this work even better, getting in at a lower price than the previous day. But some active traders take advantage of those scenarios and some don't. I personally like to be more conservative and wait for that confirmation candle, which is the classic way to follow this. The RKO indicator works on all time frames. It's versatile for day traders, swing traders, short-term traders, even long-term investors. Now, when I worked on improving what criteria to use for the setup candles, red knockout candles, trigger candles, and confirmation candles, I spent a lot of time on it. And it was a really great and humbling experience. It reminded me of my old boss, Steve Fawcett. You see two people here. The one, of course, is who? Sir Richard Branson, and the other is Steve Fawcett. Now, for those of you who don't know who Steve Fawcett is, the late Steve Fawcett he was not only a famous trader, but also a famous adventurer. He held many world records. He attempted to fly to set one flying around the world in a hot air balloon with Richard Branson. And I remember one day, Steve took all of his traders out to dinner, and there were about 45 of us. And after dinner, he stood up and he asked us, he said, "Why do you trade?" You know, it's not the money or whatever, the real reason, the deep reason. Why do you trade? As floor traders, standing all day long in a pit, your feet hurt, your back hurts. There are people yelling in your ear, getting their spit on you when they yell. Why do you do it? What's your real deep-seated reason? Is it to have more freedom, to take some time off and, you know, play Frisbee or whatever? To secure your retirement, put your kids through college? And that stuck with me. So I want to ask that same question to you. Hit that questions box. What is your deep-seated reason for trading? Please share. Please hit that questions box. I'm taking a little poll here, and I kind of want to know. Hit that questions box and tell me, what is your deep-seated reason for trading? Jennifer says retirement. Okay, that's awesome. Charles says to pay for my wife's college. Oh, that's cool. Usually I get my kids. Sometimes I get my grandkids. My wife's, that's awesome. Let's see. James says for financial freedom. That is a great answer. That kind of encompasses a lot of things, doesn't it? Tina says retirement. Lawrence says to leave to my kids. Lawrence, let them fend for themselves. No, I'm just kidding. That's a very noble reason as well. Cameron says growth. I love that one. Trading really helps your brain, doesn't it? Yoshi's, and I hope I said that right, says travel and freedom. Alan says to add to my Social Security income. Different Charles here says freedom. Aisha says to have more time freedom. Gary says to travel. I love this. And you know, Steve was a great mentor. Without having him in my life, coaching me, I could not have become the trader I am today. But there was one thing that Steve was known for saying: I'm still learning. When I met Steve, he was a gazillionaire, super successful trader, but he was always tweaking his process, always learning, always moving forward, always making his trading better for himself and his traders. And I'm super thankful for that because I was one of his traders. He kept improving. So I also started improving the process, the exit point in this case, for me and for you. And here's how it works. What we're looking for is the size of the green run. After the red candle, we're looking for a repeat of that move, a repeat of the green run. So we take the low of the first green run setup candle and subtract that from the last one, from the high of the last one. We take that sum and we multiply that times what is called a haircut, which basically just means a percentage of that actual move, so that if we make that less than 100, we'll get out a little bit earlier, be more conservative, and be more likely to profit. And we just add that haircutted value to the high of the RKO candle. Now, this is very, very simple. right? Very, very simple risk management. We immediately, after buying the stock or the option position, we set a profit-taking order, good till cancel, conducive with that math that I just shared. And if you don't remember it, I'm going to show you a way to just make it super easy in a second. And also possibly a stop loss, good till cancel, OCO, one cancels the other. Now, if we're trading a debit spread, which we're going to do on some of these stocks, we don't set an actual stop loss. We set in alerts, and that's all covered in a video that I'm going to give you the opportunity to see in a second here. Bottom line is work the system works. And if you're not familiar, by the way, with some of these terms or exactly how to do some of these things, later I'll share with you how you can learn how to easily do all this and make your results super simple. Now, I want you to leave here today with all the tools that you need to be massively successful with this. And I bet you do too, right? Would you like me to share with you what I've discovered that makes RKO trades even better? Yes? If you want it, show me, hit that questions box and give me a big yes. Give me a big yes if you want a couple of little tips and tricks here. I'm just gonna show you. I'm just gonna show you. Jennifer says yes, all caps with an exclamation point. James says yes. Charles says, of course, exclamation point. Lauren says yes. Yoji says yes. Okay, that's kind of what I thought. Maria says yes. Michael says yes. So Aisha says yes. So here's the thing. We want, Alan, Charles, oh boy, they're rolling in. Okay, good. So look, I'm going to give you some tips, and I need you to write this down because I don't have this on a slide, but I want nothing more than to have you have these tools in hand, right? So one of the things that I look for is the red knockout pattern, all 4 steps, does it at some point cross through one of the major moving averages, which is a 21-day, 50-day, or 200-day? Even though these are trades that can work on just a few periods, if you're trading on the daily candles, it could just be like a 3 to 5 day trade. But we still use the 200-day, the 50-day, and the 21-day moving averages. Another thing is if we're going to look at the RSI. If we have some relative strength, but it's not overbought, that's going to benefit this as well. If we have moving average crossovers heading in the same direction as this, that's beneficial as well. Now, in summary, there are a few important takeaways. Momentum trades can yield outsized profits for sure. And this is a time-tested, very evolved system. So we have the setup candles, the red knockout candle, trigger candle, confirmation candle, and the profit target. There's very, very simple math behind that. And very, very simple. I mean, I kind of think that maybe I did a good enough job where if you saw one of these on a chart, I bet you could identify it. I really do. I bet you could. But there's a problem. You know how many stocks there are in the market to trade? There's 6,366 listed stocks. If it takes you, say, 45 seconds to spot an RKO setup on a chart, which is, if I did a good enough job showing you how to do this, you'd probably spot one in 45 seconds. Couldn't be too much less. Hopefully it wouldn't be too much longer. But if you could, and there's 6,366 stocks, it would take you about 80 hours a day to go through all the opportunities out there. And that's only looking at one time frame. You trade multiple time frames, we're talking 160, 300 some hours a day. You don't like missing opportunities, do you? There's got to be a better way, right? And I bet you know that. You wouldn't be here right now if there wasn't a better way. Are you ready for this? So the RKO system is officially here. Over the past about 3 years, we've created both a scanner that would easily identify RKO trades, as well as an indicator that displays the pattern right on the chart along with the exit target. It calculates that automatically for you and puts that right there on your screen. We wanted to make it so simple and time-saving that it's impossible to mess up. Now, first, let me start off by talking about who this system is not for. Just to be clear, this is not a get-rich-quick scheme. It's just not that kind of strategy. This is about having more consistency in your trading. And this is not for people who love spending hours and hours going through thousands and thousands of charts to hopefully, fingers crossed, have a halfway decent trade. This is the fast track. Your time is valuable. These trades can literally be made in a minute because all the information is right there on the chart. Now, this is also not for wishy-washy procrastinators, overthinkers, wishy-washy people who see a good trade but just can't make a decision to save their lives. Well, they don't make good traders, right? But I know that that's not you because you've invested in yourself already. You've invested your time in being here, and that's very valuable. So let me tell you who this is for. This is for you. If you want your trading to be easier and less time consuming, this is for you. If either you're new to options and you want a simple, easy to follow system, or you're experienced and you want to increase your number of trade candidates without spending more time. And this is for you if you can follow a few simple steps. And this is for you if you're willing to invest in yourself. You now have a new opportunity to easily scan for top momentum trades you wouldn't be able to find without this screener. To easily visualize when an RKO trade is set up, when to enter the trade, and where the price target is. With over 6,000 stocks out there, I mean, it's almost impossible to just happen to come across one of these great setups without using some technology. But with this easy to use 3-step scanner, it makes it possible because I've made the investment for you. You see, look, I know what it's like to struggle as a trader in the market. I do. I've had the pleasure of training thousands of traders, and I wanted to develop a scanner that made it very easy, very simple to find profitable trades with great potential. And even for myself, before creating the RKO system, I would come across one of these setups maybe once every 6 months. I would miss so many opportunities. But finally, I've invested both time and money to develop this simple, easy to use scanner that you can harness in just 3 easy steps. Imagine what your trading account would look like if you could just sit in front of your charting software and have a powerful trading tool that identified both the trade entry and exit points in just seconds. Imagine if you could block out all the noise in the market and only focus on trades that have been identified for you. What would that mean to your trading business? Well, that's exactly what the RKO scanner does for you. These are some examples of trades, both exits and entries, identified by the RKO scanner and displayed by the RKO indicator. On the left are the stock trades. On the right are some option trades. This one in YPF, a stock trader could have bought the $5 or could have bought the stock at $5.89 and 10 days later sold it at up to $7.37. That's a 25.1% profit in just 10 days. In WTI, a stock trader could have bought the stock at $6.80 and sold it at up to $9.10, locking in a 32.5% profit in just 6 days. Now, this works fantastic with these lower price stocks, even for small traders, because you can make potentially massively high percentages. But what about some stocks that maybe have a higher price tag? Well, look to the other side of the screen here. In the options, in IBM, a trader could have bought the 138 calls at $2.18 and sold them 11 days later at $6.15, locking in a 182.1% profit. To make that more tangible, if you bought, say, 4 of those calls, you'd have invested $872 and made a profit of $1,588. Even if you make, say, 3 of these trades a week and your results are half as good as some of these, how much impact can this have on you and your family's financial future? Start getting the results that you deserve. This is Nick. Our head coach, John, who's a brilliant guy, ex-Goldman guy, by the way, John and I shared with Nick what we were thinking when we came up with this. Nick was one of the first humans, he was actually the first human besides me and John, ever to see the RKO. And in fact, he was actually extremely instrumental in helping us as well. And Nick said, using scanners, in particular the RKO daily scanner, helps me find trades when I'm busy or might not be fully locked in the market. I run the scanner and do the checks and decide to take the trade or move on. It only takes a few minutes and helps me find the best trades consistently. I want to invite you to join us and start using the RKO system right away. So today, first you're going to get the red knockout scanner. So every day you'll be able to have a list of all the RKO trades available in the market at any given moment. This simple scanner searches the universe of over 6,000 stocks for the setup and makes it possible to find trades that you would never have access to without it. For you to profit with the RKO system, I need you to know how it works. So I created a video training course that shows you step by step exactly how to install this on your platform, how and why the RKO system works, how to set up the trades, the filters and cross scans to optimize the strategy, and of course, targets for the exit and trade management. So what this means is first you're going to get the red knockout system and you're going to get the RKO accelerator video course to get up and running right away. Now, look, I can put the tools in your hand. I can tell you how to use them. But I know for me, I learn faster when someone shows me exactly how to do it. So the best thing I can do for you is give you hands-on training. Every Friday for the next year, 1 full year, you're going to get to attend our online live group coaching class and watch John Kamisic, he's the ex-Goldman guy, set up RKO and other trades right there while you watch. Again, John's formerly with Goldman Sachs, First Options of Chicago, Lind Waldock, traded for a hedge fund, and he is the expert on the red knockout and more. Like I said, he helped me develop it. He's just the kind of person you want to listen to. And I want to make sure that you hit the ground running and get all the hands-on training to start getting immediate results. Now, I want you to meet Dennis Mixel from East Peoria, Illinois. He says, thanks, great class. Exactly what I was looking for. The class gave me a lot of insight into options and the Greeks. I'm a fairly new trader, but I've been putting in the work to move my skills forward. How would it feel to have top picks selected by an ex-Goldman guy every single day? Well, look, you're going to get the red knockout system. You're going to get the accelerator video course. And today, you're also going to get that weekly group coaching with John. And that's a $5,247 package. But do you mind if I over-deliver? What I really want is for you to make as much money as possible trading the RKO, and I imagine you do too. So every day, we're going to rank the day's RKO trades and list them out and give you our top RKO picks so that you can see what we think are the best of the best. This is the RKO watch list, and this is a $1,297 value. Plus, John will also add a bonus trade every day from his daily group coaching class, the daily version, so that you never miss a beat. You can diversify your trading and get all the top trades of the day by simply clicking one link to access your curated watch list. So what that means is you're going to get the red knockout system today. You're going to get up and running fast with the accelerator videos. Every Friday, you're going to watch the weekly group coaching or the recording, and you're going to get access to the RKO watch list. And finally, this completes everything you need to make the RKO simple to trade. With the RKO indicator, we put the arrows right on your charts to show you the trigger candle, confirmation candle, even the exit price. So all the information is laid out for you. This literally could not be easier. So that means today you're going to get the red knockout system. You're going to get the accelerator videos. You're going to attend the weekly group coaching. You're going to get it all put on a watch list for you. And you're going to get the RKO indicator right there on your chart. RKO works on the following platforms: Metastock, Thinkorswim, NinjaTrader, TradeStation, TradingView, and I think a couple others. Now, you may have noticed the red knockout trades are all for when the stock is rising, and for that reason, these tend to work in bullish markets a little better. The market doesn't always go up, does it? And not all stocks always go up, do they? In fact, some can have some pretty big bearish moves. So I have created the green knockout to double your chances of success. So today you'll get both the red knockout and the green knockout. So you'll have all the tools you need to trade any market up or down. So that means you get the red knockout, you get the accelerator video course, the weekly group coaching, the RKO curated watch list, the indicator right there on your chart, and you get the same thing for all the bearish markets too. Plus, you're going to get updates every time we optimize the strategy to make it better for 1 full year. Buy now. You can see why the RKO trading system is a steal even at $10,041. If all this did for you was identify the trades that had profit of 182.1% or 83.7 or even 25.1%, the question you need to ask yourself is, would it be worth it? Yeah. But you're not going to pay $10,041 today because you've made the investment of being here live on this training, and for being one of my action takers, you're the elite. You're better than millions of other traders out there. And I want you to have the results that you deserve. Get started today for a one-time, small, easy investment of only $997 by going to markettaker.com/meta. 123go. That's market like stock market, taker like take what is rightfully yours, 2 T's in a row. That's markettaker.com/meta. That's short for Metastock. But to get all these bonuses, including the green knockout, to maximize your success in any market condition, you have to be one of the first 25 new members today. And you have to take massive action by going to markettaker.com/meta. 123go. Now, just to recap one more time, when you open your browser and go to markettaker.com/meta and sign up today, you're going to get access to the red knockout scanner that is going to identify trades with the entry and exit points. On top of that, when you're one of the first 25, you're going to get instant access to the RKO Accelerator video course to get you up and running right away. You're also going to get access to the weekly group coaching, where we will go live into the market together, and you'll see exactly how me and my team, John namely, use the scanner to generate profits in the market. You will also get access to the RKO watch list with our top picks of the best trades that John and I are looking to trade with the scanner. This way, You have the best opportunity to generate profits from the scanner by following the exact trades that I'm looking to place. And further, when you open your browser and type in markettaker.com/meta and lock in your RKO traders package, you will get access to the RKO indicator itself. This way, while we're coaching you live in the market each week, giving you access to my top watch list, you'll also have access to this powerful indicator 24/7 across multiple markets to take full advantage of this great and easy to use trading indicator. Also, as we run more tests, more tweaks, as the RKO continues to evolve and we get it performing even better, you'll get automatic updates for a full year to all this. And lastly, when you join us right now, you'll be one of the first to trade the green knockout. You'll have the confidence of knowing that you can trade in any market, up or down, but you have to take massive action right now and be one of the first 25 members today. Now, I'm going to go through some frequently asked questions. And then actually, I see we have a good number of people join us already. In fact, let me really quick welcome the people who just joined us, and then we're going to answer some questions. If you have a question that I can answer to help you make the decision to join us and invest in the RKO Traders Package, pop it in the questions box there. But first, I want to welcome Charles. Welcome and congratulations, Charles. Nice work picking up the RKO Traders Package. Welcome and congratulations to James. And welcome and congratulations to Paul. Welcome and congratulations to Tina. Welcome and congratulations to Lawrence. Welcome and congratulations to Heather. Welcome and congratulations to Jennifer. And welcome and congratulations to Jerry. Wow, we are off to a wonderful, wonderful start here so far. Now, let's answer some frequently asked questions. Sometimes people ask me, Dan, what if I can't install it properly? Well, we send step-by-step instructions of how to set it up, how to use it. Very, very simple. It's a video. All you have to do is follow along. Is it time-consuming? No. Many traders have a busy schedule. I've designed RKO so you can literally trade this system in about 60 seconds per trade. What if I can't figure it out? You get a video tutorial plus hands-on training live every Friday morning in the group coaching. Speaking of which, what time is the weekly group coaching? It's live every Friday from 9 to 10 Central, which is 10 to 11 Eastern. But I know many of you work or have things that are going on at that time. So the class is recorded in case that time's not convenient or you just want to review. Another question I get, Dan, I can see how this is a great way to grow my account, but I have a small account and I have a hard time coming up with $997. Is there a way to finance this? And that answer is yes. We have a deal with PayPal to offer you both PayPal as a payment option and also PayPal credit. So you can lock in the red knockout today when you check out using PayPal and just choose PayPal credit. How do you do it? Just go to markettaker.com/meta and click the PayPal button to get started right now. So once again, a little quick recap here. And then I'm going to welcome some more of the new people who just joined us and get a little head count here. When you join us today by going to markettaker.com/meta, first you're going to get the red knockout system. You're going to get the RKO Accelerator video course. You're going to get the hands-on training in the weekly group coaching. You're going to get this even easier because we're going to curate it and tell you which of the RKO trades we think are the best and give you bonus trades every day. We're going to give you the RKO indicator right there on your Metastock charts or whatever. And as an extra bonus, you're going to get all this for the bearish markets too. You don't have to separate them out. You're going to get that free today as part of your package. And how do you do it? You go to markettaker.com/meta. So Paul says, how does this differ from the nail the trade? Yeah, that's something else that I did. This is a lot different. That was, the other thing was more for investors. It was covered calls, cash secured puts. This is a momentum trading system. It's a little bit more for active traders, not like day traders or something where you have to be in front of your computer all day long, but for people who, make trading, at least a part-time business. Maybe you're in front of your computer on and off, for an hour a day. Maybe you have a full-time job, but you trade off your phone and you need to be able to easily identify the trades by just going to the watch list, double checking it in the RKO indicator, and jumping in and making the trades. So yeah, this is
YouTube questions, Dan.
Oh yeah, go ahead.
Let me know when you're ready for them.
Yeah, I think I just answered that in total. This is pure momentum indicator where trades last anywhere from 2 to maybe 2 days to 2 weeks. All right, what you got for me, Jeff?
I'm sure this is his real name, but PVDG from YouTube wants to know, what consistency does the pattern have?
Yes, so there are multiple time frames, multiple different asset classes. We're talking stocks, options, commodities, Forex. So, that's impossible to answer. Plus, I don't take all the trades, and I share in the Accelerator video course how to screen those trades so that you're not taking all of them either, so that you're just taking the best of the best.
Gotcha, which always helps. He also wants to know, how often does the scanner find a trade? How often will it be traded?
Especially between the red knockout and the green knockout, it's anywhere from a few a day. And I personally trade just off the daily candles. I'm not day trading or anything like that. I personally trade just off the daily chart, and I'll see anywhere from 4 to, maybe 2 to 12 trades a day. It depends on market conditions, how it sets up. Yeah.
We're caught up on YouTube.
All right. Well, holy moly. Thank you so much. First of all, Jeff, for having me. Thank you all for attending this session and trusting in me to share with you this strategy, because I think it's great and I love it. And we've got an army of traders trading this. And special thank you and welcome to all of our new folks. And I know I didn't read all of your names, but either way, welcome. Jump into our chat room and I'll give you a big warm welcome tomorrow morning. That said, I got one more question that popped up here.
I was going to ask you. So there you go.
Yeah. Does your indicator work for futures, ES and NQ? Yep, absolutely. It will work for those as well. Michael, you are welcome. All right.
Thank you to you, Dan. Thanks for spending an hour with us. Appreciate it.
Yeah, thank you again so much.
Great job too, by the way.
Thanks.
All right, cool. Let me, and the offer for that is markettaker.com/meta. Thanks again, Dan. We appreciate you coming in. Let me go ahead and we'll wrap it up right here. Let me make the presenter here. I do want to actually do just a few things. I want to thank our sponsors, Task, great sponsors, sponsoring us for over a decade, a dozen years. Task is such a great magazine, and we certainly appreciate their sponsorship over the years, and they do a great job. I also want to thank AAII.com. AAII, great sponsor, great company, great nonprofit organization. AAII.com for that. And then, of course, the CMP Association, another great, well-respected, well-reputed organization who's also going to be coming in there. Before we totally wrap up for today, let's go through tomorrow's schedule. I've got it right here. We have another great day for tomorrow. So let's go ahead and start at the top. I talked a lot about Rahul's system during my time today. Rahul's going to come in and kind of kick off the day for us tomorrow. After that, we're going to have Wendy Kirkland, who does a great job with the options and her indicators. Then we are going to have Alex Cole and Tyler Wood. They're going to come in and talk about data and emotions. Steve Primo, Silas Peters, John Thomas, Anka Metcalf, Rod David, and Casey Stubbs. So another great lineup tomorrow. I hope you can enjoy it. I hope you join us and enjoy it. And yes, also progressively worse enunciation by me, by yours truly. So that's what we've got on the docket for tomorrow. Hopefully you can make it. If you haven't tried Metastock yet, you should. Metastock.com/conf promo will get you a buy one, get 3 on Metastock. You can also contact us with any questions you've got, metastock.com/sales chat. And you can also give us a call at 800-882-3040. Thanks everybody for coming. It's really good to see you. Hope to see you again tomorrow. And I will be back. See you tomorrow.
Hi, Kelly Clement here from Metastock. Before you go, I have 2 quick things for you. 1, thanks for joining us today. We love having you here at our webinars and viewing our videos. So what I'd like to invite you to do before you go is like and subscribe. Like the video, subscribe to the channel. It helps us a great deal and it helps us bring you more awesome content like today's video. The second thing is we have a great ebook on trading that you can get for free. If you go to metastock.com/YouTube book, you can get a free copy of The Secrets of Successful Traders. It's a great book with lots of content from traders just like yourself who can teach you some of the secrets that they have learned. Thanks for taking a second with me and learning about those 2 things. Thanks for joining us and keep on trading.